This is the time and place scheduled for the Nevada State Board of Equalization hearing. It's 9:30, September 29th. Would the clerk please call a roll?
Chair Morse,
Here.
Member Bancroft,
Here.
Member Burke. Here, Member Cadwell.
Here. Thank you.
We have a quorum.
We have a quorum and we are legal. The meeting has been properly noticed and posted. And I think we're in compliance with Nevada open meeting law. Would staff introduce themselves, please?
Thank you, Mr. Chair.
Thank you.
Jeff Mitchell for the record. I am the Deputy Director of Excise and Local Government Services with the Department of Taxation and will be acting as secretary to help us with the agenda. To my right is Adrian Roberts Larson, Chief Deputy with the Department of Taxation. We have Carrie Skalski providing staff up north, down south in Las Vegas, and we have Hector Sepulveda up north providing staff in Reno. At this time, I'd like to go just through some of the procedurals.
Wait a second. I'm sorry, I missed something. Would everybody please rise for a pledge of allegiance? I pledge allegiance
To the flag of the United States of America and to the republic for which it stands, one nation under God, indivisible, with liberty and justice.
Just a second, Jeff. On the agenda is opening remarks by the chair. I would just like to thank everybody that has been able to make it today. We have to consolidate this meeting with the one that we had to cancel in August, and I really apologize for that. We had some issues with personnel, I guess, and we weren't really ready to make sure that everybody had received all of their information. And so we postponed that meeting. We've had a lot of change in staff at the department. And the only way really this meeting is coming together today is the efforts of Mr. Jeff Mitchell. And I want to thank Jeff for his expertise in putting this together and keeping everybody in order and getting the files out and making sure that everything's rolling. We had a change in the department staff as well with Carrie coming on board. And thank you, Carrie, for your assistance to Jeff. And then also we have a new attorney today. Would you introduce yourself, please?
Good morning, Mike Denner from the Attorney General's office, operating at Fort Council today.
He was recruited yesterday. I think it was 9:30 last night I got the email. So thank you for participating. So we're going to roll right along. And I know we have some people in Northern Nevada. Can everybody in Northern Nevada hear what's going on down here?
Yes.
Okay, good. Thank you. Let's have introduction of the board members. You guys do that yourselves, okay? Let's start on this end down here.
Good morning. I'm Paul Bancroft. I'm an attorney with the law firm of McDonald Carano. I've practiced law in Nevada since 1981. And a large portion of my practice has been addressing property tax matters. I've participated in numerous appeals and representing taxpayers before the county boards of equalization and this board. So it's now fun to be on the other side.
Thank you. I'm glad you are joining us.
Curtis Cadwell, I'm an accountant. I work at gold mines up north. I live in Elko. I've been involved in taxation probably since 1998 in Nevada when I started at Gold Strike back in the very early days. But yeah, it's good to be here.
Thank you.
Corey Burke. I am actually currently retired, but I worked in assessment since 1997, first for the Department of Taxation and then Washoe County. And I'm currently a realtor in Lena.
Thank you. My name's Tim Morse. I'm the chair of the state board. I have been practicing as an appraiser, commercial appraiser in Nevada since I think it's 1973, 73. I am retired now, but I still maintain my MAI designation to qualify for this board position. I've been on the county board of equalization I was on the county board for quite a while. I've had some experience appraising a lot of properties in my career. And I think the agenda today is going to be very challenging. So I appreciate everybody's attendance, and now we know who all the board members are. Next item is public comment. Anybody wishing to express public comment, please raise your hand or say something, okay? Hearing no one, we'll move on. Next item on the agenda. Oh, I'm sorry, Mr. Mitchell.
Thank you, Mr. Chair. With public comment, we now have to read a little statement on the record. If we can just pause for Carrie to do that real quick, I apologize.
Persons wishing to provide public comment remotely may access the meeting by using the telephone numbers and meeting ID posted on the agenda. Public comment will be limited to 3 minutes per person, and comments based on viewpoint will not be restricted. Public comment will be available at the beginning of the meeting and at the end of the agenda. At the discretion of the chairperson, additional public comment may be heard when that item is reached. The chairperson may allow additional time to be given to a speaker as time allows at his sole discretion. NRS 241.020, NRS 241.030. Thank you.
Thank you. Anyone wishing to express public comment? Hearing no one, go ahead, Mr. Mitchell.
Thank you, Mr. Chair. Before I call the first item on the agenda, I will go through a little bit of the procedural functionings of the board. At the beginning of this hearing, we will have an administration of an oath that will be administered by Mr. Detmer in just a minute. In the matters of the cases, if there is new evidence that has been brought forward, we will first hear the consideration of why this new evidence is being brought forward and why it was not available to be heard at an original hearing, if it was heard at the County Board of Equalization, or why it was not filed timely, if it is a direct appeal that we are addressing. After we addressed either of those matters, we will move on to the case itself. The petitioner will have 15 minutes to provide their opening statements and remarks. The respondents will have 15 minutes for rebuttal, with a 5-minute rebuttal by the petitioner, and then the meeting will be closed for deliberations. Questions by the state board are usually after the final rebuttal. Once the matter is closed, it is usually not reopened for questions of the members, but rather the deliberation process is continued by the board. With that, I think I'll turn it over to, one more comment. This is an administrative hearing. We ask that everybody be polite and respectful of both parties as well as the board. We do have a court reporter that is taking transcript. Please do not talk over one another. Speak clearly, speak slowly so that we may have an accurate record of what is transpiring. At this time, I will turn it to Michael Detmer for the oath.
Good morning. Mike Detmer for the record. For those of you who are going to testify before the board, if you could please stand and raise your right hand. Do you hereby swear or affirm to tell the truth, the whole truth, and nothing but the truth? Thank you very much.
Next item is D, the consent agenda.
Thank you, Mr. Chair. Jeff Mitchell for the record. Under agenda item D, the consent agenda, we have items 1, 2, and 3. These are all matters that have either been agreed on by the county assessor or the Department of Taxation and the various petitioners. I have reviewed the case matter, and these have all been properly noticed, as well as stipulations within the case files. If the board wishes, the proper motion would be either to pull an item off of the consent agenda if you have questions in regards to one specifically, or we can have a motion to do pass items D 1, 2, and 3 on the consent.
Thank you. Go ahead, Mr. Bancroft.
Thank you, Paul Bancroft. My firm, McDonald Corona, represents Mission Support and Test Services in case numbers 25-157, 158, 160, and 161. I will not be participating in the consideration or vote on those matters. And so I'd suggest that they be addressed in a separate vote.
Thank you, Mr. Bancroft. Corey?
I make a motion to accept items D 1, 2, and 3, excluding 25-157, 158, 160, and 161.
I have a second?
Second.
Have a motion to approve the consent agenda items with the exclusion of the mission support ones. That we'll hear separately. All in favor, please cast your votes. Aye.
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 I make a motion to accept item D 2, case numbers 25-157, 158, 160, and 161.
And Mike Demmer, for the record, I apologize for the interruption with the board. My understanding is with that last vote, it did pass, that there weren't any nays.
Correct. I'm sorry. That's true. We did pass. We have a motion to approve the mission support items. Do I have a second?
Second.
Thank you. We have a motion to approve those items. All in favor, please indicate by saying aye.
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 Mr. Bancroft has abstained. The motion carries. So thank you. All of the consent items have been taken care of. So next we're on to E. Mr. Mitchell.
Thank you, Mr. Chair. Under item E, we have a recommendation by the secretary to dismiss the taxpayer's appeal pursuant to NAC 361.7014. Case number 25-109 is hereby called the Esley Carmona Irrevocable Trust. With this specific appeal, we have prior tax years, which were a part of the original appeal. The recommendation is to dismiss those tax years as they have already been considered by the State Board of Equalization and decisions have been rendered on those. The matter of the current tax year is agendized further on in the agenda and will be held separately.
Any questions or comments from the board? Hearing none, I make a motion to accept the dismissal of 25-109. Have a second?
I'll second.
Second, Mr. Bancroft. All in favor, please indicate by saying aye. Aye.
Aye.
Aye.
Did you vote, Mr. Bancroft?
Yes, aye.
Motion carries. Thank you. That next item, Mr. Mitchell.
The next item is case number 25-144, Landcap Sparks 4 LLC. The taxpayer is requesting that the State Board of Equalization reopen prior years. For a previous year, the State Board of Equalization made a decision. That decision was applied for the appropriate year and then reverted back to a previous value methodology. The taxpayer did not appeal those years when it reverted back to the previous methodology. The taxpayer is appealing the current year, which is agendized later on in the agenda. And the recommendation from the secretary is to not accept jurisdiction on the tax years where it was untimely filed.
Board members?
I just have a question. I understand our jurisdiction is limited to the appeal before us, but in the situation where you have a case and the state board renders a decision, which it did for tax years 2022, 23, and tax year 23, 24, I think we have continuing jurisdiction to ensure that the decision of the state board was correctly implemented. There are allegations in this appeal that the assessor negated the SBE decision and increased the property's quality class in contravention of what the state board held. And so it's not clear cut as to those early years, whether the state board decision was correctly implemented.
Mr. Mitchell, do we have to hear the case then? Is that?
Jeff Mitchell for the record. The matter of jurisdiction is up for the decision of the state board if they want to reopen those cases. It is the secretary's opinion that the order from the state board for the appropriate tax years was applied appropriately. It is in subsequent years, the assessor made the decision to go back to its previous methodology, which is within their authority to do so. And I believe that the assessor's office is at the table if you would like to hear from them.
Okay. Good morning. Go ahead. Introduce yourselves for the record, please.
This is Jeff Lewis for the record with the Washoe County Assessor's Office. So, yeah, so in the 2022 or 2023, 2024 tax year, you guys did hear this case, and we made an adjustment to the quality class. The decision and the subsequent work to fix the record on that, the paperwork was received a little late, past when we did our new costing for the 2024 year. Before that year, when the decision was made to reduce the quality class and therefore reduce the value, we did make those changes for that year. But like was said, we did readjust our valuing of the property in the future years because we don't believe that the reduction to the quality class was appropriate. So we did adjust it.
Is that satisfactory?
Well, yeah, I'm on. For the tax fiscal year 2024-25, I don't see a basis for jurisdiction. But for those earlier 2 years, there's the allegation from the taxpayer that, and I'm quoting from his brief, the assessor negated the SBE decision and increased the property's quality class. But what you're telling me is, no, that did not occur.
Shannon Scott with the Washoe County Assessor for the record. So for the 22-23 fiscal year, all adjustments were made according to the state board decision. Each year stands on its own. So for the 2024-2025 fiscal year, the property was relooked at and readjusted. But for the year that was appealed, so for the 2023 year, all adjustments were made correctly.
Okay. And is the
petitioner present?
Yeah.
Mr. Polocalis?
No. Okay.
We have no petitioner present, so I'd entertain a motion.
I'll make a motion that we dismiss the appeal to the extent it applies to tax years 2022-23, 23-24, and 24-25 fiscal years.
Have a second?
Second.
Second for Mr. Cadwell. All those in favor, please indicate by saying aye.
Aye.
Aye, Tim Morris.
Aye.
Motion carries. That item is taken care of. Jeff, we're on F.
Thank you, Mr. Chair. Jeff Mitchell for the record. Under agenda item F, we have two cases, case number 25-124 and case number 25-143. I did receive an email this morning on case number 25-124 in regards to the petitioner that he indicated that he wishes to withdraw. We do not have that paperwork in front of us at this moment, but we are efforting to get it. So I would make a recommendation to continue this case 124 to the end of the agenda to see if we can get that withdrawal paperwork in line.
Wouldn't need a motion to do that?
It's discretion of the chair.
Okay, we'll move that item later.
Sorry, he asked about F. You're talking about G. F is the crossing LLC 120, 21, 22.
My apologies.
So on 144 is the email that you got or on?
124 is the email that I received. Under agenda item G, my apologies. We have the recommendations by the secretary to dismiss taxpayers'
Oh,
appeals.
hold
pursuant-
on a second. We're on F. Right? That's the crossings. By recommendation to dismiss.
One moment, Mr. Chair.
Am I on the wrong agenda here? I'm looking at the one that was posted September 23rd.
This is the posted. So that is so I would say that.
That's fine. Back on the record, item F, possible action recommendation by the secretary to dismiss cases 25, 120, 121, 122, and 123. Is that correct, Mr. Mitchell?
That is correct. Thank you. Jeff Mitchell for the record. My apologies. My notes were sideways. Under agenda item F as called 25, 120, 121, 122, and 123. The recommendation by the secretary is to dismiss these as these should have been filed with the County Board of Equalization first. There was no appeal filed with the county. They were filed directly with the State Board of Equalization.
Thank you, Mr. Mitchell. Any questions from the board members? If not, I'll entertain a motion.
Mr. Chair, I do believe that both the petitioner and the respondent are present if you wish to receive any comment on that.
Thank you. Would you introduce yourself for the record, please?
For the record, Diana Arias from the Washoe County Assessor's Office.
Shannon Scott, also with the Washoe County Assessor's Office.
Jim Kaplan, representing the crossing and the 16 small business tenants that occupy that space.
Who is going to familiarize us with the property and tell us what the heck's going on here?
If the county assessor could just introduce the property and give us a brief overview, and then Mr. Kaplan, if you could explain why these were not filed timely with the County Board of Equalization. The standard for accepting is if there was matters outside of the control of the petitioner.
For the record, Diana Arias from the Washoe County Assessor's Office. So these are parcels including 040-162-5051. Sorry, 040-162-51, 040-162-52, and 040-162-53. They're known as the crossing at Meadowwood Square on Virginia Street. It's across the street from Whole Foods. Current tenants include Ski Pro, Subway, Taco Bell, Panera, Ocean Spa, among other tenants, but these are the tenants that are most known. Are there any additional questions about the?
No, that's fine. Mr. Kaplan?
Okay.
Thank you all for being here and for hearing this. As you can see this morning, the confusion continues. So, the tax structure of raising taxes for deferred maintenance and updates to a property like this that was built in the 70s really discourages property owners from making improvements and business owners from making improvements to these. The taxes.
Excuse me, Mr. Callen, just a second here. Before we get into hearing the case, we need to hear from you as to why this wasn't timely filed, because the item on the agenda is to dismiss this because of untimely filing. So we have to decide whether we're going to take jurisdiction and hear this case or not. So that's what we're here asking you, Mr. Kaplan. I apologize if you didn't understand what Mr. Mitchell said, but that's what we need to start with before we get into the details of the property. Thank you.
We received the information on the tax increases late, and by the time we were able to analyze that, we were told by Washoe County to appeal to the state for it to be heard there. And that was somewhere in I think early to mid-February. Excuse me.
Mr. Bancroft?
Were the taxes assessed on the secured roll?
You're asking the assessor's office?
Yes.
For the record, Diana Arias for the Washoe County Assessor's Office, and yes, they were.
And was an appeal filed to the County Board of Equalization?
No, there was no appeal to the
If-
county board.
If they were assessed on the secured roll, wouldn't the taxpayer have been given notice?
Yes. So those are sent in on December, and they have till January 15th to appeal.
But no appeal was filed.
Correct.
As a general rule, matters that are assessed on the secured roll are to be appealed to the County Board of Equalization before coming to the state board. And I don't know of any statutory authority for us to hear an appeal that bypasses that County Board of Equalization.
Correct. So do you want to send it back to the county? Mr. Mitchell, is that possible, or what do we do?
My recommendation would be not to accept jurisdiction, and the County Board of Equalization unfortunately cannot accept jurisdiction either, because they do not have statutory authority as it was lately filed.
Mr. Kaplan, I'm very sympathetic. The timeframes in Nevada are very tight in terms of addressing these property tax issues, but they're also those timeframes limit our ability to take action. Thank you. I understand. With the mailing taking place and the delayed United States Postal Service during that time of year, I don't know when we received it, but we didn't receive it in enough time to analyze it and turn it around and file the petition. So if you could put it back to the Washoe County, I believe you have the jurisdiction to do that, then we can work through it with Washoe County. I'm sorry, but I don't think we have jurisdiction to do that. I don't think they'd have jurisdiction to take the matter up. I think at this point, your best strategy would be to start preparing your case for the next appeal season.
Yeah, unfortunately, that's, I agree. That's all we could do, Mr. Kaplan. Because of the untimely filing, I really apologize. I think it stinks, but.
Just so I'm clear, how many days is that you have to analyze and file? As it's very tight, and well, just what is it exactly? Well, the assessors are required to post their secured roll by the end of December. Usually they do it much sooner than that, but under the statute, they don't have to do it till the end of December. And yet you have to make your determination and appeal by January 15th. And that means that it effectively could be sent out on December 30th, December 31st. We don't receive it till January 5th, January 10th, and potentially even later than that. And then at that point, we have to spend the time to look into it and do the research and then file within that 2 or 3 day period. Yes, that's the way it's set up. I don't think it's good, but that's the way the statutes read.
Corey?
I believe that value notices actually have to be mailed by December 18th. So you have nearly a month. And
Well,
then the roll is posted in the newspaper or online by the end of the year.
So that depends on the mailing and tracking. So I understand. It's but I just think if there was a jurisdiction by your board to be able to put it back to Washoe County, that would be more in line with what I think everybody's incentivized to do, which is to make improvements to buildings that are derelict or antiquated and with deferred maintenance and to bring things up to current grade.
Yeah, I understand, Mr. Kaplan. I think that Mr. Bancroft gave you a good suggestion, and Corey stated that those numbers, I think, are available sooner. They are posted on the Washoe County Assessor's website. You can check those prior to receiving the mailing. My suggestion then is get the appeal form, file it. You can always withdraw it, which you'll get their attention, and then you can go and discuss the case with the assessor's office before the county meeting, and you can supply them with whatever material you would like and that they would request. And maybe you could come to some kind of an agreement before the meeting, but if you file that petition, you can always withdraw it. So unfortunately, that's all I think we can offer as a suggestion for you today, sir.
Okay, thank you for your recommendations. Appreciate it.
I'm willing to accept a motion at this time.
Make a motion to dismiss cases 25, 120, 121, 122, and 123 on the basis that we have no jurisdiction.
Second,
I'll second it.
we have a motion and a second to dismiss 120 through 123. All those in favor indicate by saying aye.
Hi.
Aye.
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 Aye, motion carries. Thank you. Next item is G. So we're going to go on to 125, 124.
Thank you, Mr. Chair. Jeff Mitchell for the record. Under agenda item G, 25-124, we do have consideration of a remand back to the County Board of Equalization to provide an accurate record or adequate record pursuant to NRS 361.360 sub 6. These were timely filed with the County Board of Equalization. Unfortunately, there was no decision made at the County Board of Equalization, and therefore no decision could be appealed upwards to the State Board of Equalization. We did receive information on case number 25-124 that the petitioner is looking to withdraw that case. With that, I would like to make a recommendation to the chair that we just consider that case later on in the agenda if we are able to receive all the paperwork on the withdrawal.
I'll entertain a motion to that effect.
Chair.
Yes.
Sorry, Mike Devon for the record. With this just being a continuance at the end of the agenda, you have the discretion to just table it.
I'll just table it. Good. All right, let's go on to 143.
Thank you.
143, Mr. Mitchell, please.
Case number 25-143, the Esmeralda County School District Board of Trustees. This matter was considered at the county, but they did not make a motion or a decision. Therefore, there was nothing to consider under appeal. The recommendation from the secretary is to remand back to the County Board of Equalization so that they can render a decision. I believe the petitioner and the respondent were both properly noticed. I do not know if they are in attendance or on Zoom.
I see we have some people. They would like to introduce yourselves, please.
Thank you. Ladies and gentlemen of the commission, my name is Ryan Russell. I'm an attorney with the Allison McKinsey Law Firm representing the Esmeralda County School District. Present with me at the table is Annabelle Guerrero, the financial manager. We also have representatives from the superintendent's office, Winifred Sanderson, and the superintendent himself, Jonathan Firm, in the audience.
Thank you. Any questions or comments from the board or?
I do have a comment. I would like to recuse myself from this case as I have a relationship with counsel for the Esmeralda County School District.
Thank you.
Do we have a representative?
I apologize.
Sure.
Mike Demer for the record.
The nature of that relationship is counsel is my nephew and my attorney.
Thank you.
Okay.
Okay.
Do we have a representative from Esmeralda County here?
Do we have any representatives from Esmeralda County Assessor's Office, please? Seeing one, no one, move on. Let's go.
Just as an, just as an observation, I've read through all the materials. And I agree that with Mr. Russell's analysis that these should be exempt parcels. There's no requirement in the statute that the property be, quote, in use. And if you look at the other statutes and read them consistently, for example, for charter schools, any property acquired is deemed to be for educational purposes. I don't know why we'd take any different approach to this. However, that being said, the county board didn't make a decision. We don't have a decision to reverse it or not, and it's set up here for a remand. I think that as a board, we could remand it to the county board and hope they make the correct decision, or we could just make the decision right now ourselves. Those are just my comments.
Mr. Mitchell, I guess the item on the agenda really is to decide whether to dismiss this or not, correct? Do we have an option to hear this case? Or do we take jurisdiction and hear it, or do we?
Thank you, Mr. Chair. I believe, as this is agendized, the recommendation is to remand it back. If you decide not to remand it, the case was filed to the State Board of Equalization. We would then need to make a motion to accept jurisdiction and to hear it, which I believe is within the authority and scope of the State Board.
Board members, what's your desire?
I've read it. I'd make a motion to accept jurisdiction and make the decision.
We have a motion to accept.
I'll second the motion.
We have a motion to accept jurisdiction and hear the case. All those in favor indicate by saying aye.
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 Aye, and we have an abstention from Corey. So let's move on to hear the case. 25-143.
Thank you. Jeff Mitchell for the record. I would like to call case number 25-143. The petitioner has 15 minutes to explain their case.
Thank you, Mr. Chair. What you have before you today is very truly a pure question of law. In the state of Nevada, a school district property, and this is pursuant to NRS 361.065, is exempt for tax purposes. If school district owns property, even as noted on the agenda that put us before you today, the property is exempt. And when we're talking about a public entity, a school district in particular, the Supreme Court has routinely found that exemption is the rule, taxation is the exception. And there's no grounds for an exception in this case. The school district has owned these lots, as noted in the record by the assessors, for at least 35 years, one of them up to 100 years. And until 2022, they had never been assessed ad valorem taxes. They were assessed in 2022, and that number that has been assessed since has grown exponentially. When we went on appeal of this matter to the county board, as noted, the board heard the case. And that's the standard that has to be applied in order to come up to you, is that they heard the case. And what really happened is they failed to equalize the school district's property. And they failed to do it by not making any decision, which was very much like denying the appeal because the assessment stood. And so we come to you today to have the exemption properly returned to the property as it had been. And in doing so, we note that the school district is very small, one, but it does hold this property for school purposes. It doesn't use it for anything other than school purposes. And under the statute, school districts are able to own, manage, and dispose of property in their discretion. And that property, if so used, is exempt. And so I don't want to belabor the time that you need to consider this, especially given that there will not be any rebuttal from the county. I appreciate everything that's been said and would simply posit that this matter of the real property of the school district is exempt, and that we hope this board will make a decision to exempt the property.
Is there anyone here from Esmeralda County? One last time. Anybody from the Esmeralda County? Good job, Esmeralda County. Okay, I'll entertain a motion.
I'll make a motion to rule in favor at Esmeralda County School District in case 25-143.
I'll second that motion. All in favor indicate by saying aye.
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 Thank you, board. I wish you good luck with the rest of the meeting.
Thank you, board.
Thank you. The motion carries. The 25-143 is been granted exemption. We're on to H. Item H on the agenda, please.
I'll just make one disclosure on this one. I deal with Empire Southwest. I'm not going to recuse myself, but they're one of our largest vendors. So I deal with them on a very regular basis.
Thank you. Mr. Mitchell?
Thank you, Mr. Chair. Under agenda item H, we have an appeal from the action of the County Board of Equalization pursuant to NRS 361-400 for the 23-24 unsecured roll. The cases that are called are 25-127. It is personal property. The petitioner is Empire Southwest, and the respondent is the Elko County Assessor. I would make a note to the chair that case number 25-128, as well as case number 25-126 and case number 25-152 are all dealing with the basic same subject material and evidence. The reason for the placement in the two separate areas on the agenda item is with the unsecured roll, if it is valued before December 15th, the first layer of appeal is to the County Board of Equalization. And so we have a record where these two cases were heard at the County Board of Equalization and then appropriately appealed up to the State Board of Equalization. Under agenda item I, if the billing of the unsecured roll is after December 15th, these are direct appeals to the State Board of Equalization. And so there is not a county record for case number 25-126 or case number 25-152.
But all four of those cases have the same issue.
Same issue, but we are also dealing with four different counties. So the respondent is Elko County, Humboldt County, Elko County again with a different tax year, and the Washoe County Assessor.
Okay, so good morning. Could you introduce yourself for the record, please?
Sure. My name is Jim Seuss. I'm an attorney at the Deacon Cheney McDonald Law Firm. I'm representing Empire today.
And introductions down up north, please.
Hi there, Janet Earbarn, Elko County Assessor. I'm passing this to my Deputy Appraiser, Tammy Dickinson. Tammy presented this case to the board, the Elko County Board of Equalization back in February.
For the
Mr.
record, Tammy Craycraft Dickinson.
So we have a representative from Elko County. Do we have any representative from Humboldt County?
He's on his way up.
We have a representative from Washoe County too.
Good morning, Andy Heiser, Humboldt County Assessor.
Hi, Andy.
Good morning, Tony Lopez. Good morning, Tony Lopez from the Washoe County Assessor's Office, Personal Property Coordinator.
Okay, so we have the three counties here, and I
sorry to interject, but I presume Mr. Sousa would be comfortable hearing all four cases together.
He would not,
Oh, no,
Um,
okay.
but I appreciate that. Jim Sousa, for the record, what I'd like to do is just simply take 127 first, because we have a record in that. But Mr. Mitchell's correct, it's the same legal issue. And so to avoid any problems, we're going to have just one presentation to you. And then the counties can certainly address that, all three of them, if they would like. And then we'd ask the board to make a decision, then call the other cases, and we'll simply incorporate our arguments and things like that into each of the future cases. I doubt the outcome will change. And so that's how we'll dispose of four cases. And because we have four of those, I'm hoping to get more than 15 minutes to present my case, not much more. And then we'll get a decision from the board.
Mr. I just want to point out to you that 25-153 is very similar, and we will probably might hear that case before we make a decision on the other four. That's what's
Anything you
going to
want to do,
happen.
sir?
That's what's going to happen.
There you go.
Okay, so let's proceed with 25-127. You have, what, 15 minutes for this case, or since you're going to be basically covering all fours, are you going to require some more time?
Just a little bit more. Not duplicative, not times four, but maybe times two.
Okay. Paul. What's the first one? What's that? Go ahead, Mr. Sousa.
Well, the county might want to.
Well, let's get an introduction from the county, what this property is and what we're dealing with, please. Andy, you going to do that?
This is Tammy Dickinson for the record, Elko County Assessor's Office. I'll be doing the introduction for case 25-127. This is regarding Elko County Personal Property Account BU 002495 located at 5010 Idaho Street in Elko, Nevada. Empire Southwest LLC is a sales and rental company of heavy equipment. Empire markets itself as a cat dealer that also has a robust rental fleet of heavy equipment. Empire acquired the heavy equipment sales and rental company Cashman Equipment in 2022 and assumed their Elko County operations. Clients continue to enjoy the standard benefits of renting, such as on-site repairs, large selection of equipment, training, etc., from Empire that they had had with Cashman Equipment. Empire asserts that the equipment qualifies for exemption under NRS 361.068 Section 1A, which exempts inventory held for sale in the ordinary course of business. They also contend that all non-inventory was properly reported and that the 23-24 audit performed by Tax Management Associates disregards statutory requirements. As per NRS 361.265, a written statement of all personal property located within the county signed under penalty of perjury must be submitted at the demand of the assessor. This demand was sent to Empire on June 26, 2023. The declaration was returned on July 27, 2023, processed on October 13, 2023, and billed January 31st, 2024. Tax Management Associates, also known as TMA, was contracted by Elko County in 23-24 to audit local heavy equipment rental companies after internal reviews determined that they might be underreporting their equipment. TMA was retained to audit multiple companies, not just heavy equipment. This just happens to pertain to heavy equipment. The audit found that Empire had $17,674,240 in reportable equipment. Empire had reported $1,466,140 in equipment. Empire was notified of the discovery on October 21st, 2024, and was given 14 days to dispute it. This office received no dispute, and a supplemental billing was generated November 19th, 2024. Empire was notified of their right to appeal this valuation to the Board of Equalization. Empire filed an appeal on January 13th, 2025, citing NRS 361.357. Full cash value of the property is less than its taxable value. The case was heard by the Elko County Board of Equalization on February 20th, 2025. Empire initially requested a reduction to $1,541,900, but amended it to $2,101,342 just prior to the hearing. The appeal was denied. Empire filed an appeal to the State Board of Equalization on March 7th, 2025. Empire asks that the State Board of Equalization reclassify their on-site equipment as inventory and reduce their taxable value to $2,101,342. They have since stated that they recognize any equipment classified as non-CAT equipment, also known as allied equipment, should have been reported. The TMA audit identified 83 pieces of non-CAT equipment that had gone unreported with an acquisition cost of $2,129,979. Added to the initial request for reduction, the taxable value would be $4,203,284.
Mr. Souza.
Wow. It's a long introduction of the property. Okay, so here we go. I have some opening statements here. First, I inherited these cases from Doug John, who took them to Elko and Humboldt County. And then I filed a direct appeal for the Washoe County. So it's been a learning process for me as to what's going on. In this case, there's actually only one question. And the question is exemption granted in both the Constitution and statute for merchandise held by a merchant for sale? Lost when property that was purchased for that purpose is put into a rental fleet. And the assessor answers the question yes, Empire answers the question no, and the board has to decide who's right. So in general, personal property is based on a declaration the property owner completes, and Nevada law requires that the property owner go out and take a picture, if you will, on July 1st and say, what do you have? It doesn't matter whether the property got there on June 30th or whether it's actually going to leave on July 2nd. Nevada statute's very clear. If it's your property and it's in the county and it's July 1, then this is the property that is subject to taxation in the state. And there is no changing of that or amending of that as time goes on because it left the state the next day. For the entire year, it's taxable. So on July 1 is when you take the picture. On July 1, 2023 and 2024, Empire reported that its CAT equipment was either taxable or exempt. And what's important for this appeal right now is that all the equipment that's not CAT that's sitting in the rental fleet is subject to tax. And they had not reported that properly, the allied equipment being the biggest part of that. And after receiving the brief that was filed, I believe, by Elko County, we looked into allied and decided, sure, I think they're right. We are an authorized dealer for CAT equipment. Before us, for 100 years, Cashman was the authorized dealer for CAT equipment. CAT equipment is big stuff. It goes out to the mine, goes out to the construction companies. That's what we're talking about. Everything else that isn't CAT equipment is taxable. And we can work with the assessor and get a number. We just heard a $4 million number. That could be right. We'll figure that out later. The question before the board is whether the CAT equipment and only the CAT equipment is still exempt if it's sitting in the rental fleet. So we have statutes that apply to this, and we have a dividing line. And the statute gives us a dividing line of on July 1, is this equipment in the field, which means it's being leased to somebody, or is it sitting in the yard, which means it's not being leased to somebody, otherwise it'd be in the field. As a result of that, anything that was in the field on July 1, Empire said that's taxable, and they sent declarations to the counties, and they said, here's all the CAT equipment that's in the field, and therefore this is what the purchase price was, here's when it was acquired. The counties determined a taxable value for that equipment, and then they sent us a bill, and Empire paid it. The stuff that was sitting in the yard, they took the position that it was inventory, and therefore it wasn't subject to tax on July 1.
Excuse me, Mr. Sousa.
Yes, Mr. Banger.
You're drawing a distinction between personal property that's in the field and personal property that's in the yard.
Yes, sir.
Where do you find that distinction in the statutes?
I find that distinction in NRS 361-159 that states that when personal property, which is otherwise.
I've read it. I don't need it read to me. But that applies to possessory interest.
Pardon?
361-159
Yes.
applies to the assessment of a tax on a possessory interest. It does not apply to an assessment of a tax against an owner of the property.
Okay. I'm not sure we're going with that. We took the position it was taxable.
Well, you may have taken the wrong position.
Well, we'll be happy to file refund claims, but we took the position that it was taxable, and we in fact paid tax on all those things that were in the field.
You may be due a refund.
Well, we'll get there later. But I need to talk about the exempt inventory now. Okay. But I digress. So the Department of Taxation has issued an advisory opinion which looks at a question which I understand in United will be front and center, which is if somebody buys something that they claim is inventory and therefore exempt, but then they put it out for rent, how do we tell whether it's exempt inventory or not? And the Department of Taxation adopts a primary purpose test, which they received from, I believe it was a use tax case called Nevada Cement, which Mr. Bancroft, I believe, argued in front of the Nevada Supreme Court twice.
Yeah.
Yeah. And the primary purpose test is primary doesn't mean only. It just means the primary, which means you could have a secondary purpose. And the primary purpose, and you'll hear in testimony, of purchasing every single piece of CAT equipment is to sell that. And the decision to hold certain equipment as brand spanking new, no hours on the clock, is a business decision. And for those type of pieces, the assessors all agree that is exempt inventory. For the other pieces, it's the business decision of Empire to still sell those. The day they buy them, they want to sell them, but they could also lease them out depending on whether or not there is any appetite in the community for leasing them as opposed to buying them, and for how long you want to lease them. And then it creates a valid business purpose of having a second class of Empire property, CAT equipment that is, and Mr. Cudwell will clarify this if I'm wrong, but CAT is the Cadillac in heavy equipment, and they also compete against Chevrolets, and those Chevrolets are good, but even a used Cadillac is sometimes better than a Chevrolet. So they will in fact have some equipment to do that. There will be testimony today that any piece of equipment sitting in the yard can be bought. Any piece of equipment sitting in the rental fleet can be bought. If anybody makes an offer, it will be sold. The question is how much, and that depends on how used is it. So within 1 to 2 years of buying every single piece of CAT equipment, whether it's sitting in the rental fleet or brand new, it's sold. None of these things are 20 years sitting in the rental fleet. All right. At this point, I'm going to ask some questions for the controller of Empire, and we practice these, but we'll go quickly. This is going to be a shared microphone, so please speak up.
Can you introduce him, please?
I was going to work on that. Could you introduce yourself?
My name is Dale Heising. I'm the controller for Empire Southwest.
You're going to have to speak up, Dale. Well,
More than that. Okay.
all right, more than that, yeah. How long have you been with Empire?
44 years.
I'm not, okay, I haven't been a lawyer that long. What are your duties in your job?
I'm responsible for the accounting and financial reporting for Empire, and that includes submitting both sales tax and property tax reports.
Okay. And so let's skip to Cashman Equipment Company and purchasing that. Can you tell me, were you involved in the purchase of Cashman?
Yes,
What did Cashman do in Nevada?
they were primarily a seller of Caterpillar machines, parts, and providing service, as well as providing machines for rental.
So in Arizona, Empire was the cat dealer, and in Nevada, Cashman was the cat dealer, and you guys bought Cashman?
That's correct.
Okay. And when you bought Cashman, did you retain any of the Cashman employees?
Yes,
Did
most
you-
of them.
Did you retain the employees that handle state and local tax matters?
Yes,
How many people do that?
2 people.
Okay, so after your acquisition, was there a discussion at all about maintaining the same type of reporting that Cashman had done for state and local taxes?
Yes.
What was the result of that?
We continue doing it the way that Cashman had been doing it for years.
When you talk to any of the Cashman employees, have they ever expressed any comments coming from the Nevada, state, or local taxing authorities regarding the way that Cashman complied with state and local tax laws?
My understanding is that it was the traditional method of reporting,
Okay.
that it was accepted by the counties.
Is it accurate to say that Cashman filed declarations in all the counties in Nevada?
Yes,
Okay, and you continue that practice?
yes,
And the same people who did the work are doing it now?
that's correct.
And how long was Cashman in business?
I think 100 years.
Okay. Let's move on. This is the first time then that anybody at the assessor's office in any county has questioned the filing methodology. Is that accurate?
Yes.
All right. What criteria do you use to determine whether or not personal property should be exempt or taxable?
If it's in use as of the assessment date. So in the case of a rental fleet machine, if it's out on rent to any client, then we'll report it and pay tax on that to whichever county the machine is located in.
And I've used the term in the field. Is that the term that you use?
Yes.
Okay. And when you fill out those declarations, what information do you provide to the counties for the stuff that's in the field?
We tell them who our customer is. We tell them about the equipment, of course, and where it's located. The best geographical information we have for where the customer is using it.
Okay. Is this the same method that Cashman used?
Yes.
All right. So how many years did the Cashman people that now work for Empire actually work for Cashman doing this work?
The two people involved, one of them was hired about 3 years ago. The other's been around Cashman and doing this reporting specifically for 20 years.
Okay. On an annual basis, about how much property tax does Empire pay to all the Nevada counties combined for the items that you declare as taxable?
That's a good question.
Well, it says here about $1 million.
$1 million?
There you go.
Okay.
We did this before. Come on. All right. Sorry. How much is the assessment for the 3 counties in this appeal?
Sorry, guys.
Couple 100,000.
It's $1.5 million.
Oh, I'm sorry. I was thinking of the other case.
Yeah.
$1.5 million or $1.7 million. Okay.
It's $1.3 million plus another 150,000 in penalties.
Oh, how thoughtful.
So $1.5 million total.
All right.
We're not going to deal with the taxes. Let's go on with the value.
Okay. Well, the value that's listed, is that where you're going?
No, I just want to deal with valuation. We're not dealing
Okay.
with how much the taxes are. That's all
Okay.
our board can deal with. We don't deal with the.
I was just giving you a
the taxes.
ballpark idea that these are not small potatoes. These are serious people who have lots of operations, who know what the heck they're doing, have done it for 100 years right. And the county's coming now and saying, we'd like $1.5 million more. So that's the point I'm making. All right, let's talk about your rental operations. How many pieces of equipment are within Nevada on a July 1st valuation date?
For 2024, I believe it was 2,700 pieces.
Okay, and on July 1st, is this your primary or slow season?
It's the beginning of the busy season. The busy season runs June through September.
All right, so on July 1st, the stuff that's in the field, is that high range, low range? Where is that?
I think we had 1,400 pieces out on rent on July 1st that we reported.
Okay. When Empire purchases Caterpillar equipment, what is the primary purpose for buying it?
We're buying it to resell it.
Okay. And about how much Caterpillar equipment do you sell in the state of Nevada on an annual basis?
Do I have a number?
You don't, it's a ballpark.
Okay. About $800 million.
So you're buying equipment and within 1 year, you're selling $800 million worth of Caterpillar equipment just within the state of Nevada.
That actually, the number I quoted includes also selling cat parts.
Okay, fair enough.
But yeah, and most everything that we buy is sold within 2 years.
Okay. And so as a result of that, how much of what you buy actually goes into the rental fleet? 20%, 5%?
Probably about 20%.
Okay. So in this case, the 80% that doesn't go into the rental fleet is exempt machinery and equipment held by a retailer ready for sale, and the rest of it sitting in the rental yard. Some of it's in the field being rented on July 1st, and some of it's sitting in the yard not being rented on July 1st. Is that accurate?
Yes.
Okay. Can you tell us what factors go into deciding what will go into the rental fleet?
It's really based on demand or anticipated demand. There are some models that customers prefer to rent, and those would commonly be machines that they wouldn't necessarily use every month all year long, but they have more of a sporadic need for.
Okay.
So we try to have those available.
From a tax compliance standpoint, when you purchase CAT equipment from the manufacturer, do you claim that this equipment is purchased for resale in the regular course of business for sales and use tax purposes?
Yes, it is.
And when you receive rental income from any of your operations, do you report to the state of Nevada sales tax based on your gross receipts from renting activity?
Yes, we do.
And when you sell a piece of Caterpillar equipment, whether brand new or having been in the rental fleet and is now used, you report sales tax to the state of Nevada?
Yes, we do.
Okay. So approximately how much sales tax does Empire pay in a year to the state of Nevada?
Roughly $40 million a year.
Okay. And roughly about $1.3 million in the property taxes as well?
Yes.
Okay. Those are all the questions that I had for him. And so I was gonna just now briefly explain why we think that all the Caterpillar equipment, not the other stuff, but just Caterpillar equipment should be exempt from the property tax. The primary purpose for which it is purchased, one moment, please. Is for sale. This is the same primary purpose that Cashman had when it purchased its equipment. Cashman also leased out its equipment. Cashman and Empire pay the appropriate Nevada sales tax on their sales receipts and their rental receipts. They also paid property tax on items, not enough because the non-cat equipment should have been included, but for the cat equipment, they've paid enough in the property taxes because there is nothing that makes the items in the yard subject to taxation on July 1. It still maintains its character as being exempt inventory. And so our argument is that there may be other organizations that don't have the exclusive dealership for the inventory that they're purchasing and that they will resell it within a year or two. Empire does. And as a result of that, and a result of the historical precedent of what Empire has done, they should include the cat equipment as always being exempt inventory. And then when it's sold, taxes paid on it at that point. I think that's everything I have. I'd like to hear what the counties have to say, and then I had some things to put in reply.
Go ahead. County.
Andy Heiser, Humboldt County Assessor. I think you'll probably hear a little bit different, but all the same stance from all three counties that are present. I'm just going to hit on a couple brief issues that I have, and then if you guys don't mind allowing the other counties to have a say as well. I agree this case ultimately boils down to inventory versus fixed assets. When we did do a TMA audit, my county, prior to the Empire takeover, I had noticed that Cashman was reporting on rent units only. And so I started some dialogue before the takeover happened. But I was made aware of this prior to the Empire takeover. So we started some dialogue with the branch in Winnemucca about, are they claiming all the assets both on rent and in the yard? Some of that dialogue got ended. We never got to finish. I wouldn't get a response. But there was several times where I had asked the appellant to please list all assets like it states in NRS 361-265 for us to obtain that list, and I never received it. That's why we hired TMA. July 1 is the lien date for Nevada. What equipment is in the state of Nevada in the county? I think the blend of the July 1 lien date and the exception to the exemption, the 361-159, it doesn't blend for me. For me, that exception to the exemption is if the equipment is leased, loaned, or otherwise made available. It doesn't give on that date or on July 1. It just says that it's leased, loaned, or made available. Also in that statute in subsection 2, like it was kind of previously discussed with the possessory interest, if the appellant were to get the exemption of inventory and then this exception applied, we would have to tax the lessee or the renter of the equipment, not the appellant. And I don't believe that's what the statute is there for. We did submit a petition for advisory opinion. We respectfully, with the utmost respect, disagree with the case that was used in that is a sales and use tax case. And we just don't see the correlation that it has to assessment in Nevada under Chapter 361. You can look at NRS 372.050, and it does set forth a primary purpose test. And 372.155 is about presumption of taxability, sale for resale, and the intent to purchase. But our office is guided by Chapter 361, not 372. So in conclusion, I'll just wrap it up real quick. There's a couple other Supreme Court cases outside of what the opinion put that I like. Nevada versus Moros in 1988, the Supreme Court ruled that the burden of proof shall be upon the party attacking the same. We have previously held that an agency charged with the duty of administrating an act is impliedly clothed with power to construe it as necessarily precedent to administrative action. I feel the Assessors Association is the agency that is to administer 361. And we feel that by depreciating assets, whether you move these assets into inventory and then depreciate them when they're on rent, that I don't know if that's a normal accounting practice, but we feel that these assets, as they are depreciated, are assets and they should not be exempt. I also want to bring up in 2019, 2021, and 2023, Heavy Equipment Rental Company went before the legislation. They submitted very similar bills. They were all a little bit different each session, but they submitted very similar bills all 3 years. And their bill was to exempt heavy equipment rental equipment, and then they would pay a 2% rental fee on that. I believe legislation's intention was very clear when they denied those bills. Those bills did not go to the floor for a vote. And then in 2025, the same industry came in with the ability to have a 2% rental fee added to their invoices to offset the tax burden, and that passed. Thank you for your time.
Next up from the assessors, anybody else?
Tammy Dickinson, Elko County. Our case diverges from Humboldt County a little bit in that we adopted the opinion cited by the petitioner, the advisory opinion 23-005, even though it would not apply by Empire's own definition. So that decision was made for businesses that were primarily heavy equipment rentals. And Empire made a very compelling argument in front of our board that they are not primarily a rental company, so that advisory opinion would not apply. But because their case rested on it, we took it and applied it to our case. The crux of that case is intent to sell versus intent to lease. There's a few things that would signal that intent. We have to look at the actions around the intent to verify that that truly was their intent. Is the intent to dispose the assets for sale through within the year? Empire testified in front of our county board that they lease equipment out for multiple years. It's their business model to rent the equipment first, to depreciate it down, to make it more marketable in against second-tier dealers. So that would tell me, intent is to lease it and then to sell it. Our research also found that in the acquisition of Cashman, they acquired at least 98 pieces of Cashman's rental fleet. That would tell me at the time of that purchase, they intended to maintain that rental fleet. They assured their customer base in our county that they would still have access to the rental fleet that Cashman had provided to Elko County. Those pieces were reported by Cashman for years. We found another 100 pieces just from curating data across other counties that indicate approximately 200 pieces found in our audit had actually belonged to the Cashman fleet before they came into Empire's possession. We also found that at least 42 of those assets were leased at least one more time after the audit, indicating that not only, they don't meet the definition of sporadic lease, they are regularly leased until they are marketable against those second-tier dealers. The other thing is you look at, do they depreciate the equipment? Empire's testified that they do. It's a sort of out of the box method, but it's from what I understand, it's acceptable. So they are depreciating it. If it were to be held in inventory, they would stop depreciation. There needs to be a formal plan to sell and actively market for sale the equipment. We periodically reviewed the Empire use sell site over the last year, and we found that approximately 15 to 20 pieces of equipment are listed, used equipment is listed for sale in the Elko location at any given time. But in the audit, they discovered 250 pieces of equipment on site. These pieces are marketed as available for rent, but they are not always available for purchase. Without proper documentation from Empire, we were limited to the data that we could curate ourselves, which isn't complete by any stretch. We determined much of the equipment found in the 23-24 audit did not meet the definition of intent to sell. Empire continues to decline to provide any documentation that would allow us to determine if any of the pieces identified met the definition of inventory. They could provide records showing that it was, taken out of the rental fleet and kept to the side. The other thing I would like to touch on just really quickly is that when we retained TMA to audit the heavy equipment companies in our area, it was not because we decided, oh, Empire needs to be audited. We had been seeing a trend over several years that Cashman was diminishing their fleet over time. We were seeing the asset numbers drop over a several year period, which was unusual. I think in their final filing with our county, they reported 147 assets, which was down about 100 pieces from in the past. But they were also at the point of acquisition. So they were acquired in December of 2022. Empire filed in 23-24 with only 54 assets. So when we retained TMA, they looked at the Cashman records and the Empire records, and they found that Cashman was reporting on-site equipment appropriately and adequately, but Empire was not. And I'll just include also, like, the Nevada Constitution guarantees equal and uniform taxation of all property not exempted by law. Favoring Empire's position would violate the principle by creating a special exemption for rental companies who hold property for dual purposes. Businesses using personal property for profit would no longer be taxed on actual use, while others, such as service firms or small businesses, would still bear full personal property tax burdens. Future audits would become effectively toothless, and equipment in the yard could be shielded from tax simply by asserting resale intent, regardless of its primary business use. Businesses would be incentivized to underreport or recharacterize usage to avoid tax liability, resulting in unequal treatment between the compliant and non-compliant taxpayers. And statutorily, the burden of proof rests on the taxpayer. Empire has provided no documentation, so the equipment must be treated as taxable personal property by the assessor's office. The assessor is bound to view all property in the state as taxable unless otherwise exempted, and the taxpayer has to show how it qualifies for that exemption. Our office determined that after vetting the audit findings, they were consistent with Nevada law, Department of Taxation guidance, and best accounting practices. And we could add the escaped property onto the tax roll. And we still have not yet received any documentation from Empire that would show that the equipment qualified as inventory in 23-24 or in 24-25.
Hi, this is Tony Lopez from Washoe County for the record. Honestly, my argument is pretty much going to be what they said. So I'm just going to recap a few things because I really don't want to be a broken record, but I think it is important to voice these things. For us, it was a similar situation. We decided to hire TMA, Tax Management Associates, to audit them. The conversation started coming up about what was inventory versus what was being out on rent and what was being leased. The conversation came up that anything that was on the lot was what was on the lot was no longer on lease, would be considered inventory. I guess the biggest question here, for me anyway, is when it it returns to the lot and they claim that it's inventory, is it readily available to lease again? Because if it is, to me, the designation of asset would be more adequate. If it comes back to the lot and it is available to sell, but also to lease, again, the designation should be an asset. Now, if it's exclusively held for sale, then it's 100% inventory. It's no longer available to lease as an asset and to produce income. So that's one big distinction that I think needs to be made. The other thing is that, at least from my understanding, an asset cannot be inventory. Asset and inventory cannot exist at the same time. It's got to be one or the other. So, really, it's to me the distinction would be: is it exclusively held for sale? Because if it is, then I think that answers that question. But if it's readily available for lease, I think an asset is appropriate. The other thing that I just wanted to bring up was that I completely understand where they're coming from when it comes back to the property. However, some of the information couldn't be ascertained. That would kind of clear this up, kind of to repeat what Tammy said. So if we had that information or additional information to kind of determine what really is inventory, what is an asset, we could clear that up. So we were also not provided that information. Renato was supposed to be on the call from Tax Management Associates. I don't know if he made it or not because I know he had a prior engagement, but I did speak to him. It looks like we were working with limited information. So really it can be ascertained whether it's inventory or an asset. So again, to me, if it's readily available to be leased again, to me, that's an asset.
County representatives? Anything further from the county assessors?
Not at this time. Thank you.
Mr. Sousa?
Hello. Okay, well, Jim Sousa for the record. There's one thing that we didn't hear in the presentation from the counties. Where's your lawyer? I mean, I have 3 counties, 3 district attorneys. This is a legal question. Where's your lawyer? Our briefing that was submitted cites statutes, cites the Constitution, makes a legal argument. Where's your lawyer? So we hear county assessor people, all fine people, none of them trained in the law, telling us what they believe should be subject to tax. We heard if it's exclusively held for sale, therefore it's inventory. Is that in some statute exclusively held for sale? The department tells us that the primary purpose of buying it is to sell it, then it's inventory. That exclusive and primary are not the same. The department's in charge of all the assessor offices. They issue the personal property valuation guidelines. They direct what the assessors are supposed to do. And they were asked for an advisory opinion on a different person than us, and they gave it. And that was the test that they used. I do like when they have cases that they cite, Nevada versus Moros, the burden of proof is on the property owner. We agree. And the property owner has testified today that it buys every piece of Caterpillar equipment for the purpose of reselling it in the regular course of business. Its position is consistent for sales and use tax purposes and for property tax purposes. And it remits $45 million a year, sales, use, and property taxes to the state of Nevada. These are not unsophisticated people. That's a double negative. These are sophisticated people. They know what they're doing, and they did it right. Cashman did it right too. One of the other cases that was cited, I don't think this is Mr. Bancroft case, Sierra Power versus Department of Taxation. As a general rule, tax exemptions are strictly construed. This is from the brief that I believe was submitted by Elko. The caveat that people always miss on this is that ambiguous terms in statutes granting exemptions are in fact strictly construed against the exemption. We have a statute that grants an exemption for merchandise held by a retailer. All the testimony today is exactly the same. For all the Caterpillar equipment, this is merchandise held by a retailer. That'll either be sold new, 80% of the equipment, or it'll be sold for some used hours on it to create a second class of property. There was an accounting issue, which I thought was interesting, and my little CPA brain sort of sprung into action. Mr. Caldwell probably thinks the same thing. Depreciation. The Internal Revenue Code does not allow you to depreciate inventory. So I need to ask my witness the question, do you in fact depreciate Caterpillar equipment that is put in the rental fleet, or do you lower the actual carrying cost of that equipment on your books and records to reflect the fact that you've rented it out and it now has a not new value to it?
Our methodology is that when equipment is rented, a portion of the revenue amount is applied as a reduction in the book value or our net value of the equipment. When CAT equipment is sitting in the yard between rentals, it does not get depreciated. There's no valuation adjustments. It's just the same as inventory.
Right. And so the writing down of the value, is this a recognition of the accounting principle on your balance sheet of carrying something at the lower of cost or market?
Yes.
All right. So I understand the counties are in search of large amounts of money and they hired TMA to go out and shake the trees to see what they could find. But they found it from the wrong people. There are other people that rent equipment that are not the exclusive dealers. And if you're not the exclusive dealer, then you cannot be the people selling this in the state. Caterpillar is very specific about you get one per state. And Empire and Cashman are for Caterpillar. Again, as I started my comments, any other non-Caterpillar equipment, whether sitting in the field or sitting in the yard, should have been subject to tax and declaration. We will work with the assessor's office to get those numbers for them. But for all the Caterpillar equipment that was sitting in the yard on July 1st, this is still exempt inventory and should be treated that way. And therefore, the assessments which were done treating it all as taxable are all in error. What we're looking for from the board is a ruling that says that because we continue to hold this as inventory and our primary purpose is to sell it the day that we buy it, and we do in fact sell it, and we sell it either as new 80% of the time or used 20% of the time, it is still inventory entitled to property exemption, and there's plenty of revenues collected when the sales occur. And this is an $800 million in revenues per year. So there's a lot of tax being collected. Are there any questions from the board? Nope. Sorry.
I know our schedule doesn't permit any testimony on a rebuttal, but I'll allow the assessor's office representatives to present a short rebuttal if necessary. Any further comments from the assessor's office? I think you guys had, I'm sorry, go ahead. I'll allow you to.
Tammy Dickinson for Elko County. First, I would like to say my attorney is at work in Elko County. He reviewed this case prior to us presenting it. He actually gave us the some of the court cases that we should use to justify the positions that we took that sort of solidified the position that taxation is dependent on the use of the equipment, not the intent. Mr. Souza is a lawyer. He knows that intent is incredibly hard to prove in a court of law. What you would do is you would look at the actions and the documentation and the circumstances surrounding intent to see if it measured up. And in this case, we feel very strongly that they purchased Cashman equipment with the intent to maintain Cashman's rental fleet. Cashman Rental did report their equipment adequately as found by the audit. We weren't out shaking a tree. We weren't trying to rustle up some dough. We audited multiple entities in our county, from small businesses to very large ones. We also audited Kubota. That's a big, heavy equipment person. We found many businesses were underreporting or inadequately reporting. We view this as a chance to educate our taxpayers on the proper way to report. We spoke with Empire multiple times about our concern that they were stating the equipment was inventory, but they didn't provide any documentation. Their word isn't good enough as per the statute. They have to provide documentation to say this is inventory. When you get to the United Rentals case, you will see a similar situation. They were asked to provide documentation about which equipment would qualify as inventory, and the documentation was provided. So it's unclear why Empire is not able to provide that to us.
Anything further from the assessors of Washoe County, or Andy, you got anything from Humboldt?
No, Tony Lopez for the record. No, I was just going to say that at this point, I'd be reiterating everything they're saying, and I don't want to sound like a broken record, but we all share the same bit of information and opinion.
See you nodding, Mr. Heitzer, is that correct? You're in agreement?
Yes. In agreement. Nothing more at this time. Thank you.
Questions from members of the board?
Yeah, I've got a few. If something goes out on rent, comes back, so it's out on July 1st, it comes back, and then you rent it out again, is it now part of a rental fleet, or is it still used, held for sale?
So the last
Sorry,
thing.
I'm sorry. Can you repeat that question again?
So let's say a piece of equipment goes out, V6 goes out, it's out on July 1st, it's out for 6 months, comes back, sits there for 5 months, now it's classified as inventory, and then it goes out on rent again. Is it still deemed by Empire to be held for sale?
All CAT equipment is held for sale from the day it's purchased.
Okay.
Period. All equipment is either new or it could be in the rental fleet. Only 20% makes it into the rental fleet. And then while it's in the rental fleet, everything's still available for sale. And now it's used equipment with certain hours on it. And whether it's in the yard or out of the yard, doesn't matter. It's always available for sale. So your example was if it was out in the field on June 30th, came back in on July 1, went back out in July 2nd. We do a picture on July 1. Is it in the yard? If the answer is yes, we're claiming it as exempt inventory. If it's in the field, we're claiming it as taxable. Mr. Bancroft may disagree with that, but that's what we're claiming we're paying taxes on. So that's a distinction that we've made. And Mr. Heising has informed me that that's the same distinction that was made by the people at Cashman. And so the comments about Cashman reported way more equipment than we've reported just isn't accurate. It's the same people doing the same job with the same equipment in the same locations for the same company that's been in business for 100 years.
Okay. Next question is on when you do rent things, I know it's pretty common to apply the rent to the ultimate sales price. Does that count as used when it's finally sold, or is that new? Let's say I rent something from you. This happens in mining all the time. We'll rent something for a year and we'll extend it for another year. And we ultimately say, well, we're just going to buy it. Is that used equipment or is that new equipment?
It's used equipment.
So that's classified as used.
Right.
Okay.
Yeah, once it goes into the rental fleet, it's considered used at that point because we've communicated to Caterpillar that it's sold, even though it's sold to our own rental fleet, and the warranties are started. So at that point, it's considered to be a used
See, and
machine.
I would consider that a new sale to me because that's what you guys are trying to do.
Right.
You want us to rent it so that we will buy it.
Exactly.
So if we get a brand new machine on day one and we rent it for a year or two, then we buy it. That is typically, I mean, that's a very common scenario. So who do you typically sell your used equipment to? Because when I think about Empire, when I think about Kent, I'm not going to you guys for used equipment. I'm going to everybody else who sells used equipment. You guys are not anywhere near, I wouldn't even, until I saw this case, I would have never even thought to ask Cat. To me, Cat sells new stuff. They don't sell used stuff.
Yeah.
So that's something that I'm just curious.
Sure. Yeah. Dale Heisen, the controller for Empire. Will the scenario that you described a minute ago, Mr. Cadwell, we do have customers who they'll lease a machine and request a purchase option. So it's a stipulated agreement up front that they get so much credit against the rentals that they paid and you know, that adjusts the sales price accordingly. But there's other times in the rental fleet, probably most of the time when somebody rents something for a period of time and then returns it without buying it. And that equipment is then sold, you know, it's maybe rented multiple times and then ultimately sold as used equipment. And the equipment is sold in Nevada and in Arizona to different clients. Some of those clients are brokers. Some of that equipment is sold to out-of-state brokers. We also, when we have a need for it, we'll buy used equipment from out of state and bring that in if that's the best way to fulfill a customer's need at the time.
Yeah, because you guys would prefer to sell new equipment, so I don't picture you guys having a whole bunch of, you know, used cars for sale over there. I have never really purchased used from any of the dealers, but in particular, you guys. Why was the D10 T2s, the two of them, specifically mentioned in the Elko County case?
Yeah, those were kind of an unusual. Yeah, those are a couple of high dollar machines. They're like roughly $2 million a piece. And for some reason, they were classified as being in the rental fleet. And they were added to the rental fleet a couple of months before the assessment date. A couple of months later, they were classified back as new inventory and sold as new inventory. And they had never been rented. They'd never had any hours put on them. And my contention is they were just, it was an administrative error, it was a clerical error. And that those two machines should be excluded, I mean, regardless of the decision on anything else, that really was the whole time it was new inventory and it was sold to clients as new inventory.
And I'm guessing you won't know this, but I'm going to ask it anyway. Do you know the average hours on the machines you sell as used? 2,000, 5,000, 10,000, 20?
Probably not the upper end of that range.
Yeah.
But if it's, you know, and it depends on who's renting it and whether, you know, when they rent it for a week, or are they running it for 10 hours or 40 hours or 60 hours? And the amount of time that it sits in the yard, when obviously it's not accruing hours. I would say it's typically between 1,000 and 2,500 hours when it's sold.
Based on that question, what is the useful life of usually one of the big cat? And I want to make sure we're only talking about cat items.
Right.
What is the like maximum hours of life? 10,000, 20,000?
It varies significantly between machines.
Yeah, that's right, Mr. Caldwell. You know, on the high end, I'd say it's probably 25,000 hours before the machines need to be rebuilt. And some of the big haul trucks are an example of that. There's maintenance, expensive maintenance that's done during the course of its life, but the basic unit will last for years, even in a 24/7 operation.
So I just wanted to kind of summarize then what you're saying because of the question you asked. All the CAT equipment that's purchased is ultimately for sale, either brand new 80% or 20% that went through the rental fleet and became used. When we talk about used, we're talking about number of hours being put on it. And those number of hours are like 1,000, 1,500. Does that sound about right before it's finally sold?
Something like that. It depends on what the customer wants, because if the customer is looking for a 500-hour machine, that's what we're going to, you know, try to find, you know, pick out of the fleet to sell to them.
Okay.
If the customer wants the lowest price possible, it'll be an older machine with no hours.
All right, but the machines themselves are lasting upward over 20,000 hours before they have to be rebuilt or more?
I would say the average is maybe more like 8,000 to 10,000 hours.
Okay, all right. So when you answered his question about who do you sell this to, you sell the items that have been through the rental fleet to either individuals who want to buy them, or you sell them to dealers or brokers who will then sell them along with other types of equipment to whoever wants to buy those.
Correct.
And just to reiterate, within 2 years of buying all the CAT equipment, the CAT equipment in your plan is sold to somebody.
Some of it we end up keeping longer. And Cashman had some stuff when we acquired them that was older than that. But the majority of the equipment is run through the process within 2 years.
All right. Thanks.
What percentage of the used is sold to dealers? You know, because to me, when you're selling to dealers or third parties like that, you know, a whole bunch of machines wholesale, that's typically what I would expect a rental company to do as opposed to a dealer who's in the business of selling used equipment. I mean, that's a way, you know, you just sell off 20 pieces of equipment to these guys for $4 million or something like that.
It's the exception to the rule that we'll sell something like through an auction, like a Ritchie Brothers auction. That's pretty rare. The people, the brokers who we're selling to, they've got a customer on the other end who's looking for a machine in Indiana or Michigan or wherever. And it's not at our sale price to them is quite a bit more than what you would expect to get at an auction. It's more of a retail sale, but obviously they need to make some money on it too. Also, I think the majority of the machines are actually sold to other clients of Empire. Maybe not the mines, but the construction companies and other types of users.
Anything further?
Good.
You have any questions?
I do. The purchase from Cashman was the end of 22, which is almost 3 years ago. So what percentage of the equipment you bought from Cashman do you still own?
So I think it's important to get the evaluation date. So one is July 1 of 23, so shortly after, and then the other one is July 1 of 24. So with that caveat, do you have any idea of that answer? Of what's left from Cashman that you bought maybe by January of 24, the later date? Or not January, July 1 of 24?
Yeah, I don't, without researching it, I'm sorry, I didn't prepare for that question.
I guess I'm more curious what you own today because it's been almost 3 years and you're saying everything's sold within 1 to 2 years. So it would make sense that none of it would be left now.
Yeah, I would say the majority of it has been sold and there's been other machines added that have been sold. But there could be some machines still lingering that were originally owned by Cashman. In fact, I'm sure there are some. I just can't give you a percentage without doing some research.
Mr. Bancroft?
I don't have any questions, but I do have some thoughts and observations, but I don't know if you want those now or if you wanted to hear the United Rentals case before we make decisions in these.
Yeah, I'd like to hear the United Rental case.
Yeah, so I can hold off and, or I can go now. It's up to you.
It's up to you.
So would that be, sorry, Mike Demmer for the record. So then would we be going into deliberation or?
Right now?
It would, my understanding is we're still in the question answer
Yes.
format for the hearing.
Yes.
I'm not too sure if what we're discussing right now is more appropriate for deliberation.
Okay. I don't know. It's what Mr. Bancroft has to say.
I can wait if you want to move forward with your United Rentals and you can do questions in United Rentals and do them all at once.
Okay.
Or if you want, I think Mike's correct. My comments are more tended toward deliberation.
Okay. The Washoe County assessor people indicated that several of these pieces of equipment are rented and they're brought back for rental and then you sell them. Is that correct?
Sometimes, or they're ultimately, sir, they're ultimately sold. You know, there could be multiple rentals that occur. Like if there was a machine that was returned in the yard on the assessment date, you know, it could sit around the yard for a week or for 3 months before it's rented to somebody else.
But ultimately it's sold.
Ultimately, at some point in the process, when the right buyer comes along that wants that machine.
So you're not really that much in the rental business, you're in the sale business.
Yes, sir.
Okay,
Yeah, the rental is
Thank
ancillary.
thank you. That will conclude the testimony for, I think it's 127. Yeah, 127 was the first case. So does that include 128, Mr. Sousa?
So you've kind of thrown a new wrinkle in that you want to consider United. So what we'd ask you to do is to hear United, then decide our case along with United's, and then call our next three cases where we will incorporate our same testimony here today into those next three cases and wait for the board to decide those three. So we create a clean record, as I'm sure your council would like us to do. So.
Mr. Mitchell, is that reasonable?
Jeff Mitchell for the record. I believe that's reasonable as long as we don't receive new testimony that would affect any deliberation. So we could open those cases and incorporate the record and then incorporate the decision that we have for those cases.
Okay. So if you don't mind taking a seat, what I want to call 25-153, United Rentals North America, a personal property case with the Clark County Assessor being the respondent. Introductions, please.
David Denman with the Clark County Assessor's Office.
Where's Lisa? Oh, there she is. Okay. Okay. Mr. Mitchell,
Is the respondent on Zoom by chance?
United Rental. Where's United Rental?
If you are appearing on Zoom for United Rental, please raise your hand.
Mr. Mitchell, I don't see anybody here representing United Rentals. Last call, United Rentals. You guys scared them away. Jeez. What do we do, Mr. Mitchell?
With that, I believe it is appropriate to just go ahead and hear the rebuttal from the Clark County Assessor's Office. And there are any questions directed towards them.
Lisa, I hear you back there mumbling. Are you going to come up here and say something, please?
Lisa Loxton with the Clark County District Attorney's Office, County Counsel. When you don't have a petitioner show up, there's nothing to rebut on the record for the county to rebut. So you could just decide the case that, they haven't met their burden as they're not here to present their case. And that would be the request of the District Attorney's Office, as there's nothing to rebut to create a record.
Mike Devner for the record, I believe there's a regulation on point as far as not appearance of the party can go to having them proceed with the case, dismiss the case, and there's a third option that I'm looking up.
Sir, are you representing United Rentals? Oh, I'm sorry, you were out of the room. You just came back. Oh, okay. Mr. Mitchell, what do you suggest here?
Would you be willing to take a quick recess and me and Michael can talk over for a brief minute?
We're in a recess for 5 minutes. You need longer than that? 10 minutes? 5 minutes. Thank you. No.
I'm sorry, if you guys
are talking, we can't hear you. Sure, your mic was not on. I just turned it on for you.
Oh, I'm sorry.
I believe it was case 25-127 that we heard the evidence on
Yes.
and the argument. So I think open up that case, make a decision in that case, and then move forward to the other cases.
Mr. Mitchell.
Thank you, Mr. Chair. Jeff Mitchell for the record. Yes, I believe the best scenario is we'd call case number 25-127. We've received all testimony in that one. We can close the hearing and deliberate and make a decision. I would then incorporate or open 128, 126, and 152 and incorporate all the evidence that's been testified to that one. And then we can make a motion on each one of those and then move forward.
Okay, thank you. That's what we're going to do then. We're in deliberation. Mr. Bancroft,
Would you like my comments?
yes, sir.
Good. I read the materials. I found the preparation for this case was very well done. I found the affidavits of Mr. Helms and Dale very compelling. From a legal perspective, I believe it's the Nevada Department of Taxation that's charged with general supervision and control over the entire revenue system in the state. The relationship between the department and the assessors is made clear under NRS 361.215B, which provides the department, quote, shall continuously supervise assessment procedures and advise county assessors in the application of these procedures, close quote. Advisory opinion number 23-005 dated December 18, 2023 was issued based on the authority and should set forth and sets forth the standard which should guide disposition of these cases. That opinion its conclusion reads, whether personal property held for both sale and for lease is exempt from taxation as personal property held for sale by a merchant under NRS 361.0681A requires a factual inquiry into the taxpayer's primary purpose for purchasing the property. I think based on the evidence, I believe Empire's primary purpose is for the sale of the property, not for rental. It's the exclusive dealer of the CAT equipment. Less than 13% of the revenue is derived from leasing. Sales of CAT equipment and parts constitute almost 70% of their revenue. The CAT rental fleet is a sales tool. It fills short-term needs of existing clients. It enables new clients to test drive the equipment or rent with an option to purchase. And it creates low-hour used equipment that's competitive with second-tier manufacturers. So I think under the standards set forth by the Department of Tax in its advisory opinion, I think Empire's CAT equipment should be treated as exempt under 361 068 1A. Its principal purpose is sale, not rental. There's been a lot of discussion. So that, in my opinion, creates two categories of equipment. CAT equipment, which is purchased with the primary purpose for resale. Allied equipment, which is not purchased for resale. So that's the first distinction. There's been a lot of discussion about NRS 361.159. That statute does not control the disposition in this case. That statute contemplates an owner or lessor in whose hands the personal property is exempt. And a user or lessee who uses the property in a business conducted for profit. The statute authorizes the assessment of a possessory interest tax against the user or the lessee based on the use of the property in a business conducted for profit. It does not authorize assessment of a tax against the owner lessor. In this case, Empire Southwest holds the property for both sale and lease, the CAT equipment for both sale and lease. I believe it's demonstrated that its primary purpose for purchasing the property was to sell it. Property should be treated as exempt from taxation under 361-068, regardless of whether the property is in the field or in the yard. The lessee who rents the equipment from Empire may be assessed a tax on their possessory interest in that equipment. But NRS 361159 does not authorize assessment of possessory interest tax against Empire. So that's my kind of read on the situation, but you're paying the tax, which should be legitimately assessed against your lessees. That might be convenient for you to do from a business perspective. It may be convenient for the assessors, for you to be remitting that tax on equipment in the field. But I don't think it's required. How was that for thoughts? Yeah.
It's a legal argument, I guess. I struggle with once something's being rented, especially once you get to reasonable hours. I mean, I don't look at Empire being a used equipment dealer. You know, so once you hit some hours on the machine, I don't know. It seems like by default it's rental, but it's not a. I do agree Empire is in the business of selling equipment. That's all I've ever thought of them as, equipment and parts. Once you buy the equipment, so you keep buying the parts. It's a good business model. So, but when you hit some hours on a machine, it basically becomes used, and it's not very many hours on these things. The yellow paint wears off very quickly in the dirt. So, but yeah, I mean, your argument makes sense, Paul.
Corey, do you have any comments?
If I understand the testimony correctly, they're currently reporting what is out being rented and paying personal property tax on that equipment. And if I understand what you're saying, Mr. Bancroft, you're suggesting they should not even be paying tax on that. Is that correct?
Yes, that is correct. I believe that the assessors could assess a possessory interest tax on property which is otherwise exempt because they're holding for sale. It's exempt under that inventory exception. They could assess a possessory interest tax against the lessee. So the tax would be due, but it's being paid by the wrong party. This could be convenience for the lessee, could be a convenience for the assessor. So I'm not saying their practice could be discontinued. I'm saying it's not required.
And I think there's a new law that just says now you pass on the 2% to the lessee and a recovery fee. Do you know of that? The
No.
SB 196?
No.
But we have a closed hearing, so we probably can't ask about that then.
I apologize. That would not be a matter of.
I do have one other comment. in the record in case 25-127, the one we're deciding, in the materials, the assessor's office acknowledged that Empire has provided a strong case as to why they are not a rental or leasing company. It then added the caveat, but 361-159 states, but I don't believe 361-159 is controlling in this case. I think that what's controlling is the advisory opinion issued by the Department of Tax and whether or not we conclude that the primary purpose in purchasing the property was for sale or for rental. I don't believe it was for rent. Primary purpose is for sale, so I believe I'd be prepared to make a motion.
Okay, go ahead.
I don't have the numbers available as to the dollar amounts involved, but I'd make a motion that the parties go back and calculate the appropriate tax that would be due based on the treatment of Caterpillar equipment as exempt inventory, regardless of whether it's also leased, also rented. The distinction is between I think all parties agree allied equipment is taxable. The question is whether or not the Caterpillar equipment should be treated as exempt inventory. And the motion is that Caterpillar equipment be treated as exempt inventory, regardless of whether a portion of it is also rented.
Any questions?
We can't hear you up here.
I understand the motion. I'm just not sure. We're gonna send it back so that they go adjust these numbers. Is that, I mean. Right? I mean, so they appealed 17-332-206 to 2101-942, and you're saying they need to take off the stuff that's in the field as well. Or the stuff, yeah, the stuff that's in the field that they're paying tax on. Empire needs to with the county assessor.
Mr. Chair, there's a point of clarification. The stuff that's in the field is reported under a different license number. This is the one that's for the stuff in the yard. This is this license number. So nothing is going to impact the stuff that we've already reported in the field. That's a different license. So Mr. Bancroft's motion is on the license number that's here. All the things that were picked up in the yard. Everything that's not cat has a value and is taxed. Everything that's cat is exempt. Correct?
That's your motion. That's the way I understand it.
Yeah.
Yes, that's it. I'll second the motion. Any other questions, comments? All those in favor indicate by saying aye. Aye.
Aye.
Nays?
Nay.
Aye.
Motion carries. Thank you. That's for 127. So we're going to move on to 128. And the information from 127 has been incorporated into 128. 126 and 152, is that correct, Mr. Mitchell?
That is correct.
So what do we have to do with those cases? I mean,
I would make a motion on 128 separate, and then a motion on 126 separate, and a motion on 152 separate.
Mr. Bancroft, would you like to make a motion on 25, 128?
First, I make a motion that we incorporate everything from the prior hearing. I'll make a motion that we incorporate all the testimony and discussion from case number 25-127 in case 25-128.
I second that motion. All those in favor, please indicate by saying aye.
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 Motion carries. Thank you. The information will be incorporated into 128. Do you have a motion, a further motion on 128, please?
The motion on 128 would be the same as the motion on in case 127, that Caterpillar equipment that the purpose of Empire, that Empire acquired the equipment was for purpose of resale, even though some portion of it may be rented, and that equipment should be treated as exempt inventory.
I'll second that motion. All those in favor, please indicate by saying aye.
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 Anybody opposed?
Nay.
Motion carries. Thank you. That's for 128. We're going to move on then to 126. 126 Empire Southwest LLC. Mr. Mitchell.
Thank you, Mr. Chair. Jeff Mitchell for the record. We will call case number 25-126 under agenda item I. The appropriate action would be to make a motion to incorporate all testimony from 127 and then a motion separately on the decision.
Mr. Chair, I'll make a motion that we incorporate the evidence from case 25-127 into case 25-126.
I'll second the motion. All those in favor, please indicate by saying aye.
Aye.
Aye. Motion carries. Thank you. Next motion.
Mr. Chair, I'd make a motion that the Caterpillar equipment be treated as inventory, even though a portion of it may be at times rented.
I'll second the motion. All those in favor, please indicate by saying aye. Aye.
Aye.
Any nays?
Nay.
Motion carries. Thank you. Let's go 20, that motion carries, and that's for 126. Let's go on to 152. Mr. Mitchell.
Thank you. I'd like to call case number 25-152 under agenda item I. As stated before, an appropriate motion will be to incorporate all testimony from 127 and then a separate motion on the decision.
Mr. Chair, I'd make a motion that we incorporate the evidence and testimony and discussion from case 25-127 into case 25-152.
I'll second. All those in favor, please indicate by saying aye. Aye.
Aye.
Aye.
Aye. Motion carries. Next motion, please.
Mr. Chair, I'd make a motion in case 25-152 that the Caterpillar equipment be treated as exempt inventory, even though a portion of it may be at times rented.
I'll second that motion. All those in favor, please indicate by saying aye.
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 Opposed?
Nay.
Motion carries. Thank you. That'll conclude the Empire Southwest cases. Thank you, Mr. Sousa, and your witness. I want to go ahead and call United Rentals, please. 153.
Thank you. Jeff Mitchell for the record. Under agenda item I, we will call forward case number 25-153. Unless something has changed, the petitioner is not in attendance at this moment. And so the state board has a couple of different options available to it under NAC 361.708. You can proceed with the hearing. You can dismiss the proceeding with or without prejudice, or you can recess the hearing for a period to be set by the state board to enable the party to attend. If you proceed with the hearing, there is not a presence, so there is no testimony to give them from the petitioner. So you'd have to go off what has been presented to you with the materials, and then a presentation from the Clark County.
What's the pleasure of the board?
I suggest we proceed with the hearing.
I agree.
Do we need a motion to that effect? No. No.
I'd-
All right, we're proceeding. Right? Please introduce yourselves again for the record.
David Denman with the Clark County Assessor's Office.
Jason Patchett with the Clark County District Attorney's Office.
Vincent Kelly with the Clark County Assessor's Office.
Okay.
If you would wish, we could have a brief introduction of the property from the Clark County Assessor's Office, and then they can speak to their materials if they wish to do so.
Thank you. Let's do that.
Mr. Chair, real quick, we do have some developments that we've acquired. We'd like to review on that real quick.
I'm sorry, you what?
We have some developments that have come to fruition here. We'd like to address to you and the members of the board in regards to a stipulation.
Vincent Kelly with the Clark County Assessor's Office. The stipulation that was included in the case material, I am currently in contact with Deloitte, the representatives of United Rentals, and they are wishing to sign the stipulation. That's why they're not here. And they requested that I resend it to them, which I have just done. I don't have it in my possession that it's been signed, but they are wanting to take the stipulation that's in here on page 7 of the direct response file.
127,084.
Yes, it is.
024.
Could you explain the stipulation and basis for the reduction?
Yes, so the original amount of 160,100,000 was based on an estimate, right? We did not receive a declaration. Once we did, we worked it out through the hearing or through the appeal process. And so based on what they filed with us, we went ahead and want to reduce to 127,084,024, which is what we would have originally had we had this declaration.
Comments,
How-
questions?
Yeah, how is the estimate off by 33 million? It's a pretty big miss.
So the estimate was placed based on prior year reporting. Okay, so United Rentals is very large. Stuff moves around. Sometimes stuff isn't even going to be in the county from one year to the next, or even in the state. So when they didn't file the declaration that they were required to, I looked at the prior years, just the historical information. I even adjusted for depreciation. And that's where I got the 160,100,000. And then when they did file something over to us, we took a look at it and their inventory had went down. So that's where the 127 is.
Do you see that size of movement from year to year if you look back in 10 years?
So United Rentals is interesting because they recently acquired Ahern. And so because of that, there's a lot of up and a lot of down. But what I did do is look at what they filed and it seemed extremely reasonable. You know, we're talking 16, 20,000 units of various sizes, and it's based on the nature. I feel very confident that the 127 is that's acceptable.
In the materials, their apparent argument concerned idle equipment, or at least that's what they've written in that overassessment as per idle equipment. Do you know of any distinction drawn between or exemption or for idle equipment?
In response to your question, we respectfully declined to provide a response. We're not here to rebut their argument or their presumed argument, right? We have a stipulation on file. Well, it hasn't been signed yet, but it's agreed to orally. We would ask that the board at this time, please consider the stipulation, and if it pleases the board, to make a motion to accept.
Well, but would you respond to my question, please?
As far as,
Idle equipment.
again, I can't speak to the argument. It seems like a valid assumption that that's their argument, but I don't have confidence in what that argument totally is. And I will defer to the assessor's office as to, is that the valid argument? If you have an answer to that question, sure.
I do. So the idle equipment, when they're using the term idle, let's put air quotes around it. They're not using it in terms that we'd expect to see in appraisal or an assessment or even in accounting. They're not saying idle and making calculations and things like that. They're literally saying like a person on the street would. It's not being used. And that's a matter of opinion. What they're saying by idle is not being used by one of their customers.
Well, from the assessor's office, in your assessment of personal property, do you ever consider an idle equipment adjustment?
Again, so in this case, this would not be an adjustment for idle equipment. This would be the same thing as a store closing at 10 o'clock at night and it's shelving sitting there until they open the next day.
Okay. No, yeah.
David Denman with the Clark County Assessor's Office. To consider idle equipment is really difficult in that you need 5 years worth of data so you can get a trend. You have to do the calculation, and then you need an industry average for what is idle equipment. None of that was supplied by the taxpayer, and we couldn't find anything that gave us an industry average. And without their 5 years worth of their financials, couldn't even begin to calculate one. So we're taking the presumption that idle equipment, as far as their rental fleet goes, is downtime for maintenance, to pick it up, to clean it, and to get it back out, because they didn't give us anything else.
Possibly repair parts of it, of the equipment that may be a bit damaged during the rental.
Correct.
Thank you.
May I make a motion?
So hopefully somebody will. Let's go.
I'll make a motion that we reduce the value to the value proposed by the assessor's office. I believe it's 127,084,024 dollars.
Yes, that's right. 127,084,024. I'll second that motion. All those in favor, please cast your votes.
Aye.
Aye, 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 aye. Your aye on your own motion, Mr. Bancroft.
Yes.
Thank you.
Aye.
Motion carries. Thank you. Next item is 155, Eagle Shadow Mountain Solar. I'll call you up to get introduced.
And I'll put my announcement on record.
Introductions, please.
Good afternoon. My name is Josh Hicks. I'm an attorney with McDonald Carano, and I'm representing the appellant. And with me is Justin Johnson, who is the Chief Operating Officer for the appellant.
Nice to meet you, Mr. Hicks. Thank you.
Jason Priebe with the Clark County Assessor's Office.
And Lisa Loxton with the Clark County District Attorney's Office.
Let's just go into a description of what this case is all about, and then we're going to take a lunch break, okay?
Before we do, can I just put on the record that my firm, McDonald Carano, is representing the petitioner in this case. So I will not be participating in the vote in this matter.
But you will be able to ask questions and discuss issues. You just will not take a motion or vote on that motion.
I won't advocate.
Won't advocate for your client.
Correct.
Or your-
Or vote in the final decision.
Mike Devitt, for the record, that is correct. If you under interest, 2818.420 something.
Okay.
Correct. Member Bancroft, I believe, yes.
Let's just have a description of what's going on here. Is that going to be from the assessor's office? Yeah, you guys are up. Come on, let's go.
Jason Priebe, the Clark County Assessor's Office. Case 25-155 is for the assessor's account number 229299. It is an appeal concerning the personal property assessment of Eagle Shadow Mountain Solar for 3 fiscal years, 22-23, 23-24, and 24-25. These prior years were assessed due to the appellant's failure to file per NRS 361.767 subsection 3. Eagle Shadow Mountain Solar is a utility-scale photovoltaic power plant located on the Moapa Band of Paiutes tribal land within the Moapa Indian Reservation. A locational aerial view can be referenced on page 111.
So you're in 25-155 Eagle Shadow Mountain, that 613 page document?
Yes,
And what page did you refer us to?
111, please. The facility occupies approximately 2,098.27 acres, situated about 30 miles northeast of Las Vegas, and has a nameplate capacity of 300 megawatt and operates under a long-term purchase power agreement with Nevada Energy. The assessor recommends holding the value of $321,558,864 for the fiscal year 24-25, $283,854,690 for the fiscal year 23-24, $291,527,100 for the fiscal year 22-23.
Mr. Hicks, just some introductions and what your case is, what the issues are, and then we're going to take a break, okay?
Sure thing, Mr. Chair. Thank you. Josh Hicks for the record. I'll just to give a little bit more context and then just kind of frame this up for when we come back. You heard this is a 2,300 acre project called Eagle Shadow Mountain. It's actually on land that is owned by the United States, and it's held in trust for the Moapa Band of Paiutes. And I do also want to note that the Moapa Band submitted a letter, which is in your materials. And the chairman of the band is actually online as well. And I know he would probably appreciate the chance to make some comments at some point when it's appropriate in this matter as well. Now, just to give you a sense of the scale of this project, I tried to think of how you could look at it in terms of something else. And if you look at Allegiant Stadium, which we're all familiar with, and the parking lots around it, where the football field comes out, that's just under 60 acres. So you're almost thinking about 40 Allegiant stadiums is the footprint of this site. It's a massive site. And there are pictures of it, as well as the aerial overview that you saw. There are pictures of the site that we've included in Exhibit B. Just a couple other things just to discuss some context of this. This facility is owned and operated by the appellant. Like I said, it's on land that's tribal, United States land held in trust for the tribe. There's a 50-year lease that Eagle Shadow Mountain has with the Moapa Band of Paiutes to operate this facility. In addition to that, power from this facility is sold to NV Energy pursuant to a power purchase agreement, which is sometimes called a PPA. That's 25 years. Both those parties, the Moapa Band and NV Energy, have independent rights to acquire the project at different timeframes. So you'll hear some more about that later, but I just wanted to point that out. This was a pretty massive construction project, 34 months of construction to build it, $460 million. So a very large, very massive project. It consists of a variety of different components that you'll hear some more about, but that all operate together to do what the project is designed to do, which is put power on the grid. So you've got modules, you've got trackers that collect the energy, you've got wiring, you've got inverters that it runs through, and it eventually goes to a substation, and then it goes up onto the power grid from there. So none of those work independently by themselves, but together as a unit, they do work and provide power, and that's the whole purpose and goal, and actually the only use allowed under the lease. But that, I'll stop there if we want to take a break. But I will say the issue, really the only issue in this case, is because of the location of this project. Being on land held by the United States and held in trust for the Moapa Band, is that subject to property tax? And our position is that it is not, that this is a question of federal law, not a question of state law. And the federal law is clear on this for multiple reasons, that it is exempt per se because of the nature of the improvements. And even if the improvements were not considered permanent, which is a question of federal law, not state law, that there's a balance of interest test that weighs strongly in favor against taxation. So those will be the issues we'll be discussing when we are ready to go.
Lisa, do you have a comment on that? Just what the basic issue is?
Yeah, I mean, I think the basic issue is whether or not these are taxable under federal law. I think Mr. Hicks framed the issue correctly. So, I mean, I think this case is mostly a legal argument.
Great.
And before we do that, we do have some other procedural legal briefing that was filed. We have a pending counter motions to strike different, if you want to take, care of that before we get started with the case materials to make sure we have a clean record.
No, I called on you because Mr. Hicks has stated that, the whole issue here is who owns the land? And it's the federal government in trust for the Indians, which right in the first sentence of two of those paragraphs I'm reading, it's non-taxable. I'm just wondering why the county thinks Indian land is taxable.
Because when it is used by a non-Indian tribe, by a non-Indian entity, it can be taxable under federal law. And there's various case law across the country on that. And so when it is purely owned and operated by a non-tribal entity, it can be taxable based on an analysis. And that would be our argument based on the federal case law and the fact that this is ad valorem taxes in this situation. It's different than a lot of the case law that is out there on tribal land, but that we believe it's clear under federal law that this is taxable land. And we have, we'll put that on our case, but there's other situations where we tax property on tribal law, on tribal land.
Okay, so let's just try and, when we come back, stick to those two issues. I don't want to get off on another wild tangent, go down a rabbit hole. Yeah, I know this is a very complicated case. We have our esteemed counsel abstaining, and we have the three of us, and we have guidance from the state. So we'll be back in how long? What's convenient for the staff? Half hour, 2 hours? Where are we going for lunch? Half hour, 45 minutes?
I say we reconvene at 1 p.m.
1 p.m. Thank you very much. We'll see you back at 1 o'clock. We're back in session. This is the State Board of Equalization hearing. It's a continuation from this morning's agenda. We are on case 155. Mr. Mitchell?
Thank you, Mr. Chair. Jeff Mitchell for the record. As mentioned, we have called case number 25-155, and we've had a brief introduction of the properties. Before we get into the presentation and rebuttals, we do have a motion to strike information that is within the record, as well as a response to that motion to strike that I believe that we need to take under consideration and make a motion on first, just so that we have a complete and accurate record. And so the original motion to strike was filed by Clark County, and I believe it would be appropriate to hear why that was filed and then turn it over to Mr. Hicks to respond.
Is that okay? Good, because that's what we're going to do. Go ahead, Lisa.
Lisa Logston for the Clark County Assessor's Office with the Clark County District Attorney's Office. So on September 19th, 2025, on a Friday, Clark County received a response brief that was filed by the petitioner in response pursuant to NAC 361-703. But in this case, there was never any initial first brief filed. And so NAC 361-703 allows either party 20 days before the state board hearing to file a brief with the state board. In this case, the assessor's office filed their case materials in accordance with NAC 361, I believe it's 745, 15 days before this hearing. Included in their case materials was a district attorney opinion that was granted to the assessor's office. They chose to include that in their case materials, and pursuant to NRS 252-160, the DA's office is required to give his or her legal opinion to any county assessor regarding matters of duties of their offices. So the district attorney's office issued a DA opinion related to this case, but the district attorney's office did not submit a brief to the state board in which the petitioner filed its response to. So that's why the county filed its motion to strike, because the response was not timely because there was never anything to respond to. So that's why we filed the motion to strike. But in the alternative, we also answered the brief that was filed by the petitioner's office. So we just ask that this board either strike all of the filings or accept everything that has been filed.
Mr. Hicks?
Thank you, Mr. Chair. Josh Hicks for the record. I'll admit I was a bit mystified when the motion to strike came in because NAC 361-703 very clearly states that anyone, either party, can file a brief memorandum or other written explanation. That's the terminology used. And if that is done, the other party gets a chance to respond to that 10 days before the hearing. So when we first saw the September 8th letter from the district attorney, that provided a legal analysis with respect to their position. That to me is unquestionably a brief memorandum or other explanation. I'm not sure what else it could possibly be, which triggers the 10-day period to respond. So that is exactly what we did. We prepared a response to that brief memorandum or written explanation. We filed it timely on September 19th. And then we got this motion to strike, which, like I said, I didn't really understand it. If the county's position is right, actually a taxpayer would have no chance to respond to any kind of brief put on the record by the county. So it didn't really make much sense to me. So I thought it was a very simple analysis. We responded to their legal analysis and we filed it timely.
Mr. Mitchell?
Thank you, Mr. Chair. I believe it is appropriate either to accept a motion to accept the material and all materials within the record, or to accept the motion to strike, and we would remove that specific information, which may take a little bit of time because it's referenced different letters within there.
Their packet of information.
Yes.
Questions or comments from the board? No. What do you want to do?
I'll make a motion to accept all information included in the file.
I second the motion. All those in favor indicate by saying aye.
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 Motion carries. And Mr. Bancroft abstained. Thank you. Let the record reflect that. So thank you. Who's next? What do we do, Jeff?
Thank you, Mr. Chair. Now it's appropriate to go to the normal proceedings and procedures on hearing the petitioner and then the respondent and then back to the petitioner. Petitioner.
Go ahead, Mr. Hicks.
Thank you, Mr. Chair, members of the board. For the record, Josh Hicks, representing the appellant, a petitioner. And I'll refer to the appellant or petitioner as interchangeably and throughout this. Again, you've already heard an overview of this case, and there's really one issue in this case, which is a legal issue. And that is whether the county can impose the property tax on this project, a solar project located on land owned by the United States and held in trust for the Moapa Band of Paiutes. Because it is on United States land, it's a federal issue. So this is controlled by federal law, and I believe the county agrees with that proposition. This turns ultimately on the supremacy clause of the United States Constitution, as well as a variety of cases and regulations that have interpreted the application of that clause. Now, today is not the first time this issue has come up. This is not a new issue, especially in the Ninth Circuit where we sit here in Nevada. This issue came up, and really the case that's on point is called the Chihalas case. That's from 2013. That's cited in our letters. The county, I believe, included a whole copy of the case as well. But in that case, the Ninth Circuit, and again, that's the controlling precedent here, held that the county could not impose a property tax on what in that case was a hotel, water park, and convention center that was located on federal land held in trust for the tribe. And a very important part of that case is that the court held that ownership of those improvements does not matter. In fact, they use the word irrelevant. So you're going to hear some distinctions that I'm sure the county will try to draw to say, well, this project, the Eagle Shadow Mountain, the facility itself is owned by the appellant. But that does not matter in the Ninth Circuit. Ownership does not matter. And in fact, the state of Nevada has agreed with that. And the state of Nevada, as you know, has general supervisory control over the tax system in this state. They also have the ability to issue guidance to assessors. And they did that in 2014, pursuant to their power under 362.15. They provided guidance directed to the assessors. And that's guidance letter 14-001. And I just want to quote.
Where would that be on your pages here? I got 613 pages in one of these things.
That is exhibit, I believe. It's exhibit V, and I believe it was in the county materials as well.
Okay, so I'm sorry to interrupt you, sir, but there was also some items that you wanted that were more confidential.
Correct. That's not one of them.
Okay. Are they in the packet now?
They have all been submitted to the board, and how they've been made available to you by the staff, I'm not sure.
I think that you separated those, right? So we do have them. So if you're going to refer to those, then we're going to have to close the hearing, I guess, and discuss confidential information.
Well, but Mr. Chair, I think we're comfortable referring to some of those in general. If we're going to get into some of the specific details in them, then I think we could flag that at the time. But as far as our presentation goes, we're comfortable referencing them, and we don't think that waives anything.
Any objection?
I don't have any objection, but I think we'll just have to take lead from council because I guess the county doesn't know what they want to retain privilege to and not, so we can cross that bridge when we get there.
Nobody told you that?
Mr. Chair, just to be clear, we have no objection discussing them. We've referenced them in our letters. Our letters are on the record. It was really just, we didn't want the documents themselves out there for public availability.
Well, you had a lot of it blacked out, though. I mean, anyway, go ahead. I'm sorry.
Before you go, you mentioned the guidance letter. Which exhibit is that?
Exhibit V as in Victor.
Hold on until we find it here.
You have a page number for it?
It did not, I don't believe it had a page number. It just was an exhibit V. And it was on the website, at least as of last week.
I believe it was included in their September 19th brief.
Okay. No, that's the team. Let's see. Oh.
Remember the good old days with paper?
Mr. Chair, we do have one copy of it in paper. We'd be happy to send it around if you'd like to see it.
It makes a difference. It's on the website. And I found that I can email it to the board.
Oh, okay. Where is it on their website there?
Scroll down.
155.
So see, is it, what's that? You said V, correct, council?
Oh, no, no, no.
V,
S in Victor?
yes.
V? Okay, I'll just re-download it. Yes, you gave me that, thanks. Okay, so this is what I have is a guidance letter, 3-page letter.
Yes, that's correct.
Oh, this one from Terry, okay. Yeah, okay, everyone's seen that. All right. Everybody find it?
Yes.
First?
No.
We all have it.
Go ahead, Mr. Hicks. Okay, thank you, Mr. Chairman. So one thing you'll note on that letter, and again, that is submitted, that was directed to the county assessors pursuant to 36215. And it was submitted shortly after the Chihalas decision, which I was talking about, the 2013 Ninth Circuit decision regarding improvements on tribal land. And there's a sentence on there that's important because it addresses the ownership issue. It says, and I'm going to quote it, quote, based on the rulings of the federal courts and federal regulation, real property such as buildings and improvements located on lands held in trust by the United States government for an Indian tribe is not taxable property, even when owned by a person or entity other than the tribe, end quote. So that's the guidance that has gone out since the Ninth Circuit ruled in 2013. That's what was sent out by the state with the supervisory control to all the assessors. That case, that Chihalas case, is still good law. That guidance is still issued. It's readily available on the department's website. And that's what our client has been following throughout this process. So the salient question really before you is whether this is a permanent improvement located on United States land held in trust by the tribe. And there's no question it is on United States land held in trust by the tribe. So the question is permanent improvement or not. And that is a federal law test. So I just want to make clear that that's a little bit different than what you sometimes hear when you're hearing what does state law say about permanent versus personal. So it's a federal law test. That's what controls. And the way the state treats an improvement is not pertinent. And that's one of the other holdings of the Chihalas case. So the way that the state or the way that the federal government and the federal courts look at this is they apply a 6-factor test. And we've outlined that in detail in our letter dated September 9th. And in specifically pages 5 to 17 of that letter. So over 12 pages, we went into that in detail. And I know but here, I'm not going to go through all of that verbally, but it is in writing. And Mr. Johnson, seated to my right here as well, can speak to any of that as well. And in fact, on rebuttal, I may call him to answer a few questions on that. And he's, of course, well, if any of the board members have questions, he can answer it. But I do want to just kind of briefly go over those factors and how the federal courts look at this. So one of the questions, the first question, is how is the project affixed to the land? And in this case, and again, we've discussed this in our letter, but this was again a massive project, 34 months to build it, $460 million, and it includes a series of what are called module trackers. Those are the systems on which the solar panels are actually mounted. There's a picture of all of those in Exhibit B in our materials if you wanted to see what they look like. There are 10,618 of those tracker units at the project. And all of those are affixed into the ground through one of two ways. They're either through earth trusses or through driven piles. Those are two different styles of affixing solar panels, the mounting systems into the ground. There are 83,304 earth trusses at the site. Each of those weighs about 60 pounds. There are 38,061 driven piles, each of those weighing between 60 and 186 pounds. So you can see why it took so long and cost so much to build this project over 3 years. And installing those, just the tracking systems themselves, was around $140 million and almost a year, over 10 months to put those into place, not including all the grading and earthwork that had to happen as well. And earth trusses, and Mr. Johnson goes into this in detail in his affidavit, which is Exhibit M to our materials. He goes into this in detail about the earth trusses are unique in the solar world. That's not the usual technology used to affix solar panels to the ground. And a lot of that is because of the unique geological conditions at the Eagle Shadow Mountain site. The ground is extremely hard The caliche there actually acts like almost like bedrock or cement, and it requires significant work, including these earth trusses, to affix these module trackers into the ground. Once they're affixed in there, removing them is very complicated. It's very difficult. It essentially requires cutting those posts and trusses off at grade because the way you can't just pull them out of the ground without damaging them. So it renders the property itself really unusable once it's taken out. And again, Mr. Johnson can speak to that if you have specific questions about it. We've tried to detail it in our letter. The substation itself is another major component of this project. And again, like I'd said in opening remarks, all of these pieces work together. Nothing has really any function if it's just done by itself. But the substation is the point where the power comes in and goes up onto the grid and out into the world. That itself was a major undertaking. $15 million, not including the grading and earthwork, 6 months to build it. It's built on a deep concrete foundation, 8 to 13 feet deep. It includes transformers, and these are major pieces of electrical equipment, each weighing over 50,000 pounds. There's control structures, breakers, switching, backup generators, and steel structures to support all the overhead lines that run out of the substation. And there's pictures of the substation in your Exhibit B as well, if you wanted to see that. And just like the module trackers, removing a substation is not simple. It's not easy. It takes a significant amount of time and money, and it effectively destroys the components when you take them out of there. So the level of fixation of the ground for that test is significant. Another test factor in the test is the property designed to remain permanently in place? And you've heard about how this property is affixed, how difficult it is to remove it. But it's also important to look at some of the relationships between appellant and other parties here. There is a lease between the appellant and the Moapa Band of Paiutes. That's a 50-year lease. That lease expressly treats the solar project as a permanent improvement. And it includes an option for the Moapa Band to keep those improvements past 50 years. And there is a very good likelihood that this project may well continue on and could continue on after 50 years. Mr. Johnson can speak to some of that as well. The lease also precludes the site from being used for anything other than a power generation facility. So again, this isn't a situation where the appellant could simply pick up, move its stuff out of there and use the property for something else. That is a lease condition. Now, I mentioned also there's a second party, that's NV Energy, and Eagle Shadow Mountain, the appellant, has a 25-year power purchase agreement with NV Energy. NV Energy at the end of that 25 years has the right to acquire the property as well. So you can see that the idea that this project is going to produce power for a very significant, permanent, and long-term period of time is out there because you've got multiple parties who have negotiated rights to acquire the property at various times. So with that said, that second factor, is it designed to remain permanently in place? The facts absolutely show that that is the case. Another factor under the federal test is how substantial and time consuming would it be to remove the property? Now, even assuming that they wanted to go remove it, the removal process is not just show up, unscrew some bolts and take it out of there. There is a conceptual decommissioning plan that has to be followed. That process takes well over a year. It requires bonding. It requires compliance with federal regulatory oversight, and it will cost millions and millions of dollars to do that. Perhaps more importantly, removing this project and the pieces to it essentially destroys them. It renders them unusable. These aren't pieces that are going to be able to be shipped off to another solar project. And again, Mr. Johnson gets into detail on that in his affidavit in Exhibit M. A fourth factor is, can the property be moved, and has it in fact been moved? The answer to that is no. It has not been moved. It's never been moved, and it's not going to be moved. Not only because of the time and expense to do it, but because moving that project would result in a breach of the lease, and it would result in a breach of the power purchase agreement. So there is no reason to do that. There's no practical reason to do it. And the project would essentially be destroyed and not usable anywhere else. Fifth factor, how much damage would the property sustain upon removal? That would be complete and total damage. The module tracker systems, like I mentioned before, they get cut at grade. They're not usable again. They're destroyed. The panels are not compatible with other facilities. The voltages don't match up, and the substation will be destroyed. And again, there's a lot more detail in our letter and in Exhibit M. Sixth factor, are there circumstances showing the expected or intended length of a fixation? So like I was just talking about, we have a 50-year lease with the Moapa Band of Paiutes. There's a 25-year power purchase agreement, multiple rights to acquire the property. Additionally, there's all the treatment in the lease and the tribal agreement about these being permanent improvements to the property. So there are
5 minutes left.
Okay, thank you. I'll go fast. I appreciate that. And I also want to note, Mr. Chairman, I know the Chairman Reel would really much like to speak. I'd be happy to give him some of my time, or I can try to get through my next few minutes.
Sorry, what did you say?
The chairman of the Moapa Band of Paiutes
Oh,
would like to
he's
speak.
on Zoom?
He's on
Was
Zoom.
he sworn in?
I don't know if he's been sworn in or not.
All right, before he testifies, if he is going to testify, we'll make sure he's sworn in. All the rest of your party has that's going to testify.
Mr. Johnson has not been sworn in, but before he speaks, we can swear him in.
Thank you, Mr. Hager. Go ahead.
Thank you, Mr. Chair. I'll try to move quickly through the rest of my remarks.
Well, I realized part of that was delayed because we were stumbling and bumbling through our computers trying to find those documents. So we can add a couple of minutes on here.
Okay, I appreciate that. Thank you very much. So with that said, those are the 6 factors under the federal test. All 6 factors weigh in favor of this being a permanent improvement. Assuming that the board agrees that this is a permanent improvement, that's the end of the discussion, because under Chehalis and under the state's guidance, it is exempt. Ownership does not matter. It is exempt, and there's no property tax on it. Now, I do want to note that the State Office of Energy has taken the same position. When this project started in 2019 and the renewable energy tax abatement was applied for, there was email correspondence between the Office of Energy and ESM, actually through me, because I was counsel for them at the time, directly stating that this project would be exempt from property tax. And that's been included in your packet as Exhibit I. So not only do we have the Ninth Circuit saying it's exempt, we have the state saying it's exempt, the State Department of Taxation, excuse me, saying it's exempt, but we also have the State Office of Energy in the renewable energy context saying it's exempt. And I also want to note, even though this is an issue of federal law, the state of Nevada, when analyzing these projects outside of tribal land, has also interpreted them as real property improvements. So that is evident from the fiscal notes that have been submitted on various renewable energy projects over the past decade plus. And we've concluded all of those in the record as well. And to note, 43 times the state of Nevada has been asked, and most recently is in April of 2025 this year, they have been asked, is this personal property or is this real property? And they have come down every single time and said it's real property because it all operates as a single unit and everything's necessary to accomplish the goal of producing power. So that, I think, is helpful as well to show not only do the federal courts look at it as permanent improvement, but the state of Nevada with its supervisory control does as well. Now you're going to hear, I'm sure, you heard when we were talking about the motions to strike, there was an issue about the county's legal letter. And what became apparent from their legal letter is they're really hanging their hat on a case out of Arizona. And that Arizona case held that a solar project was subject to property tax in that state. But that case is not appropriate, not applicable here for a couple reasons. One, it's a state court case out of Arizona. It's not a Nevada case, and it's not a Ninth Circuit case. Second, and probably really important, and importantly for you to keep in mind, in that case, the project owner had to remove the project at the end of the lease. There were no other options. It was lease is over, clear the land off. That's not the case here. We've got multiple parties who have the ability and right to own the project and operate it after 50 years. So one final comment I'd like to note, we've noted this in our letter too. Assuming that this project is not a permanent improvement for federal law, that's not the end of the analysis. There is a further discussion called the Bracker analysis. And this comes from a United States Supreme Court case that held there are restrictions on any state or county efforts to tax activity by a non-tribal entity occurring on tribal land. And that's a balance of interest tests. So assuming you hold that these are not permanent improvements, you still have to look at the Bracker test and how does the balance of interest fall? And that means you have to weigh the interests of the federal government and the Moapa Band against the interests of the county. And the interests of the federal government and the interests of the Moapa Band are extremely strong here. Those are interests of tribal sovereignty. Those are interests of tribal economic development and tribal well-being. This land, the Moapa Band land, is remote. It's largely vacant. And the Moapa Band, realizing that, has engaged in economic development on it, to their credit. That's exactly the kind of federal and tribal interest that is supported under the Bracker test. When you look at what the county's interests are, to date, I really haven't seen any county interest that seems appropriate. Those interests can't just be, there's money on the table and we want to get it. Courts have rejected that as an interest. The interest has to be narrowly tailored. It has to be a county interest that is tied to the activities occurring on the land. So it has to be county interests that are tied to the operation of a solar facility. So that doesn't mean some of the kids who belong to the tribe are going to county schools. It means they have to be tied to the project, and that has not been demonstrated at all by the county. So we have strong federal and tribal interests. We have weak county interests. So the balance of interest test falls on the side of immunity from taxation. With that, Mr. Chair, I would love to see if you feel it's appropriate, if the chair of the Moapa Band wanted to make any comments, I would certainly welcome that. And then I'd be happy to stand for questions or make further remarks on rebuttal.
Okay, do you want to speak as part of your case?
Mr. Chair, he's not there. They've submitted a letter and I know our interests are aligned. They're not a party to the case, but I think that this would probably be an appropriate time to do it because, like I said, our interests are aligned on this, and he could speak very well to the tribal interests here on this project.
Lisa, you have objection to that?
No, I don't have an objection.
If he wants to speak, let's get him sworn in. Hey, Sarah, swear in Mr. God at the same time.
This is Mike Dedman for the record. Do we know if he is on the line?
We made him a panelist.
Hello. Good afternoon. My name is Ivan Rail. I'm the chairman of the Moapa Youths.
Oh. Good morning, sir. And sir, you're testifying as well. If you both could please stand and raise your right hand. Do you hereby swear or affirm to tell the truth, the whole truth, and nothing but the truth?
I do.
Thank you both.
Thank you. Anybody else here that is sworn in that's going to testify? Nothing missed it. Let's go. Go ahead, sir.
Hello, good afternoon. The tribe is in alignment with the rebond on this project and for the Eagle Shadow Mountain project. The tribe did not enter these agreements lightly with not to disturb our tribal lands and our federal lands and the lands that we hold sacred. We would not put a project like this if it was not meant to stay here and work in our tribal best interest. I think that the argument comes down to is if the county recognizes us as a federal agency and a government, who has the right to govern and who has the right to tax? The tribe has taken the initiative that we are in charge of this project. We have governed this project from the very beginning, from the leasing to the negotiations to the current operation. Nobody can enter this project without my signature. And so for the county to come in and essentially try to double tax our company and our partner here it comes across as they don't fully recognize us as a government entity that has the right to self-govern. And we're willing to support Arriva on this project for the foreseeable future, as far as this is willing to go. And that's as much as I'm willing to say, unless you guys have any questions for me.
Any question from the board members? Go ahead, Ms. Fix. Next.
Thank you, Mr. Chairman. I would like to just,
Yes, sir. Thank you, Mr. Chairman.
Thank you.
I'd like to build off of one thing that Chairman Wheel mentioned. He talked about double tax. And that's important for this board to recognize, because although our position as appellant is that property tax is not owed, that doesn't mean that there aren't property tax equivalents being paid here. And Eagle Shadow Mountain pays pilot payments. That's a payment in lieu of tax. They pay pilot payments to the tribe. And we've noted that in our letter. That is a very significant amount. It's approximately $26 million over the course of the lease. That's not including the lease payments. That's just the pilot payments. So there's a significant amount of money going to the tribe. And it's also worth noting too, and we've mentioned this in our letters, that if the county prevails in imposing the property tax here, that imposition of tax operates as a cap on the pilot payments. And it effectively makes those pilot payments go away. So it would be a transfer that there's essentially a property tax being paid by Eagle Shadow Mountain to the tribe. But if that property tax gets transferred and paid to the county, it's no longer paid to the tribe. So that's an important economic damage. And I just wanted to make sure that I added a little color onto Chairman Reel's comment about double tax, because that's what that means.
Thank you for that. Anything further? You can have Mr. Johnson testify to anything.
Yeah, if I could just ask Mr. Johnson a couple of questions, I think that might be helpful. I'll make it brief.
Minutes.
I'll be brief.
Came all this way this morning. You gotta say something.
Yeah, you've been sitting up here patiently, so I'd like to at least ask you something. So, Mr. Johnson, could you just state your title with the appellant, just for the record?
Again, Justin Johnson, I'm the Chief Operating Officer for Arriva Energy. We own and operate Eagle Shadow Mountain. In my role, I'm responsible for all the engineering, procurement, construction, and then the asset management and operations activities. We own over 6,000 megawatts of solar plants all around the US, and we own them for the life of the asset. We're the long-term owner.
Thank you, Mr. Johnson. I know we talked a little bit about your affidavit. I think in the interest of time, I'm not going to go through question by question, but I did have one question for you, because I'm hoping you can give the board some context about how long Eagle Shadow Mountain could potentially last and continue producing energy.
Yes, if you look at the materials that Eagle Shadow Mountain is built with, so Josh described the trusses and the piles and the tracker structures. It's the same galvanized steel equipment. But if you take a drive over to Hoover Dam and look at the substations and the power lines constructed there that have been there in many cases for 90 years, it's the exact same stuff. So all the structures in the substation and the tracker arrays and the solar arrays, it's built of the same materials and built to last. There are certainly components that will fail, just as you would have in a car or in a building or something, and you will replace over the course of business. But like that essential foundation, the concrete, the steel, is meant to last conceivably for forever, for as long as something like you would see at the Hoover Dam.
Thank you. I think in the interest of time, I'll hold off on our time to potentially ask some more questions in rebuttal of Mr. Johnson.
Okay, Lisa.
Thank you. Lisa Logston for the record. Here, the assessor's office has relied on a DA opinion that is found on pages 54 through 63 of the Eagle Shadow Mountain PDF exhibit. Here, the solar facilities are owned and operated by the petitioner, and they're subject to Nevada's ad valorem taxes as they're not preempted by federal law. Federal preemption for taxation on tribal lands is not a one-size-fits-all, especially when dealing with the taxation of property owned by non-Indian entities. First, I'd like to address the Chilias decision. As the petitioner has stated, the Ninth Circuit in 2013 issued a decision with respect to a Great Wolf Lodge that was being built. And in that Great Wolf Lodge, the tribe decided to create a separate LLC, in which they owned 51% of. And so in that decision, the court said, it's irrelevant or unimportant on how the tribe holds its ownership interest in the business, but the tribe still holds an ownership interest in the business. Unlike in this situation, where the petitioner holds all of the improvements and the tribe does not hold any ownership interest in the petitioner's business. So the Chilias decision is different in that sense. And I think that leads into the guidance letter issued by the Department of Taxation, that while they make a blanket statement that this includes property owned by third parties unrelated to an Indian tribe, you have to still look at the facts of that federal court decision. And in that federal court decision, and also in other federal court decisions, the tribe has an interest in whatever improvements that they're owning in order for it to be tax exempt. So, and then I think if you look at the guidance letter, that part that was not read also states a statement that says personal property owned by unrelated third parties and located on trust lands, however, may continue to be considered taxable property by the state and its subdivisions. So in this case, the assessor's office has put the solar facility on as personal property, because I think we need to be clear here, the land is not being taxed. So the tribal land is not being taxed at all. All that's being taxed are the improvements that are made on that land, and they're being taxed as personal property because they're owned by the petitioner and not owned by the tribe, and the tribe does not have an interest in those. So the guidance letter is distinguishable, as it's distinguishable with the Chilias decision as well. And I think the more important case law, now granted, while it is out of Arizona, it is at least recent. And so in Arizona, in the South Point Energy case, it's a very similar situation than what we have here. It was a power plant that was built and owned and operated by a private entity on tribal land. And in that case, the Arizona Supreme Court distinguished it from Chilias. And they said, the property, the tribe in this situation, while generally permanent improvements affix some land, they have an interest in, but not when the leasee, so the tenant in this case, the petitioner, have agreed that the leasee owns all the improvements. So pursuant to their lease, I believe it's section 7 of the lease, it's clear that the petitioner owns all of the improvements on this property. Now, in the lease, it also does have options at the end of the lease that the tribe could acquire an ownership interest in it, but they don't have one right now. And so the three options are, the improvements could be removed. The second option is partial of the improvements can be removed. And the third option is that the tribe could purchase the improvements. So I think that goes to telling you that they don't hold these improvements in trust for the tribe. And so in addition to that, the fact that NV Energy has a 25-year option to purchase these improvements also, at least in the first 25 years of this lease, the tribe can't own these improvements and has no interest in them. So that's with the, and then the other federal cases that have discussed federal preemption generally don't deal with ad valorem taxes. The ad valorem tax is a general tax that's that's applied across the state uniform and equally. The other taxes that have been dealt with in other tribal land cases are rental business taxes, gross receipts, sales and use taxes, hunting and fishing license taxes, but none of them deal with ad valorem taxes unless the tribe actually owns the improvements. And so that's the distinction here in this case. And I think it's important, one of the important decisions out of the Arizona case and the South Point Energy case is the tribes can't market their land as tax exempt in order to gain business. And so I think that's an important thing that they say in that decision, and they have to look at what is the tribe's interest in this land.
are in this transaction. And so here it's a standard lease transaction. They're renting land to a non-tribal entity, similar to how when the county owns land and we lease land to a private entity, those improvements become taxable. So, and I think it's also important to note too that, you know, the Arizona case was writted up to the U.S. Supreme Court and they declined to accept jurisdiction on they declined to take the case. So I think if it was so clear on federal law that the Chilias decision was binding on Nevada court as it would be on the Arizona court, we're both in the Ninth Circuit. And I think the U.S. Supreme Court would have accepted that writ and provided clarification if the Arizona Supreme Court was wrong. And then with respect to the Bracker test, and so as I said, federal preemption is a complicated fact-specific analysis that the assessor's office had to go through. And so in that Bracker test, you look to the extent of what the federal and tribal regulations are governing the taxing activity. Here, there are no federal regulations that restrict ad valorem taxes. It's a general tax that's applied. And then the second part of the test is you look at, you know, who has the economic burden? Who does it fall on? Does it fall on the tribe or does it fall on the non-tribal entity? Here, the tax burden falls on the non-tribal entity. There, you know, if they non-payment of taxes, the county would not come in and take the land or anything like that. There's no economic burden on the tribe. And lastly, third, you look at the extent of the state's interest in justifying the tax. Here, they're ad valorem taxes, so they're generally applied. They apply, you know, to state education, they apply to road taxes. This isn't a county-generated tax revenue to make money. This is the general ad valorem taxes in which is a high interest and a core part of government services. With respect to the payment in lieu of taxes, that contractual agreement between the tribe and the petitioner can't bind the state of Nevada or local government with respect to its statutory obligations to tax all property in Nevada unless it's exempt. So unlike what is permitted in NRS 372-800 with the sales and use in lieu of taxes that can happen, there's nothing similar like that with respect to ad valorem taxes. So I know the petitioner spent quite a bit of time on, you know, whether or not these are permanent improvements or, I guess, personal property, but the assessor's office is going to address that. And they're going to address the 6 factors in the white coat test that the petitioner addressed here. But I do think it's important to note that the county is taxing this as its obligations under the law and that there is no case law 100% on point and it has to be a fact-specific analysis. And in this case, the facts just don't lead to that the tribe has, that these improvements are held in the tribe's interest and trust. So right now I'll turn it over to the assessor's office.
How long do they have left?
9 minutes and 40 seconds.
I think we'd ask for a little indulgences with the petitioner as well.
Sure. Jason Priebus, the Clark County Assessor's Office. We've concluded that the property should be classified as personal property and is not a permanent improvement. The solar farm is for business purposes and not for the improvement of the underlying land. Please refer to photos located on page 117 and 118 of the Eagle Shadow Mountain PDF. This is a visual of the truss system, tracking system, solar panels, and wiring.
Go ahead.
To determine whether or not the asset in question should be classified as personal property or real property, the White Coat Court case was analyzed alongside the Appendix C of the Personal Property Manual. Please refer to page 61 and 62 for the analysis.
You're bringing to exhibit A?
No, it'd be in the Eagle Shadow Mountain PDF. Yeah. That's it. Is it exhibit A? Yeah, I guess exhibit A, part 1.
Page 61, personal property versus real property analysis, is that what we're looking at?
Yes, sir. The 6 questions to demonstrate the asset should be considered personal property are: 1, is it capable of being moved? Yes, solar panels can be disconnected from the wires and the supports. The truss foundation systems are not permanent as they are screwed into the ground and can be unscrewed for removal per the manufacturing company. It does not require any cutting at grade level. Inverters and housings can be lifted and removed as a unit. 2, is it designed or constructed to remain permanently in place? No. The design is of a non-permanent nature. The truss foundation system is screwed into the ground and can be unscrewed for removal, even if it's located within collegiate with the so-called grip to the earth. The fence posts and 40% of the solar support posts are direct embedded. The other 60 are the truss foundations, not cemented in, and can be removed. Inverters and housings are prefab units that can be lifted and removed or put into place. 3, are there circumstances that show the intended length of fixation, circumstances which show the property may or will have to be moved or removed? Yes. Panels are warranted for 20 years. All leases have an expiration that typically includes a requirement for the potential removal at the end of the lease and return the land to the original state, or a buyout of the equipment. By definition, there is a lease with a term and cannot be permanent. 4, is the property equipment readily removable and how much effort is involved? All the components are readily removable. Inverters are craned in and craned out. Property in the ground, such as fence posts and direct embedded, can be removed without damage. Solar panels, trackers, and electrical wiring can be removed without damage. The truss foundations are screwed in and can be unscrewed per the manufacturer easily. 5, how much damage will the property and equipment sustain during removal? Little to none as the equipment, little or none to the equipment or the land. The truss foundations are removed by unscrewing them with little to no damage per the manufacturer. All other components can be removed with no damage as well. 6, how is the property equipment affixed to the land? Properties such as fences and 40% of the solar supports are direct embedded, not cemented in, and can be removed. The truss foundations are screwed into the ground and can be removed by unscrewing from the earth. Inverters and housing units can be lifted from the ground with no damage, easily loaded on trucks to be removed. Now turn it over to Thomas from the Assessor's Office to summarize.
Thank you. My name is Thomas Lusek. I'm with the Assessor's Office, Clark County. I was sworn in, and you can spell my last name Walusek. What co-industry tests are good questions that the courts and tax commissions have used for over 50 years. Over the years, these questions have been rendered down and simplified into 2 basic overarching concerns. One is it inherently permanent? And what that does is it basically starts asking to us to define what that permanence is. When we say inherently permanent, that means that it lends itself to not being movable, to not having impermanence at all. In fact, the dictionary definition of inherently is in a permanent, essential, or characteristic way. So the takeaway here is that these facilities would have to be a permanent and an essential or characteristic permanent way. It's kind of redundant. The idea is the emphasis is on permanence itself. And the simple answer to the question is no. As we've been indicating, they are not inherently permanent. On this matter, the first couple of items that the appellant's letter referred to were how the improvements were fixed to the ground and were they constructed to remain permanently in place. Many examples were given for the type of the construction that showcase its intended permanence. We'll just speak to the direct embedded system of the earth trusses and the elements of the substation's construction that the appellant makes on these points. As far as the earth truss system is concerned, the manufacturer's rep that we contacted, when asked about the removal of this particular truss system, explained that applying sufficient torque to the screws allows them to be easily removed. We said by that word, it's his product. This does not suggest inherent permanence, quite the opposite. It suggests inherent impermanence. Now, I want to be real clear here, because when we're saying it's easily removed, or that's his words, there's going to be effort. There's no question about that. We have 121,000 of these things embedded in the ground. It took them a little over 10 months. I gave them 11. That's 220 days at 20 days per month. That's 550 of these things being drilled and pounded into the earth every day. That included GPS location, making sure that they were the right links for their embedding and all of these other different factors. It's a time-consuming process, but they still were able to do 550 a day. And that's, by the way, on an 8-hour day without any breaks. So when you're taking them out, you don't have to worry about the GPS. You don't worry about all those other kinds of things. And in fact is a tube that's put in the earth that you essentially pull out. I think they're going to be able to decommission those things in a much more rapid level. Another thing about these trusses, and I had a 2-hour conversation with a mechanical engineer, and basically some of the statements that were made by Justin are exactly correct. They're threaded all the way up. So when they're drilled into the earth, you would assume that with all that threading, that there would be some significant purchase. Reality is when you're dealing with any kind of a screw, after the first 5 full circumferences, it becomes a de minimis type of an arrangement because it's 50% more, 50% of the last one, 50% of the last one. It basically adds more friction than it actually binds in there.
How much more time does he have?
6 minutes with extra time given for different. But that's up to you, Chair.
We appreciate the chair's proposal. In any case, we're not, when we say easily removed, we mean that it will take effort, but from the 11 months that it took to put them in the ground, we're estimating probably 2 to 3 months to take them out. I just want to make sure that we're I accuse of exaggerating that particular thing. The thing that's interesting about these particular trusses, it's the same system that was just used east of the subject in the Gemini solar field on BLM land. That's 7,100 acres, 11 square miles of that particular thing. Now, I dealt extensively with the BLM, and they're highly sensitive to what they call the reclamation of the land, and would not tolerate the installation of any kind of improvement that were essentially installed in perpetuity, which is the word that's used in the letter on page 26, which means forever. And they're not going to tolerate that. Far from it, and I doubt ESM or Gemini developers would have installed improvements that would bankrupt their companies with the expense of removal. We're not persuaded in any way that this equipment is inherently permanent. For the substation, it was highlighted that many 30 to 48 inch in diameter, 8-foot deep steel reinforced concrete case and foundations were constructed to support the substation's mid-wire support poles and steel canopies and support structure there. First blush, that sounds kind of permanent to me too. But not if you realize that that's the same construction used in cell tower deployment, which has been identified and listed as personal property for decades. You have a huge concrete reinforced caisson that's put in the ground that has bolts sticking out of it, and you bring in a much larger tower than they have on the substation, and you bolt it down onto that. Still considered and valued as personal property. The second question, though, is even more interesting. First was, is it inherently permanent? And the second question really is, what is its ultimate use? The courts have been kind of focusing in on that particular thing. So that has to mean really 2 different things. Is the facility designed and constructed to improve the land? Or is it designed and constructed solely for a business purpose? In answer to the first question, no, ESM is not constructed to improve the land, the underlying land that the tenant does not own. In answer to the second, it's designed and constructed solely as a business, as a business purpose. It's basically put on the ground to manufacture energy, which is then sold off to other third parties. That is why the example I gave about cell tower is so informative. Because even though cell towers have similar serious construction, they were placed on the nearly universally leased land for solely a business purpose, and there was no intention to improve the underlying. This is the same for Eagle Shadow Mountain. To be clear, the improvements on the Eagle Shadow Mountain solar facility are not inherently permanent. They are in fact inherently impermanent. The Eagle Shadow Mountain solar facility was put on the ground for a business purpose and is not intended to improve the underlying land. If you think about it, those 2 things go hand in hand. The essence of the above is codified and spelled out in NRS 361.035. I'll be presented by my colleague, Jason.
Jason Preby at the Clark County Assessor's Office. Per NRS 361.035, real estate and real property defined subsection 3 except as otherwise provided in NRS 361.2445, when agreement has been entered into, whether in writing or not, or when there is sufficient reason to believe that an agreement has been entered into for the dismantling, moving, or carrying away or wrecking of the property described in subsection 1, the property must be classified as personal property and not real estate. The subject is, by statutory definition, personal property. Based on these conclusions, the assessor concludes that Eagle Shadow Mountain assets were correctly classified as personal property. Our valuation methodology is supported and reflects how the vast majority of utility scale solar facilities have been put on their respective rolls and valued through the state of Nevada. The assessor recommends holding the value of all 3 fiscal years.
Anything else from Clark County? I would appreciate if somebody would vocal. We're on the record here. You're all shaking your heads. Somebody answer the question.
No, thank you.
Oh, thank you. Mr. Hicks, you have a 2-hour rebuttal.
2, perfect. May I respectfully request 3
Oh, I'm
hours?
sorry, 2 minutes.
Thank you, Mr. Chairman. I'll be brief. I did just want to, just for the purposes of the record, I wanted to just lodge an objection to a couple comments from Mr. Walusick. I'm sorry. Walusick. Thank you. I should know that. He mentioned that he spoke to an installer. I don't know who that is. We don't have a statement from an installer. I don't know when that happened, what was discussed. That's hearsay evidence, and that really should not be admissible. He mentioned he had a 2-hour conversation with a mechanical engineer. Again, I have no idea who that is. When that happened, what was discussed, there's no mechanical engineer here testifying or submitting in writing. So I'd object to that too. And Mr. Walusick also mentioned his belief that the BLM would never allow earth trusses, apparently because they think that is semi-permanent but regardless, again, that's speculative. There's no one from the BLM here to testify. There's nothing in writing. So I just wanted to have those objections on the record. And then I do have a couple questions for Mr. Johnson. So Mr. Johnson, you just heard the testimony, and let's just start with the module tracker systems. I think you heard that from the county's position, these are very easy to remove and it's not a big deal. Could you give your reaction to that, please?
Yeah, I think certainly anything is possible to be removed. I mean, you can take the London Bridge down brick by brick, stone by stone, and build it back up in Lake Havasu. But the idea that this is easy to be removed, I've never seen it done. I've been in the energy industry for 20 years. There's no utility scale solar system that has been deconstructed and built somewhere else. They're not portable. They're fixed to the self. You could go and try to remove these without damaging them. That would be very difficult to the extent that you do need to decommission a plant like this. The practice is to kind of snip everything off at grade, to cut it off with plasma torches or something similar, and then abandon those components in place.
Thank you, Mr. Johnson. And with respect to the module tracker systems, how long can those systems last?
I think they can last for decades. There's systems that have been in operation for over 20. The solar industry is a young industry, but there's systems that have been in operation for about 20 years now, and are still tracking. I was stationed at Nellis, and they built a system there that is still tracking to this day. They built it in 2007. So they can last a long time. Like, as I mentioned, the components are made out of, the galvanized steel components. Nevada's a very favorable environment. We don't get a lot of rain. We don't get a lot of humidity. So the opportunity for rust, corrosion is much less than other areas. So very common to see that last for decades and decades, similar equipment.
Thank you, Mr. Johnson. And then I think there were some suggestions that pieces of this project could be interchangeable with other projects and moved and kind of plugged and played wherever they're needed. Could you respond to that, please?
Yeah, I think the name of the game in any industry, but in solar too, it's an optimization exercise. And the length of the wires, the length of these tracker structures we mentioned, a tracker structure is just they're oriented all north-south, and you track the sun east to west every day. And the length of those tracker structures are all optimized for the nature of the land you're going to put them on. So you will then choose modules that have a certain wattage, because when you connect modules in a string, like in a row, the voltage goes up, just like in batteries. Any DC component, when you connect them in series, the voltage gets higher and higher. So you need certain wattages of modules, you need certain lengths of cable, you need certain lengths of trackers, and you do an optimization exercise to best fit that in the land and the parcels you have available. And that's very important because that helps us deliver electricity in the most cost-effective manner for our customers like NV Energy. So all that to say, it wouldn't be easy for me to pick up Eagle Shadow Mountain and go put it anywhere else, even if I could, even if it was practical.
Thank you, Mr. Johnson. Also, there was some analogy of the substation to a cell phone tower. Could you respond to how, do you feel those are comparable, or how do you see that?
I don't feel it's comparable. I mean, anyway, it's the power infrastructure we have around us is critical for all sorts of things, for keeping the lights on, for keeping the air conditioning on, for running our hospitals. It's the type of infrastructure that once it goes in the ground and once it occupies certain real estate, you don't see it move very often. Like if you just were to drive around the valley, drive around Nevada, substations that have been there for years and years. If you think about a substation you might have seen when you were a kid, growing up near your neighborhood or something, I bet you it's still there today.
Thank you, Mr. Johnson.
1 minute left.
I think we'll go ahead and stop there. I know there were some legal arguments I was going to respond to, but they're all responded to in the briefs. So I would just direct you to that for any questions, but either myself or Mr. Johnson stand available for any questions from the board. And if Mr. Reel had if I have any remaining time and he wanted to make another comment, I'd certainly defer to him. Thank you.
Again, I just want to reiterate that as the tribal government for the Wakpata Paiutes and the tribal chairman, we are taking the stance that we are a government entity. We have the right to self-govern. We have the right to create businesses and have corporations on our tribal lands, and to tax them, to lease with them, and to work with them. And again, this structure, we take it as a permanent structure because this is in the tribal plans of what we plan to do and how we want to grow ourselves and our economic status within this world. And I'm sorry, when it comes to checking laws, we usually check the federal laws and not the local counties. And that's all I have to say. Thank you.
Thank you. That will conclude our presentation. We have questions by the state board.
Yeah. 50 years seems like that's 2 lives of the panels. Panels. I just put up solar at my house, and theoretically your curve goes down at about 25 to 30 years to the point where you'd be replacing them at 25 and again at 50, or are you just going to continue to degrade? Do you have a requirement within the energy to supply a minimum amount, or?
Yeah. Thank you, Board Member Caldwell. The solar panels typically have a 30-year warranty, and there is a degradation profile, and it's typically about 0.2% per year. So that would mean that, I'm just doing math in public, but call it roughly 30 years from now, the panel may produce 10% less at peak production hours than it otherwise would have. So if it's a 100-watt panel in the middle of the day, it might be peaking out at 90 watts instead of 100. We account for that in the design of power plants like Eagle Shadow Mountain. So solar panels produce power via direct current, and then it travels through the wires to the inverter, which converts it to AC. We oversize the DC capacity of the solar power plants so that there's significantly more DC capacity available. So as that degradation occurs, we can still hit the AC production numbers.
I tried to do that too, and the energy doesn't like it. The motors, because I'm assuming the motor is a pretty expensive component on the tracking system. I know you're saying the racking will last forever, but how long are the motors gonna, I would assume electrical components like that are gonna fail, especially sitting out in that heat.
It's
a lot more frequently.
So the Next Tracker tracking system is a very elegant design. There's one single per big long row of modules that you see. There's one single motor that is about as big as that water bottle, and it's connected to a gearbox that has a ratio of, call it like 400-1. So it's a tiny little motor powered by a little battery that's attached to it that is powered by a little solar panel that is affixed to the tracker. So the motors aren't very expensive. It is a replaceable item, but it's not something that fails very often. They don't do a lot of work. They just slowly track from east to west every day. And then overnight they track back and do the same thing. So I could get replacement rates for that equipment, but it's not a very expensive piece. And you can just go, you and I can go replace it by hand.
And then it's ground screws, I'm assuming, or are in the ground. So how does the framework attach to the ground screws?
So so those are actually drilled and then screwed into the ground, the truss systems, and then the piles. So it's like an A-frame truss. So one's drilled at an angle like this and screwed in, and the other's drilled at an angle like the opposite direction and screwed in. And then there's a truss cap that mounts to the top of those. And then there's a torque tube that runs across all of the trusses, and that's what the panels rotate on.
So as opposed to ground screws I've seen before where you put the ground screw in and then you have to attach, these already come.
Correct.
With the tube attached to the ground screw, and you just.
A ground screw can be used in certain, like in areas in the Midwest where we have things like frost heaves and stuff that would try to push piles out of the ground over time as the ground freezes and thaws. We would use something like a ground screw to really fix it in there permanently. Here we use the truss system, or we pre-drilled holes and then pounded piles with a pile driver into the ground. And the piles, they just look like an I-beam. It's a piece of galvan that looks like an I-beam, and you pound it into the ground.
All right. Thank you.
Yeah.
So I read somewhere in the packet that the modules were detained by customs. So how are the modules actually transported? Were they brought in pieces, or were they built on site?
Yeah, so we have modules from all over the place. For a facility like this, there's roughly 700,000 modules. And so some come from the US, some come from Canada, some come from, in this case, overseas in Vietnam, Southeast Asia. And there is something called the Uyghur Forced Labor Protection Act that we're very sensitive to as well, where there's an area in China where we're alleging that they have forced labor doing various manufacturing and things like that. So customs detained all modules that were being imported into the US until you could prove that every last component of that module had no forced labor as part of it, all the way back to like mining for the minerals that go into the polysilicon in the panels. So it took time for us to prove to customs and provide them all the source documentation that there was no Uyghur forced labor involved in the production of our modules, and then to get them released to Eagle Shadow Mountain.
I've got another one.
Go ahead.
For Clark County, you treat all solar panels as personal property? Okay. Or systems?
All 34 solar.
Yeah.
Also in the lease, it refers to transferring the tenant infrastructure shall be conveyed to the landlord in good and marketable title, built by or on behalf of the tenant by executing and delivering a bill of sale. It's not normal to transfer real property by bill of sale. So that indicates it might be personal property.
Thank you. That language, I can't speak to why it was drafted, but I would direct you to the other components of the lease that specifically define the infrastructure as permanent improvements. And I think that more clearly expresses the intent of the parties. And as well as what you heard from Chairman Reel, he looked at it the same way.
All right, and I do see where it does refer to it as permanent improvements, but then it also refers to all tenant improvements and all material supplies, equipment, production, and other property excluding existing infrastructure collectively as tenant's personality. And the tenant may remove personality at any time.
Again, I think in any kind of sale, there's going to be a global attempt to sell everything. And like if you're out at the site, there are spare panels and things like that that have not been affixed yet. So I would assume it's referring to everything, the permanent improvements, as well as everything else out there. It's not permanent.
Right. And my final question is, our next hearing today is Town Site Solar, which I believe is owned by the same company. And that one is valued as personal property. So what is the difference between these two facilities?
Thank you. I think the important thing is that, well, first of all, the question of real versus personal, is my understanding, is not at issue in Town Site. So it is at issue here, but it is at issue under federal law. So that is a difference. And again, you heard the question that the county treats everything as personal property. We've said in our letter that one size fits all approach we don't think is appropriate. The facts and circumstances of each case are unique and they should be looked at. There's unique facts and circumstances here about the long-term nature of this project, the long-term acquisition rights that are held by the tribe. And so just because one issue is not, one question is not an issue in one case, doesn't mean it's binding in another one. Cases all have different issues that are raised. And in this one, it's the federal law treatment of the improvements.
I'm curious. So, I mean, I used to do taxes. Federal law, real property is buildings, et cetera. I mean, for the IRS anyway. I don't know about the rest of the federal government, but I've always known the definition of real and personal to be the same, no matter who I'm dealing with. It's pretty straightforward. I mean, solar panels screwed into the ground or piled into the ground, maybe. I mean, I was doing this 20 years ago, so I don't know, but you know, I don't understand this distinction between real and personal for federal versus county.
We can't hear you up here.
Certainly. It seemed to be an effort to take a multi-component system and then treat it as a unit. The trusses and the things that get direct embedded into the soil are one aspect of this. The trackers are bolted to that. The panels and all the arrays are bolted to that. To suggest that the panels, which have a 35-year life and will really be up anywhere from 90 to 87% good, are real property when they can be unbolted and carried off, it doesn't make sense to me. That's a logical fallacy to me. They had to be treated somewhat separately on those lines. And just to correct the record on this, the manufacturer that we interviewed, we have a summary of his statements on page 116 of their very first document. That's 25-155 Eagle Shadow Mountain Solar. It's the very first PDF, and it's page 116 of that PDF.
I'm sorry, what are you talking about?
I'm talking about a comment that was made that
You're not answering her question.
I did. I just wanted to correct the record that it wasn't hearsay.
We're fine. We didn't ask you to do that.
All right.
Don't interject things that aren't appropriate, please. Thank you. Any other questions?
May I just respond briefly to that question as well? Because it is a good question. And when I first got this case, I was kind of looking at the same way. What's the difference? And, you know, there's a couple things. First of all, there's the federal test that's been articulated by the courts. So it is that 6-factor test is a little bit different. But even if you looked at this case under state law, which really isn't controlling, but if you look at how the state of Nevada has looked at this, the Department of Taxation, they have held that these projects, and I know Clark County treats them all as personal. The state does the exact opposite. When they look at these, and they look at these in those fiscal notes on the renewable energy tax abatement applications, they look at them all as real property. And
Sorry, when you're referring to the state, who are you?
The Department of Taxation. So the department has a different view than the county does. And they view them as real property because they operate as a single unit to accomplish what the property is there for, which is to produce energy. And it can be tempting to say, well, this piece and that piece may need to be replaced and therefore it's personal. But the way the state looks at it, and the state being the supervisory authority here, is you have to look at the entire project and does it all operate as a single unit? And that's why the state comes down the way they do and say that these solar projects are actually real property.
May I add comment to the state's view of solar farms?
I want to know who the State Department, what are they, I know they want to keep taxation fair and equitable between all the counties, but other than that, the state doesn't, except for centrally assessed properties, tax people. Is that where that comes from?
You're quite correct on that. In fact, out of 85 to 90% of all the solar farms in Nevada, they're all assessed as personal property. They've done that primarily because of our reliance on statute, which is 361.035, which says if there is an agreement, oral or unwritten, that this needs to be pulled from the ground, it's personal property.
Mr. Mitchell, can you clarify that, please?
Yeah, please.
Thank you. Jeff Mitchell for the record. So, in the personal property manual, we give deference to the county assessors in general to declare and do the analysis on whether property is real versus personal property. Within that manual, we provide the various tests that have been referenced because we believe that there is a case-by-case analysis that needs to be done on the various properties, and that determination is appropriate to reside with the county assessors. We do have some solar farms that are part of centrally assessed properties, and those are encapsulated within the valuation of that centrally assessed process, which is a little bit different per regulation than just the real versus personal. There we do a unit valuation and we look at an income approach as well as a historic cost less depreciation on both of those. In regards to the declaration that we view everything as real property, I believe that was in reference to the fiscal notes that are done when these are being reviewed for the renewable energy abatement, but I'm not entirely positive on that. That analysis is usually speculative in nature, and I'd have to review those fiscal notes, which I have not done. In general, I believe that we usually reference that these are locally assessed and the decision on real versus person was there. But if we're looking at the property that has been submitted to us, we do the analysis based on that 50-year and 1.5% depreciation instead of the personal property table. But I would have to review those, as I don't know if I can speak to that entirely.
How were the solar equipment classified in the Battle Mountain case?
Jeff Mitchell for the record, I believe the county assessor in that regards did value those as real property.
Yes. And if I may, I believe that case, that was an issue before the County Board of Equalization. In that case, the property owner challenged the assessor's treatment of it as real property and argued that it should be treated as personal property. The County Board of Equalization rejected that argument and held that the assessor correctly classified it as real property. Yes, I'm familiar with that. We went to a mediation several times and discussed that probably pretty extensively. Let me ask both of you this, if the termination of the lease, 50 years, does the improvements or the solar equipment or however you want to classify it, does that revert then to the tribe?
Yes, Mr. Chairman, Josh Hicks, that the tribe has the opportunity to acquire them if they would like. They have multiple options under the lease, one of which is to acquire the property. They could require it to be removed, but that is not the only option. They actually could keep it. And I think you've heard from Mr. Johnson and Mr. Reel that there seems to be an indication that keeping this past 50 years is what's going to happen.
So the tribal entity does have a reversionary interest in the property at the termination of the lease.
That's correct. They have a right, an unquestionable right to acquire the project at the end of the lease.
Is there a cost to that? What's the basis for the acquisition?
Yes, there's a fair market value acquisition price to acquire it.
Any other questions?
You have not responded to NRS 361.035 that it must be classified as personal property. How do you feel about that statute?
Thank you for that question. We did respond to that in some of our writing. But I think two things. One, because this is a question of federal law, the way state law treats these, as I've said, is irrelevant. So it doesn't apply as an initial matter. But even if it did apply, that statute talks about a requirement to remove property. That's not what we have here. We have an ability of multiple parties, NV Energy and the Moapa Band, to acquire the property and keep it. So that statute is kind of a take it or leave it. Like if you have to get everything off, that statute applies. But that's not the case here because of the rights in the lease allow the property to be acquired and continued after 50 years.
Mr. Bancroft, I wish you could help us out here.
I wish I could too. I do have a question if you don't mind.
No, I appreciate that.
The economics of this, you're operating under a power purchase agreement. And it's my understanding that when you have a power purchase agreement, it's kind of like a fixed income stream, as long as you're providing what you said you'd provide in the power purchase agreement. How would, presumably you ran projections as economically how this project makes sense. And if I understand this correctly, you were advised by the State Office of Energy that you wouldn't be paying property taxes. So you didn't budget for that in the projection. How would this change the economics of your assessment of a property tax? How would it change the economics of your project?
It'd be it already is very painful. It would continue to be very painful. That Mr. Bancroft is correct. Our power purchase agreement with NV Energy, it's a great deal for them and for us too, but we're selling energy at a fixed price today and at a fixed pre-agreed price 25 years from now. And solar is nice because I don't have to worry about fuel costs. So I don't have to I'm not a natural gas plant trying to hedge water or gas prices well into the future. All my cost is up front to build the plant in CapEx. And then I have this fixed revenue stream that I know if I produce a given amount of energy, I'm going to receive from NV Energy. So my OpEx costs are things like the lease payments, the pilot's payments to the tribe, insurance, and just minimal costs. It doesn't take much, but just to do the operations and maintenance of the facility. So it has a significant impact to our ability to move forward if we're being double taxed, essentially, if we have to pay the pilot to the tribe and then go pay this property tax or personal tax, whatever you want to call it, to the county. That was not planned for. We would have needed to charge a higher power price to NV Energy to make that all work. Had we known before we built this that this was what was going to happen, we're going to need to pay the county and the tribe, we would have had a higher power price to account for that in the long term of the project.
Did you receive the 30% federal tax credit on the project?
Yes, we did receive the federal tax credit for Eagle Shadow Mountain. And that's all baked into the price we offer to NV Energy as well. So that was known in advance and we received that credit, correct?
Any other questions? Mr. Bancroft, you got a question? Lisa, you came back to the microphone here, and I assume you want to make a statement. I'll give you time to do that.
I'm just here available for questions that look like they were questions were becoming more legal than related to the real or personal property. So I'm available for any questions. But I would say in conclusion here, you know, to Mr. Bancroft's question, on the renewable application that is submitted by the state on page 11 of that, which is in your record under Exhibit J, it specifically says that the final determination of classification by property as real or personal is made by the county assessor for locally assessed property. So, you know, while it's unfortunate that the petitioner may have relied on the Office of Energy with respect to taxation, there is a caveat in the application that it is done by the county assessor.
Where was that?
It's petitioner's Exhibit J. The application is pages.
Okay, let me find it.
Okay.
I don't have a J exhibit.
So it's in the book that Exhibit B through T, I think, and then it's J of B through T.
Oh, B through
T, I believe.
So it's. How do we go to
Yeah, it's
B
just
through- What page is that on?
It'd be
737 pages I got.
it's actually the exhibit that is 1,079 pages. It's that exhibit you need to Exhibit J, and then through that it is page 614. Mhm.
It says what? It says 155 is difference in B. That should be.
614.
You see that on this list here?
The letter is in there, so it must be in one of those packets, but.
Well, I have exhibit S, U, V. Exhibits A. Then I got exhibit E.
And B
That's
through
including E, G, and H. It's a separate document that's in this 155 file.
it was part of the petitioner's packet, exhibit B through T, I believe. Correct.
Sketch this out.
So J would be in B. Yeah, I didn't catch that.
Yeah. Okay, then tell me what the hell this thing called. No, I want to get to the right document.
You can go to page 614 if you type it in through the, yeah.
So it does say exhibit B.
Six 14, something. That's.
Oh. there should be 1,079 pages of that exhibit.
This one ends at 7:37.
Well, I've looked at thousands of pages of documents, but I seriously, I don't have that.
Is
Is that on the flash drive?
Yes, Chair, it is.
Safe to put this in my machine. Let's take a break, okay, until I find this document. I'm sorry to make everybody sit around here. Let's take a 10-minute break, 15-minute break, whatever it takes. I'd like to call the meeting back to order. We are on case 25-155. We're in this state of asking questions by the state board members. Anybody else have a question? Mr. Hicks, can you refer to that, the letter that you have, you testified to, that I finally found, dated September 9th?
Yes, Mr. Chairman, the letter I referred to was dated September 9th. It was addressed to Mr. Thomas Walusek. And the Whiteco test, which is the applicable federal test for permanent improvements, our analysis of that test is set forth on pages 5, starting on page 5 and ending on page 17. So there's an in-depth discussion of those 6 factors in that page range.
So can you summarize the conclusion as to what is applicable here to determine this property as real or person? Is that what's included in here?
Yes, sir. That's the question is the property considered a permanent improvement under federal law? Because that's what's important for Chehalis, as well as the guidance from the state. And so those were the 6 factors that I went through at the start. Like I said, the analysis is set forth in detail on pages 5 to 17 of that September 19th letter. But essentially, to summarize those, the manner of affixation to the land is significant. This is a massive project, like I talked about, and like Mr. Johnson talked about, tens of thousands of tracker units, tens of thousands of earth trusses, tens of thousands of driven piles, all of which take a significant amount of time and work to put into the ground, and all of which are extremely difficult, if not damaging altogether, to the module trackers to take them out, and that are put in place with respect to unique geological conditions out there. There's a geotechnical report in there as well. The substation as well, major undertaking with a thick foundation, 50,000-pound transformers on it, overhead lines, all of which show permanence. That permanence is supported and backed up by what you see in the lease documents and the tribal agreement, what you've heard in the testimony today as well, with a 50-year lease that treats these as permanent improvements, a right to acquire the property by the tribe, as well as a right by NV Energy. You heard Mr. Johnson's testimony that this project could go on indefinitely with some repair and some replacement of pieces here and there, but all of which suggests that there's been intent, as well as the physical affixation, that this be a permanent project. We talked a little bit, and there's some more in the letter about the time and what it would take to actually remove this property, which would be substantial. It's not easy. It's not just going in there and unscrewing a few screws and moving everything off. It takes over a year. There's a decommissioning plan that's in your exhibits as well. There's regulatory oversight. It essentially destroys the vast majority of the project by doing that. And if you're cutting those posts off with plasma torches, like Mr. Johnson talked about, you're leaving pieces of the project behind too as well. So there is permanent damage to these components when you take it off. The question about whether it can be moved or has it been moved, again, it's never been moved. It's not going to be moved. To move it would breach the contract, it would breach the lease, it would breach the PPA, and that would cause economic issues, that would cause the appellant to be sued. There's no reason to do that. And in addition, if you remove it, it effectively destroys the project. So it's not going to be something you can pick up and plant it somewhere else. So that deals with how much damage the project is going to sustain as well. And then the circumstances showing the expected or intended length of the fixation. You heard Mr. Johnson talk about these module tracker systems could be there indefinitely. Again, some pieces of them, the motors may need to be replaced from time to time. The panels may need to be replaced as they degrade. But the systems itself, the project itself, can last indefinitely. And then again, there's a 50-year lease. There's a right for the tribe to acquire it after that. You've heard testimony indicating that the tribe views this as a permanent improvement as well. Parties have even codified that in their lease. So all these indications meet those 6 factors and show that this, for federal law purposes, is considered a permanent improvement. Now, again, that could be a different analysis. You could have a completely different analysis in front of you with a project that's on non-tribal land, because that's purely governed by state law. But here, the test is the federal law test. It's that 6-factor test, which I discussed and which is in that letter. And that's where we think comes down on the side of a permanent improvement. And permanent improvements under Ninth Circuit law are exempt from property taxation, no matter who owns them.
Thanks for summing that up. I think that's what I asked you. Lisa, I'll give you an opportunity to throw in a rebuttal or a few comments or some closing arguments. I would appreciate that if you would. Thank you.
Thank you, Mr. Chair. Lisa Loxton for the record. The white coat test that the petitioner keeps referring to as being a federal law test, that is actually the same test that's in the personal property manual. So we use that test across everything in personal property here in Clark County. So I think where they're trying to tie it into the federal laws, if they can get these improvements to be permanent, there's a better legal argument that the improvements are tax exempt under federal law, federal preemption. But that's not the end of the story under federal law for that. And so in my view, whether the improvements are permanent or personal property, they are still taxable under federal law because here the non-tribal entity owns these improvements. They're theirs. The tribe doesn't really have an interest in them. They don't own any percentage of them. This is more similar to the Arizona test that just came out in 2024. Same situation there. You know, there in Arizona, they determined them to be permanent, but they still were subject to federal taxation, or they were still subject. I'm sorry, let me say that again. They were not subject to federal preemption. So they were still taxable in the state of Arizona, just as they would be here in the state of Nevada. So I don't know, you know, the white coat test, which I think the assessor's office testified, you know, what their opinion was and why it was personal property and how it's been, how we've determined all solar farms or solar facilities in Clark County to be personal property.
I'm going to call on Mr. Mitchell. From the department's point of view, you've looked at the solar properties all over the whole state. It's not only in Clark County. Like I brought up the Battle Mountain solar case. Are we in the state of Nevada required to comply with the federal laws? Are we going to follow along what I just read here in his letter that it's really non-taxable? Or is there something I'm missing there? As far as real or personal property, let's address that first.
Thank you. Jeff Mitchell for the record. In regards to the real versus personal property, we do make recommendations and use of the white coat test, however we want to pronounce it. And we do give that deference to each county assessor, as it's not really appropriate for the state to do a parcel by parcel analysis of real versus personal property. in regards to solar farms. I believe that I have seen instances where either would be appropriate. Either the classifications of real or personal, and I know that doesn't give you any help. But I do believe that there are instances of these that it's an appropriate classification for it to fall into one category or the other.
Thanks, Jeff.
I'm sorry.
Thanks. We've been all over the state valuing properties and I ask all these questions. Anybody else? Is it real or personal? I guess is what it really comes down to.
Yes, sir. I'll make a motion if you want.
Okay,
We'll make a motion in favor of Clark County Assessor, based on the fact that they treat all solar as personal property in the state of Nevada. Or in the county, Clark County.
we have a motion. Do we have a second?
Second.
All those in favor indicate by saying aye.
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 Nay. Shane? Motion passes. Motion passes. Thank you. Next case.
Thank you, Mr. Chairman. Jeff Mitchell for the record. Under agenda item J for possible action, we have appeals from the action of the County Board of Equalization pursuant to NRS 361-400. We have case number 25-139, which is town site solar. And we have case number 25-140. These are dealing with different tax years, but the information contained within the appeals is very similar. I am not sure if we wish to consolidate the cases or hear the cases separately, and I would give deference to yourself as well as the petitioner and respondent.
Speak up, please.
Sorry. We have case number 25-139 and 25-140, both town site solar. This is dealing with different tax years. 25-139 is tax year 21-22, and case number 25-140 is tax year 22-23. With that, I'm not sure if the petitioners as well as the respondent want to combine, or if the chair would like to combine these as well, as the information is very similar for both.
Let's have introductions, please. First of all, you guys sworn in? You were sitting over here? Well, I just, like a half an hour ago, I said, anybody else here going to testify? I'm sorry, go ahead. Would you swear in, please? Anybody else here going to testify that hasn't been sworn in?
Please raise your right hand. For those of you who are going to testify in front of the board, you hereby swear to tell the truth, the whole truth, nothing but the truth.
Thank you.
Mr. Chair, can I make a comment on the record?
Yes.
Our firm, McDonald Crono, represents Erevan, who is an affiliated with Eagle Shadow Mountain Solar, where we represented them in that case 25-155. Erevan is also affiliated with Townsite Solar. But our firm does not represent them in the Townsite Solar case, cases 25-139 and 25-140. And I have no pecuniary interest or obligation or commitment to Townsite Solar. So I just wanted to disclose on the record that there's that affiliation, but that there is not a conflict. So I will be participating in the case.
Counselor, you agree?
Yes, Chair. This is Mike Everett for the record.
Thank you. We'll proceed then. We have introductions.
I'm sorry, we can't hear you up here.
James Bergstrom.
A little microphone, a little black thing right here.
James Bergstrom.
We still can't hear you.
James Bergstrom, Bergstrom.
Testing, 1, 2, 3. Can you hear up north?
Yes.
Can you hear me? Speak up.
James Bergstrom, Bergstrom.
Did you hear that?
We did. Thank you.
Thank you.
Eric Huswick, Vice President of Finance at Arebon Energy, owner of Townsite Solar.
Amy Mills, Clark County Assessor. Lisa Loxton, Clark County District Attorney's Office.
David Denman, Clark County Assessor's Office.
Let's get acquainted with the property.
Amy Mills, Clark County Assessor's Office.
Speak into that microphone, please, and speak up.
Case 139 is an appeal from a County Board of Equalization decision for Assessor ID 230123 for Townsite Solar for the 21-22 fiscal year. The appellant is requesting that an investment tax credit be considered as obsolescence due to obsolescence to reduce the taxable value of the personal property of Townsite Solar. The Clark County Assessor's Office contends that the ITC does not indicate obsolescence and that the taxpayer had not met their burden of proof that the Assessor's Office had exceeded full cash value. The County Board unanimously agreed with the Assessor's Office valuation of $504,676,562. The Assessor's Office requests that the State Board uphold the decision of the Clark County Board of Equalization.
Excuse me, David Denman for the record. I would like to propose that we hear both years together. They're valued exactly the same. They're before the county board, they were the same arguments.
Any issues with that, Mr. Mitchell?
As long as the petitioner is on board, there should be no issues.
How about the respondent?
Eric Huswick for the petitioner. We agree.
Okay, we'll combine 139 and 140. Thank you. Go ahead.
Thank you, board, for your time today. Eric Huswick, Vice President of Finance at Arebon. As one of my colleagues mentioned earlier, we operate about 6,000 megawatts of renewable energy projects across the United States. The issue in front of the board is whether Clark County assessed the Townsite project at a valuation in excess of full cash value of the project or otherwise assess the project in an inequitable manner under NRS 361.345. We believe the answer is yes. The county has failed to correctly reflect obsolescence in its calculation of replacement cost or consider the valuation evidence provided by the appellant in determining the full cash value of the project. Pursuant to NRS 361.224 or 227, tax value must not exceed its full cash value. A person determining whether taxable value exceeds that full cash value or whether obsolescence is a factor in valuation may, with emphasis added, consider comparative sales based on prices actually paid, the summation of estimated full cash value of land and contributory value of the improvements, or capitalization of the fair economic income expectancy or fair economic rent, or an analysis of the discounted cash flows. Full cash value is commonly called market value or the price something would sell for in an open and competitive market. The taxpayer in this instance has provided valuations of the project, which are included in case number 25-140 on PDF pages 23 and 24, and a third-party valuation starting on page 225. Additionally, the appellant opinion of taxable values is a simple approach to determine replacement costs where the project's original cost with an economic obsolescence adjustment of 0.07 is used, which reflects the impact of the federal investment tax credit earned by the project. For the avoidance of doubt, the company's valuations actually result in a lower full cash value than the amounts the appellant reported on their appeal. However, the act of valuing a project is complex and the appellant wanted to present a simple solution to an otherwise complex process. The county's valuation also relied on replacement cost new less depreciation or RCNLD that has included adjustments for cost indexing and depreciation per the personal property manual, as well as an obsolescence adjustment based on trending market costs. While we understand that two of these inputs are driven by the personal property manual, we do not think that the county appropriately calculated obsolescence, although they did acknowledge a significant amount of obsolescence exists without considering the impact of the investment tax credit. The investment tax credit can create market dislocation, which we will discuss now, an example of which is demonstrated in the handout appellant provided with the electric car example. See page 2 for case 25-140. If someone purchased an electric car for $60,000 and then received a tax credit for $7,500, the full economic cost of the car is only $52,500. The day after they purchased the car, they would be selling to will it for would be willing to sell it for 552,500 or more. However, it would be difficult to find a purchaser who would be willing to pay more than 52,500 because they could simply purchase a new one and take advantage of the same credit for their own benefit. Similarly, if someone were to build a project, it would qualify for the investment tax credit, and a reasonably informed buyer would not pay for a benefit it cannot receive. No one makes a decision and spends more than their expected value of return in that investment. That same buyer would be better off going and building a new project, just like the EV buyer would be better off buying a new EV off the lot. It appears that the county also took a cursory view of the discounted cash flow valuations provided by the taxpayer, but did not factor them into their decision of full cash value. Had the county considered them, the county would have first seen that the revenue expense assumptions underpinning these valuations supported a value much lower than the county's proclaimed full cash value by an amount in excess of $130 million. Second, the county would have compared the projected cash flows against the books and records included, which indicated the project does not actually cash flow at the same levels it was projected to, which would support an even lower valuation if they were looking at their own discounted cash flow. Furthermore, the appellant believes that the county's valuation would result in the project being treated inequitably in the face of recent board rulings and legislative action. State Board Case 22-130 found that the federal tax credit of 30% should be deducted from the assessor's replacement cost calculation. This view was reaffirmed earlier this year in the Board of Equalization's motion for motion for voluntary dismissal filed with the Nevada Supreme Court in Humboldt County, Nevada versus the state of Nevada, issued on May 22nd, 2025. In that ruling, or in that motion, the Supreme Court reports that the board affirmatively stated it intends to treat these credits as a form of obsolescence in subsequent proceedings, and that such tax credits are not per se exempt from taxation. The motion also includes language that this board may change its mind in the future and is not a stop from developing a new methodology. Due to the recency of this motion, the appellant is not aware of any new methodology and does not feel that Clark County has come up with a new methodology to address this specific issue. Instead, the county acknowledges in their evaluation that obsolescence exists in relation to the general cost to construct a project on top of a cost index provided in the personal property manual, which is a 0.89 instead of a 0.7. So they had determined that there was about 11% of obsolescence. The county, however, does not address why previous rulings by the State Board of Equalization and the aforementioned methodology from the Supreme Court, or that it was referenced in the Supreme Court ruling, were not considered and should not apply here. As such, it may be appropriate for the board to rule that an obsolescence factor of between 0.7 and 0.59, meaning the 11% based on the economic factor plus the impact of the credit, when looking at the county's calculation of obsolescence and the impact of the federal investment tax credit on what this project's full cash value is. Finally, the county's opinion on pages 43 through 46 attempts to conflate obsolescence adjustments to full cash value with a statutory tax exemption or a tax abatement, quote unquote, a tax deduction. And the county incorrectly states that the impacts of tax credits cannot be factored into the analysis because there is not explicit exclusion under the IRS or the NRS. The county erroneously argues that a warranted adjustment to full cash value is the same thing as a tax abatement or a tax exemption. A tax exemption or a tax abatement is granted by a government based on statutory language or otherwise provided by a government to incentivize investment. The appellant does not contend that there is an additional tax exemption or abatement involved here, nor does it believe that there is a statutory requirement that original acquisition costs be adjusted for the credit. The county cites numerous rulings from other states that are not binding in Nevada, which are in direct conflict with previous rulings by this board. Such a conclusion would effectively render tax abatements or exemptions inapplicable, as obsolescence is an inevitable part of any asset's life cycle. The appellant rejects the notion that full cash value in Nevada should be governed by other state laws or be treated as a tax exemption or a tax abatement, as such conclusion would be incorrect and in conflict with well-established principles of property tax law. As such, the appellant believes that Clark County's assessment is far in excess of the full cash value of this project. Based on a simplified method of applying 0.70 obsolescence adjustment to reflect the impact of the 30% ITC to the acquisition cost, the taxpayer arrived at its opinion of taxable value and believes it is far more reasonable. This approach would be easy to integrate into the county's valuation approach and the personal property manual. A taxable value of $375 million is in excess of the value computed in the appellant's discounted cash flows, but the appellant understands that a simple approach is much easier to align with NRS 360.2911A, which provides that taxpayers must be treated with courtesy, fairness, uniformity, consistency, and common sense. We ask that the board reject the assessor's conclusion of a taxable value and accept the appellant's methodology and opinion of value.
Anything further?
No, Chairman.
Mr. Denman?
David Denman with the Clark County Assessor's Office. We would like to remind the board, this is an appeal from the county decision, not a direct appeal to the state. The gentleman that just provided testimony did not speak before the county board, so it's all new evidence. The county board had none of this information that he just spoke to make their determination on. Therefore, we would request that it be stricken from the record, and I will hand it over to Ms. Mills so that she can present the county's case.
Amy Mills, Clark County Assessor's Office. As was testified to at the County Board of Equalization, the Assessor's Office valued the personal property for town site solar as directed in the personal property manual using the 30-year life table for a power generating utility. Please go to page 33 of case 139 for the valuation breakdown.
What page is that on?
33?
Yeah, correct.
Of case 139.
33 of 139. I'm on 25, 139. Am I on the right?
Is page 33,
Yes, valuation details goes across, yes.
I gotta get the right yo-yo here. 25, 139 is a 284 page document.
Page 33.
Yes, sir.
Page 33 is okay, I'm there. Sorry.
Okay.
That's the 21, 22 values.
Correct, sir.
Okay.
This gave us a taxable value of $531,238,486. Based on an analysis of the Berkeley Lab study, obsolescence was calculated and applied, thus reducing the taxable value to $504,676,562 as to not exceed full cash value. The ITC is a made-up number derived by a congressional committee to incentivize companies to invest in building renewable energy facilities. It is an incentive that greatly increases the investment return to the ownership of this class of asset. The ITC is not a purchase discount, nor does it alter the replacement cost new of an asset. It is only a reduction of federal tax liability. NRS 361-227 Section 5 allows three methods to determine if taxable value exceeds full cash value: sales comparison, cost approach, or the income approach. The ITC does not meet any of these three criteria for estimating full cash value. Furthermore, there is nothing in the accounting records that we have been provided that indicates that our taxable value as calculated, less the obsolescence, exceeds the property's full cash value. An impairment study is an accounting review that is normally done yearly to make sure that the carrying net book value of assets does not exceed their fair market value. If the value of this company's assets has lost as much value as indicated in their appeal, an impairment would be made to lower their net book value. We have been shown no evidence that this adjustment was made. Please go to page 12 titled Balance Sheet as of December 31st, 2021.
Page 12.
12.
Balance sheet, December 31st,
2021. Yes, sir.
About halfway down the page, you will see fixed assets. You can see that the total for the solar system and the battery system, as well as the depreciation for those items. The net book value listed for the fixed assets is $530,732,983.73. There is no indication that an impairment adjustment was applied to the property's net book value to adjust to the market. Their net book value of $530,732,983.73 is greater than our taxable value of $504,676,562. Our conclusion is that our taxable value, which includes an obsolescent adjustment, does not exceed full cash value, and that the appellant has not met their burden of proof showing otherwise. The county determined that there was no evidence that the assessor's taxable value had exceeded full cash value and unanimously voted to accept the assessor's valuation of $504,676,562 for the 21-22 year. I will now hand it to Lisa Logston.
Thank you. Lisa Logston, Clark County Assessor. Just want to address two issues with a blanket 30% reduction for the tax credit. The District Attorney's Office provided a legal opinion in this case to the County Board. It can be found on page 34 through 37 of Case Material 139. And in that legal opinion, there were two issues discussed. One, whether or not a blanket 30% reduction for tax credits would violate the already tax credit that is allowed under the renewable energy under NRS 701A, section 370, which states that if you get the 55% tax abatement, you're not allowed additional exemptions or abatements. Since this is just a blanket 30% reduction, it acts more like a tax abatement than an actual reflection on the value. So it's our District Attorney's Office opinion that that would violate that section. You could either get the 55% or you could have this 30% reduction. Obviously, there's no case law in Nevada with respect to applying these tax credits outside of the case that this board stipulated to and settled at the Nevada Supreme Court, which is not, it's a different situation than here, but other jurisdictions outside Nevada have looked at this. In Arizona, there is a statute specific on point that says the taxable original cost of renewable energy and storage equipment shall be reduced by the value of applicable investment tax credit. So they have a statute directly on point saying that the investment tax credit should come off the value. But in California, other jurisdictions have ruled, for an example, they looked at a low income housing tax credit, and they determined that that does not reduce the property tax valuation. That's the tax credit that you get for affordable housing is an intangible asset that does not directly contribute to the market value of the housing project. Also in California, they found that the federal investment tax credit for a department store could not be considered when determining the full cash value of the company's furniture and equipment. So we've got additional case law out there that a blanket, 30% reduction due to a federal tax credit isn't really reflective of your full cash value. And then as far as the clarification statement that was issued, I believe in the Humboldt County case, it said that, solar facilities, they can use the federal tax credit as obsolescence in subsequent proceedings, but that federal tax credits are not per se exempt from federal property taxes. And that decision is not binding on future boards of the State Board of Equalization.
I'm sorry, I screwed up when I asked her a question, so I didn't catch the last part of that. But you're talking about the
settlement
case,
agreement.
I'm sorry?
Your settlement agreement?
Yes. Can you go through that again, please?
Yeah, so I think as part of that settlement agreement, the State Board issued a clarification statement, is my understanding,
Yes.
in that case. And so, and just reading from that, in the settlement agreement, it says the state board will issue a clarification that it intends to treat federal tax credits for solar facilities as obsolescence in subsequent proceedings, and that federal tax credits are not a per se exempt from Nevada property taxes under NRS 361. This clarification will not be binding on subsequent state board of equalizations. So we would say that that decision by the state board is not binding on this board right now, because in this case, we're looking at a full cash value analysis, and the 30% reduction on top of what the assessor's office has already determined to be obsolescence is not appropriate. And because the assessor's office is not exceeding full cash value.
Mr. Mitchell, you have that information on that particular case she's referring to, and has the state board met on that yet?
So I believe the case that she's referring to is the Battle Mountain Solar.
Yes.
I do not have it immediately on hand, but I could research it and get it here quickly.
Okay, but it's your position that when we did that mediation was that the federal tax credit was eliminated from the obsolescence, and the state board classified the obsolescence and ignored the federal tax credit. Is that right? It's basically what happened.
I'm not privy really to what happened in that case. All I have is what was in the settlement agreement. I don't know what the state board, but basically they determined that, you could consider the tax credit as obsolescence. And what I'm saying, and in this case, the tax credit isn't really a part of obsolescence analysis.
Sure. Speak into the microphone.
Petitioner, I think you mentioned that you had a discounted cash flow approach.
Eric Huswick for the record. What board member Bancroft? Yes, we do. We did provide multiple valuations.
Is it in the record your discounted cash flow approach?
They are in SBE 23 and 24. There are two different ones. And then, as I mentioned in my statement,
It's in the
25-140
records.
And then there's a third-party valuation starting on page 225 of that record.
25-140.
And then it's pages 23 and 24.
Now, is this information brought before the county board? Please verbalize your answer.
Yes.
Well, he was nodding.
Sorry.
Mr. Denman indicated at the start of this that the information that was presented was not provided at the county board. So I don't know what's going on here.
And Mike Dever, for the record, I apologize for the interruption, sir. And I also apologize for not being timely with this advice. But usually when there's an objection, typically in this case, the petitioner be given an opportunity to respond. Therefore, that way the board can make a determination on that objection as to whether or not in this instance that is new evidence that should be stricken. So if the board wanted to revisit that, to have that discussion as to whether or not this is new evidence that needs to be stricken because it's not provided in the lower proceedings, and therefore not appropriate for the board to review.
I'm sorry. Could you state that again, please?
It'd be my pleasure, Chair. So my understanding, there is an objection before the board concerning that the statements provided by the petitioner is new evidence. The petitioner should be given an opportunity to respond as to whether or not this is new evidence that should be stricken.
Right. Okay. So we're going to go back to the objection that Mr. Denman made about this is information that was not presented at the county board. So I asked the petitioner to tell us why we should hear that.
Eric Huswick for the petitioner. The only new piece of information would be the motion for voluntary dismissal that occurred or that the Supreme Court put out after the hearing at the county board. All of the other statements are merely my rebuttal or my response to what was posted on the county's website, which is my understanding is a carryover from the county board ruling, the information that was provided there, as well as the opinion of the county. I'm not aware of any other new information, and we did not try to put this into the record after. This is just my conversation today and my thoughts as to this position.
Right? If I understand correctly, I think Mr. Denman. If I understand correctly, I think Mr. Denman's concern was that the case was presented by somebody different in front of the county board. It's essentially the same information, but we have a different person presenting it today. So it's not really an objection to the evidence that's in the package and stuff, but just that the person presenting it may characterize it differently or something.
David Denman with the Clark County Assessor's Office. That is substantially correct.
Yeah.
The information that's in the record is the information in the record. The gentleman presenting never provided testimony before the county board. That testimony, in some ways, is, in my opinion, is different than what was presented to the county board, especially as it applies to certain things like the discounted cash flow. Mr. Bergstrom was the only person for the appellant that presented before the county board. And in a prior case, it was determined by this board that someone that had not spoke before the county board was new testimony. So our objection is that it's the testimony, not the written document, that's the new evidence.
Mike Dever for the record, if I can get some clarification. So I just want to make sure I understand the objection so I can advise the client. So then the objection is that it's the person speaking, not what is being spoken.
Well, to a certain degree, it's what's being spoken also. Not everything that in my opinion, not everything that was said was presented in that manner or at all before the board. The evidence was in the record, but the detail that they went to was not spoken before the board.
I suggest we note the objection for the record and move on.
Okay, thank you. Let's go.
So
Yeah.
just for clarity, the objection is overruled, if I understand this correctly.
It's noted.
Which would serve as an overrule. You're right.
It's overruled. Let's go.
I turn to your page 23, discounted cash flow approach. And the numbers are kind of blurry, but can you tell me what your conclusion of value is? On the page 23.
Eric Huswick for the petitioner. Our conclusion of value depends on a variety of discount rates, but the highest conclusion of value is 308,051,950.
And you said there was a second discounted cash flow approach?
Eric Huswick for the petitioner. Yes, there is a subsequent discounted cash flow on page 24 for the subsequent year. And that value is 285,305,540.
And say that number again, 280 million?
285,305,540.
And then you mentioned that you had an independent appraisal performed.
That is correct.
Do you know which page that is on?
It starts on page 225 of the supporting documents for 25-140.
225.
Correct.
And who performed that appraisal?
Eric Huswick for the petitioner. KPMG's valuation group performed that appraisal.
And do you know the purpose for that appraisal?
Eric Huswick for the petitioner. Basis of that appraisal was to support the reasonableness of the petitioner's appraisal that it had done in-house.
I am not used to reviewing appraisals to say, is this a qualified appraisal? Perhaps Chairman Morris, you could comment?
You know, I thought when I was reading this document,
I think it says that, yeah, here it is. It's a memorandum. This memorandum represents a summary of an oral report provided to client regarding our considerations and conclusions. This memorandum does not qualify as a restricted appraisal report in accordance with standards 9 and 10 of the Uniform Standards of Appraisal Practice, US PAP. So it's a memorandum, and they stated that themselves it's not an appraisal. They didn't want to qualify and comply with Uniform Standards of Professional Appraisal Practice. Does that answer your question?
Yes, that's my question. The next question was, even though it's not a qualified appraisal, what's the conclusion of value for the personal property?
Eric Hussick for the petitioner. Would you like me to read from the?
Yeah, which page is it?
On page 245, the fair market value of the property, plant and equipment on a high end is 298 million. On the low end, it is 288 million. Sorry, 288,500,000.
Thank you. From the county, in your materials, is there an income analysis?
No.
Excuse me. No, Tom Walusick for the record.
Do you
No.
have any other than the cost approach which you applied and calculated 5% discount? Was there any other methodology you used to come up with, well, what would the market value of this be? What would a buyer in the market pay for this?
That will be some of my comments that'll be coming up. We don't believe that this particular type of analysis is particularly telling for this
Just
reason.
answer this question, please. Did you do it or do you have?
Outside of the
That was
obsolescence
question. Just
calculation
answer the
based on
question.
1,200 solar farms, no.
Thank you. I'm very disappointed.
So I think the county would like to complete its case and then we can turn it back over to the rebuttal.
How much time do they have?
I stopped the clock at 7 minutes and 27 seconds. So they have 7 minutes.
Tom Walusick for the record, that'll be more than enough. I wanted to clarify primarily the valuation issues that were part of this case. Valuation of the property interest requires a going concern analysis, which they provided also in their cash flow. As such, it's an after-tax analysis. This is a little different than our normal modus operandi. All of the following are considered: free and clear cash flow, meaning after-tax expense, after expenses, cash flow protected by depreciation, and cash flow protected by tax credit are all considered as part of the number. All these things are accretive to the ownership's position. I make that point intentionally. The property position that is assessed is the ownership's position. We are obligated under NRS 361.2273 to value the ownership's interest in fee, such as in a possessory interest, for example, where somebody else actually owns the land or other property, and it's leased by the party we are assessing. We value if owned in fee. This is important to understand because the investment tax credit can only enhance ownership's position, the position we assess. The investment tax credit is an incentive. It was started in 1978. The ITC has been used to promote specific policy objectives, such as the development of renewable energy projects in general, with photovoltaic solar projects being one particular type, but giving tax incentives that in fact far surpassed feasibility thresholds. The projects would not have been built without them. The tax incentive works to reduce tax liability, reducing taxes paid of the ownership. The investment tax credit increases the value to the ownership of the project, and therefore it cannot be, by definition, an obsolescence, which diminishes value. These concepts are mutually exclusive. NAC 361.344 defines obsolescence. Obsolescence meaning the lessening of value due to causes other than physical causes, and concludes and renders the property item less desirable. The appellant desperately wants you to believe that the ITC is or behaves like an obsolescence. It simply cannot. It increases the value of the project to the ownership. The ITC also cannot be traded. Based on rules starting in 1978, all of the benefits of the ITC inure to the benefit of ownership and the ownership only. It cannot be conveyed to a potential buyer. I bring these points up because there was and is considerable confusion at the base of the appellant's argument. In our last testimony, I postured the following example, and I quote from the transcript. If you follow the appellant's logic to its absurdly illogical conclusion, what the appellant is arguing is if the federal government decided to give a 100% investment tax credit, then all of their equipment, all of the $531 million of equipment providing energy over the next 30 years wouldn't have any value at all. And I felt kind of comfortable when I said that. Beyond my wildest expectations, they said in response, absolutely. Really? Let's think about that. The $733 million in direct cash flows, that's after expense, the $61 million protected cash flow through depreciation, the $159 million in nearly instant return on investment via direct tax liability reduction would have no value? Of course it has value. We know that intuitively. But the real question, and I thank them for bringing this up, was to whom? The appellant provided a cash flow analysis and used it to suggest we exceed full cash value. The reality? The cash flow is no more than an investment analysis of a hypothetical buyer's potential position in the going concern. An investment analysis for a buyer who is unable to purchase the full benefit of the ownership's position and value. For our purposes, it's ultimately useless. It does not represent the position we are assessing or taxing and cannot answer the question we'd answering. It certainly does not transmute through some alchemy from the going concern value, which they provide, to the contributory value of the equipment itself. In short, we completely agree with County Board member Glenn Anderson as he moved, and I paraphrase, I don't think we've seen any evidence here today that would indicate that the taxable value that the assessors come up with exceeds full cash value. We completely agree with the County Board of Equalization's unanimous conclusion. And based on all the proceeding, we recommend that the State Board of Equalization uphold the County Board's decision. We're happy to answer any question the board has. And I'll be happy to address your issues on the cash flow too.
They presented two discounted cash flow analyses.
Yeah.
And
Correct.
usually when information like that is brought to the assessors, you take the time to review it and usually prepare your own to support your position, to support what the taxable, the full cash value is. You didn't, or at least you didn't put that in the record if you did.
Tom Malusik for the record. No, we had discussed this entire cash flow, which is the same cash flow that was presented 2 years ago. And the board at that time also indicated that it did not provide the information necessary to provide any level of comfort in a full cash value analysis. Now let's explain why. When you're dealing with the going concern on this, there's a number of things in a cash flow that have to be identified, whether it's the income. In this particular case, it was a very elegantly done cash flow. There was no question about that. It had to do with the quality of the information that was being used as the inputs, even to the point of the renewable energy credit sales, which you would think they would use their own numbers. No, they had somebody actually abbreviate an estimation based upon the ABB and Wood-Mackenzie curves, all the way down to where it really got ugly. And that was the assumption of various discount rates, which simply couldn't be supported in the marketplace. And when we're talking about this, in some of these properties we hear on the board.
What were the discounted rates that they were using that you say would not be supported?
One was at 12.25%. Which, hold on, one comment.
David Denman with the Clark County Assessor's Office. I don't want y'all to think that we didn't do anything to determine obsolescence. We have applied obsolescence on some of these accounts where it's indicated. We went and looked at the Berkeley study, which is takes market data out of all the solar farms, and we calculated.
I understand what you did. I see that in the record, the Berkeley study, and I understand how you got to your 5% adjustment. What I'm asking about is the discounted cash flow approach, two models that were submitted by the taxpayer. And I didn't see in the materials any model prepared by the assessor's office.
That's because we felt that the market gave a better indicator of obsolescence than the discounted cash flows that were provided when we looked at them. The discounted cash flows provided take a lot of hypotheticals that the market didn't have to have applied to it.
Tom Malusik for the record. It's a good question. I appreciate it. I really do. It's just one of the examples in that cash flow. If you were looking at that cash flow, they ended up actually taking a going concern analysis for the entire property. And then they said, wait a minute, there might be some intangible business value in the PPA itself, the power purchase agreement itself. And then they did a kind of an interesting analysis, another cash flow on that, and said, wait a minute, if we take that information and we compare it to what market spot merchant pricing would be, here's this difference between the two. They discount that at a not an appropriate discount rate, and then they said, okay, that can be removed from the going concern value.
What would be an appropriate discount rate?
For that, I don't believe any. Here's why.
Well, you said that you didn't believe, you said you were concerned with their discount rate at 12.25%.
Yes, that's for the going concern. This is a different analysis.
What would your discount rate for a going concern be?
Considerably less, less. In that case, the weighted average of capital cost, okay, is typically at about 8.6, 8.61. That's from the National Renewable Energy Laboratory. And that is an average of 174 different pieces of different properties. An average, there are some more considerably less than that and considerably more than that. The difference on a 30-year cash flow of just 300 basis points is an astronomical change in value. But in this particular case, they actually came up with this hypothetical intangible value, which, by the way, my research into the market space, dealing with people who only value power plants, said they don't do that. It's an inappropriate method. So when we looked at cash flows, and believe me, Mr. Bancroft, I've had this discussion with my own staff, and that is that wouldn't it be great to just do a cash flow? Yeah, it would. And then we'd have our made up numbers and their made up numbers, and then we could see which numbers we feel better about. It doesn't answer the question at the end of the day, which is what is the contributory value of the hard assets that are producing power for the next 30 years? It doesn't get there. We'd like to believe it does. It doesn't happen that way. I did not feel that analysis to be appropriate in this case. We have to add that. Well, no,
You're
no,
fine. You can stop.
no.
Do you have any response to the comments you made about the discounted cash flow approach?
Eric Huswick for the petitioner. I would like to, I have a list of rebuttals related to their general statement, and I would like to just address them all kind of in that order if possible, because I think it's better for us that way. Can you confirm that they're done presenting? So they can close their argument?
Maybe they're not.
I'm sorry. Researching something else for Mr. Mitchell.
Mike Denver for the record. I believe the question was whether or not respondents' cases have been provided so that we're on the phone.
Let me just clarify. Again, my name is Tom Olisic for the County Assessor's Office. I've been appraising as a general certified appraiser for over 30 years. I'm a designated member of the Appraisal Institute. I have been living and breathing cash flows and reading leases for, well, a long time. So this is not a new phenomena for me or my analysis. Thank you. Include our testimony.
Thank you. Rebuttal?
Eric Huswick for the petitioner. I will try and go through this as quickly as I can. The county asserts that there should be an impairment to represent obsolescence, but that misrepresents how GAAP actually measures an impairment. GAAP measures an impairment by first looking at the undiscounted cash flows over the expected life of the asset. And if and only if the undiscounted cash flows are less than the carrying value, do you then look at the discounted cash flows? In this case, and this is shown on both page 23 and 24, the lifetime the undiscounted cash flows on this asset are in excess of $1 billion. It is just that the income is spread over such a long period of time. As Tom said, the value swings dramatically when you discount things over a long period of time, that the value is lower. So you fail the first prong. You don't even get to what is an impairment because you don't have an impairment under GAAP. So we would reject that argument. Again, as I noted in my initial response, it is a dangerous thing to say that a RETA goes away because you have obsolescence. The county, if that is true, and there is an adjustment for obsolescence, and they say that that becomes a tax exemption or tax abatement, and I think the district attorney's opinion said that tax exemptions are very strictly construed, which to me, okay, there's an obsolescence adjustment. Now you're going to say it's akin to a tax exemption. That's pretty dangerous and a slippery slope. But that would mean that any abatement is gone the moment that you have economic obsolescence, which can't be the right answer, and it's not what the county asserted here. So we reject that. I wanted to clarify that they said that there was a statement for what obsolescence we requested, and as I noted in my initial statement, we said that an obsolescence adjustment of less than 0.7 could be used, but we requested that 0.7 be used in relation to the ITC, but it would be simple and easy to provide uniformly. In regards to the 100% ITC case, the county potentially presents this as this windfall magical thing. The reality is that these projects have power purchase agreements. In this case, this project has 3 power purchase agreements with different off-takers, which is different than other projects that you may have looked at. But if there's 100% ITC, you would be signing those. Everyone bids on these things competitively, right? Every utility has a competitive bidding process for these things. If people were getting 100% ITC, the bid would be to cover your operating costs to maintain the plant. They wouldn't be this fantastical windfall that Thomas describes, because somebody would say there would be a race to the bottom. So that's just a hard one for me to square away. The county states that the ITC can't be traded, but then they talk about an ITC later. I don't know how to square them saying that it can't be traded, but then them saying it can be sold. Under the Inflation Reduction Act, you can actually transfer credits now. You can sell them. My company has done them on assets. So, I don't know how to square those concepts. The county purports that there is this hypothetical value done, or this hypothetical valuation done from the construct of what a buyer would pay. Well, the whole point of full cash value is what would it sell in an open and competitive market? No one would pay more than the expected cash flows of the project and their adjusted rate of return. If you tell me that we're in the business of losing money because we pay $300 million for $290 million in cash flows, I would be confused. I would say nobody really runs a business that way, because you don't run a business to lose money. So how could market value, or why would somebody in an open competitive market buy something at a value that is going to lose them money? I don't understand that argument. And then in regards to the discount rate, on page 245, the implied rate of return on this project is actually a 10.1%. The 12.25% is a loaded merchant concept. So it is a concept where you try to discount and factor in what your cash flows would be when you don't pay property taxes, but you're trying to account for value with some function of property taxes line. So I just want to make sure that we are not misrepresented in value there, that we're using the KPMG was using 12.25%. KPMG actually uses a weighted average where the midpoint that they use implies a blend of the 12.25%, 8%, and 9.75%. And that's, so to say that then that averages 10.1. Is that higher than the county's assertion? Sure. The county usually looks at a project that has a 20-year busbar PPA. This project has 3 offtake agreements, one with Glendale Water and Power, one with Valley Electric Association, and one with Boulder City. And all of those have different contractual rights, including one of those contracts having a fixed shape and volume, which means we don't just use power from the solar and the battery to fulfill that contract. There are quotas of what needs to be renewable, what needs to be low carbon, but we have exposure to general market prices, which are not there to buy power to fulfill that contract. That is not a standard down the line busbar PPA that Berkeley Labs bases their analysis on. So I just want the record to show that this is not done using a 12.25% discount. And the values that I read earlier provide a 9.5% discount which is on an asset that is more risky than other assets in our portfolio because it has multiple PPAs with different contractual rights, different counterparty and investment risk, as opposed to one investment grade busbar utility such as NV Energy. So to me, there should be some adjustment to the discount value for a riskier counterparty and a riskier revenue contract. And finally, the county brings up the Berkeley Labs analysis. But all of those costs imply that somebody is going to be able to get and monetize or trade a credit. Their assumption is that something is that the discounted cash flows and what someone will build at gets the credit and monetizes it. Whether it's for their own balance sheet, transferring it to a third party, entering into an agreement where a bank monetizes it for them and funds into the joint venture. It's a very complex, nuanced thing. So I guess I just look at it and say our DCF is tailored to our revenue contracts. It's our best projections of what we think power markets are going to do, our contracts for O&M, our contracts and our costs to the best of our knowledge to forecast the project. But again, it is our PPAs, not some actual PPAs that apply to this project, not some theoretical busbar PPA that somebody can get that has much less risk. And I was a bit confused by the county's argument that there's no appropriate discount rate. I think the state actually publishes cap tables or discount rates that are in line with what the county presented for a small or a large scale utility. That's a diverse portfolio of assets across multiple generation types. That's not a single asset it doesn't have it can't diversify its risk across multiple assets. So a higher discount rate is warranted. But I think that our discount rate or our valuation and the valuation done by KPMG on behalf of the project reflects the actual economics of the project and reflects our best knowledge of our best projection of future revenue.
Anything further?
No, that's it. Thank you.
Questions from the board?
I'm trying to understand why they're taking the offtake agreement out. You didn't enter into the offtake agreement just for fun. You did it because you had a solar farm. So I'm trying to understand how that's separate.
Thank you for your question, Board Member Caldwell. One of these PPAs was actually active dating back to 2019 and was filled with commodities traders such as Morgan Stanley. So this PPA was in place and the project contracted with Morgan Stanley or other commodity houses to fill the fixed shape requirements to perform the PPA before the project was built. But I would generally agree with the county that, yeah, a fair value would be, let's look at the market price and let's look at the actual production of the project over its life. And let's look at that as what this would be built in a non-ITC, non-PPA world. But again, the ITC here provides real value. We would not, that is gone as of the initial date. The credits can't be sold again. They can only be generated again if you were to rebuild the plant, but that's a whole separate discussion. So if I'm sitting here on a lien date subsequent to the project being placed in service and the credit being earned, that value's gone. I can't get it again. I can't recover it from anywhere else. It's a one-time thing. And if I am doing M&A, which I've done at this company and I worked at when I worked at Deloitte, no one is buying things that don't exist. No one is saying, hey, I'm going to pay an extra amount for this thing because they got a credit for it. We pay less we would pay less than what the discounted cash flows say because there may be some risk of someone suing or something like that. And that all gets factored into our value. But Revon is, through the funds that it manages, has bought projects. And those projects don't say, hey, we're going to pay you for the ITC that you claimed got the benefit of, seller. We're buying the go-forward prospective value that we see based on our understanding of the revenue and expenses and a variety of other economic interest rates, things like that.
You answered your question?
Yes.
You have any other questions? Come on.
No.
Questions, comments?
I will make a comment. I struggle with the, I mean, I was around when we made the decision on the 30% thing. And, so what he was just talking about, I just struggle with, you built it 500 million immediately after you built it with 30% credit. In theory, it's worth 350. But, that's ownership taking the money out of the business. And I do struggle with that. I don't know how you deal with it because the future value of it isn't there once the credit's gone. So it's done. I mean, that's tough to, it's tough to get comfortable with. Sorry, I do have another question. In your own cash flow, what's the negative in the revenue section? It's some purchase commodity or some purchase commodity. Yeah.
Eric Huswick for the petitioner. Board Member Cadwell, that is the requirement under the PPA to buy power when the project is not operating. So this project is a paired solar and battery project, but it is designed as a 4-hour battery. So those negatives, or what we effectively, it's analogous to cost of goods sold, right? If you were to treat energy as inventory, that negative is to buy the inventory that the project can't produce.
So why would that detract from the value of the assets then? That sounds like a business decision that was made that's not necessarily, to me, it doesn't have any, that's management's decision on how to run the business, not the value of the asset. So I don't understand why that comes off.
We look at this as a unit. We can't fulfill the intent of signing these agreements is that they would be fulfilled by a project, but there are concessions in certain agreements where it was not expected that the project would be able to fulfill that. There were delays on this project, which is why it didn't start producing power until 2021, but the PPA was signed earlier. So I guess I understand your point that the economics of the PPA are not the value of the project. However, KPMG's appraisal looks at this on point and says, what would this project produce on a go-forward basis based on a market analyst's projections of future income that the market generally accepts? And they came to a value that is similar to the values that we came to our conclusion. Because they said that the value was between 288,500,000 and 298 million.
I think a simple way to think about that would just be if somebody bought this project, they would also have to go buy that electricity to fill the PPA. So it's a requirement for anyone purchasing the project. They would have the same requirements to buy it. So it's basically like inventory or some other type of operating expense.
So you're telling me all the agreements on the offtake are tied to the assets then?
Right. That
somebody couldn't just buy the assets.
No.
That is correct. There is one PPA that allows for flexibility, but it is my understanding that these PPAs do require the power to come from a renewable source such as this asset. And potentially one does specify this one singular asset.
Yeah, that's a requirement of the NV Energy's PPOs.
Yeah. I have one myself. It's a little tiny one.
Any other questions, comments, concerns? Anything else? Go ahead, sir.
Eric Huswick for the petitioner. Obviously, as I made in my initial statement, we proposed a very simple way to build onto the replacement cost analysis that can be uniformly and easily applied to solar projects. I would be thrilled if you accepted our $305 million and $285 million valuations for the relevant years. But I wanted to use this as an opportunity to create a standard that is easy for everyone to follow so that I can make continued investments in Nevada, whether it's with NV Energy or other utilities, and build projects here. And I have certainty that I know how something is going to be treated, because the volatility is not great for our business.
Yes, sir, I agree with you. That would be nice.
Excuse me, sir, could I make a comment on his comment?
What?
It's real quick.
No, I was hoping Tom would do it, but go ahead.
David Denman with the Clark County Assessor's Office. Every April, there is a personal property manual workshop. In my opinion, for his methodology to be an acceptable methodology, it wouldn't necessarily be the state board that would adopt that. It would be the Department of Taxation through their personal property manual workshop, which gets approved by the Nevada Tax Commission.
Thank you. Good idea. Where are we? Come on, somebody do something.
I just want to, my observation is that we have indications, in was it Deloitte Touche?
Erica, KPMG.
KPMG, in the KPMG, I won't call it an appraisal, but the KM
Memorandum.
in their memorandum, they suggest that the appropriate value is at the high end is 280 million. The discounted cash flow approach prepared by petitioners suggested a value of 285 million to 308 million. The owner's opinion of value on the completed form suggests it's the appropriate value would be 375 million. So I think we have 4 indicators out there that are telling us that full cash value is less than the taxable value as assessed. That's concerning to me because usually when evidence is made available that full cash value is less than taxable value, we see some type of analysis that's based on an income approach or comparable sales from the assessor's office, which shows that supports their valuation. We don't have that in this.
You mean how'd they come up with 504 million?
Well, that's how they I know how they came up with taxable value, but usually they then do an analysis to support that taxable value.
Yeah, usually they would. If you had somebody appeals a house on a cost approach, they would come in and do a market, sales comparison approach, or an income producing property to do an income approach. So we're wondering why they didn't do that.
Yeah. Well,
I know there's no sales. That's number one. There's no sales data. There's nothing to compare it to, but I think they could have done an income approach.
Mm-hmm.
So I'm not going to do one on the back of a napkin, but no. So I just think that something that was valued at 500 million is worth half of that because the federal income tax credits are gone. I just don't buy that. I don't see that. They could go that low. So where's the value?
Well, what I believe the petitioner is suggesting is that that would be what is the logic about the owner's opinion of value of 375 million. That once it's built, you can't sell it for more than your cost less than the 30% tax credit. I think that's how they got to their 375 million.
To the 375?
Mm-hmm.
And it's the 375 is 30% from the original, from the pre-discounted Clark County number.
Is that value after Clark County's already deducted some obsolescence though?
No, because it's not 30%. It's only 20 something.
No, but I believe they applied some obsolescence to their number. So if you give them the 30% obsolescence plus whatever Clark County already gave them, That would be extra obsolescence,
The-
right? When you go from the replacement cost.
The taxable value that was assessed is not, they had already taken a discount off that, and the 30% they're using to get to the 375, I believe, is off of the original number, which was 470 odd or whatever.
If I may, it's 498,992.
Yeah.
It would be bad methodology.
I'm sorry, where are we? What would you say? 40?
Go to page 42 and there are the numbers there.
291 page document?
Is it a,
It's 291, exactly, sir.
That's just got, it has your values there for 22, 23.
That is correct, sir.
Acquisition cost, replacement cost new, taxable value, adjusted taxable value because the obsolescence, which was the 11% or so. What was the obsolescence based on?
The obsolescence was based on a study by Berkeley Labs on over 1,200 solar farms. And contrary to testimony here today, Joachim Sekiel, who's actually the PhD, I speak with him frequently, actually made sure that the ITC was outside of the total installed costs that he collected through the Energy Information Agency on Form 860. So this is what things actually cost. We were able to identify a 78% reduction in replacement cost new over 10 years. We, at that time, had to use the 30-year table that we had. That's where you get the first column in there, which is the percent good via the prepaid manual. And then we calculated an obsolescence that was greater than that and applied it to that number itself. That's where those numbers come from.
So,
so the appellant's value though, RCN is 535. You guys adjusted it down to 444. When they go to 375, they're taking 30% of 535, and that's where they get to the 375. So they're not starting from the already reduced number. They're starting from the original gross RCN number. Correct?
Correct. The 30% reduction is off of the original cost.
Yeah.
I'm not buying that. Any other questions, comments?
And the petitioner, I mean, can we comment or are we done? It's on your call.
Okay, Tom, go ahead.
I appreciate that, sir. This is a very complex case and I appreciate
Oh, they're
that.
all easy today.
No, sir. I don't believe so at all. There's another aspect to this that has directly to do with the ITC. And I think we need to take that in consideration. One of the reasons why I did not
Could
do
you
the
speak up, please?
I did not do the cash flow. What you have here is that the FCV, full cash value, is a test in an open competitive market between a buyer and seller without due influence and on. And I don't think that's really appropriate in this case. Allow me to explain myself. Federal regulation does not allow or didn't allow until very recently this ITC to even be moved at all. The interesting thing is it's a federal regulation that has the force of law for all states across all jurisdictions because it's a federal tax involvement along that line. This creates for us as an appraiser essentially what's called a jurisdictional exception. Typically, we would try to come up with a full cash value number and test our own depreciation along that line. The reality is that because of the jurisdictional exception, the definition of full cash value really can't be applied here because the number you're talking about or that has been purported to be full cash value isn't the value of the property. The ownership has that value, not the prospective buyer that gets cheated out of what they could possibly do. That doesn't really work with this type of a thing. Some of this has to do with definitions of value themselves.
Okay. I think we're getting into a tangent.
Thank you. Down a rabbit hole, I would
No,
say. Okay.
it is a rabbit hole. It's not a tangent.
Okay.
I'll put a motion on the floor. People may like it or they may not. I'd move, based on the evidence in the record, there are indications that full cash value is less than taxable value. Those indications include the accountant's memorandum of valuation, the discounted cash flow approaches presented by the petition. They're demonstrating that full cash value or indicating that full cash value is less than taxable value. The owner's opinion of value is 375 million, which is higher than those indications of value. I'd make a motion that we reduce the value to the owner's opinion of value, 375 million.
I'll second it.
We have a motion to reduce to the owner's opinion of value, approximately 375 million. We have all those in favor indicate by saying aye.
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 Aye. Motion carries. Thank you.
Thank you, board.
Next item, we're gonna jump to, sir, what petition do you have? Yes, you. What? Pinto Lane. Dear Pinto Lane? Pinto Lane, that's you? Oh, no. Who is 106? Is it 106? Okay.
The petitioner in 106 is on Zoom.
It's what?
The petitioner in 106 is on Zoom.
On Zoom, okay. 106. 107. Petitioner here for 107. I'd like to move along to Fort Apache townhouses then. Yes.
Oh, there you go. Then, all right, you can take them over that.
Has your client been sworn in? Yes, he was. Thank you. Yeah. All right. Assessor's office, who's handling Fort Apache townhouses, 112 and 113? We have introductions, please. Assessor staff.
Marquise Payne with the Clark County Assessor's Office.
And Karen Slaughter with the Clark County Assessor.
Vince Shetler, the owner, 9521.
Do you mind spelling your last name, please?
SCH.
Thank you.
Jim Suso, the DeConcini Law Firm representing Fort Apache LLC.
The assessor's office familiarize us with the property, please.
This appeal is for there's actually two cases. Are we going to be hearing these together? As we did in the county hearing?
We have no objection to them being combined together.
They'll be combined.
Correct.
112 and 113.
Correct.
Apache Townhouse LLC. Go ahead, sir.
Okay, so the subject of this appeal is a 79 lot subdivision owned by Fort Apache Townhomes LLC, consisting of 1 and 2 story townhomes with 3 different floor plans ranging from 1,051 square feet to 1,642 square feet. The subject is located near Fort Apache and Serene in the Southwest Valley. The development is a rental community in which the appellant owned 3 parcels, combined them into 1, and then individually parceled the lots. There was no website found for marketing of the community, so amenities are not known other than a clubhouse. The subject potentially qualified for a subdivision discount to the land So you will hear analysis regarding that, as well as analysis completed for the retail lot value, the full cash value of each individual model, bulk sales of single-family residences, as well as an income approach. Total taxable value of all 79 parcels is $27,891,826. Individual parcel values range between approximately $304,000 and $377,000. During the county board, the assessor made a recommendation to reduce the base lot value from 100,000 to 90,000 based on 3 comparable neighborhood stats showing our land value exceeded market value. This base lot reduction resulted in the total taxable value reducing to $27,101,826, and individual parcels values dropping between the range of approximately $294,000 and $367,000. These values were upheld by the County Board of Equalization, and it decided no other discounts or reductions were warranted. The parcel details can be found on page 73, showing the reductions of the individual parcels so that they can easily be identified.
Thanks for identifying the property. Yeah, freaking cake. Go ahead, Mr. Souza.
That was half the freaking case. So I'll kind of be short because I know we lose the room at 5 and I certainly want to be done. This case is a lot easier than my first case, and it's a lot easier than the case you just heard. The county's at $28 million. As they said, they took each parcel and assigned a value to it. Our opinion and value is $21 million because the property should be valued based on the income approach. The statutes allow for the parcels to be reviewed on a collective unit. And I'm reminded of a collective unit appraisal one Tim Morris did for my clients at Turnberry for the signature towers. And it is an absolutely acceptable methodology using income under the statutes to determine a value. One of the reasons that the assessor's value is wrong is because they got the law wrong repeatedly, and they continue to recite that to the County Board of Equalization. The assessor has not filed a response to the petitioner's opening brief that we filed. I hope you had a chance to review that. During the hearings, and I'm citing from SBE page 231, Mr. Payne, who was actually very nice to work with, said, I do not want to just emphasize that again. These parcels are individually parceled that can be sold at any time. That was followed by Melody Garfield on page 233. These are individually parceled. They can be sold individually. That was followed by Ms. Slaughter on page 234 saying, and they can sell them when they want to sell them. All of those statements are incorrect as a matter of law. And as Mr. Shetler testified at the County Board of Equalization and has not been refuted by the assessor in any briefing they filed because they filed none, none of these lots can be sold as a legal matter. And therefore the assessor's valuation as individual lots fails because the premise is they can all be sold individually. So there is no argument about could one townhouse sell for 300 and whatever the number is. It could, but it can't until certain legal requirements are met. And Mr. Shetler is going to talk about that. At the end of the day, the assessor's at 28, we're at 21. Our 21 is based on income. And as I put in my briefing and my appeal letter to the county board, that is the net operating income projected by Mr. Shetler at a 6.0 to 6.5% cap rate. And he will explain where that comes from. And it's the midpoint between those two. So we're not asking for the lowest. We're not asking for the highest. We're asking for the midpoint. I would point out also that the county did an income approach using apartments. That's on SBE page 222, where they arrived at a net operating income pretty darn close to ours. And if it was in fact capped at 6.5%, it would also be at $21 million. So we're not here asking for a couple $100 million in taxable value to be reduced. We're here asking for 7 million between 28 and 21. So moving quickly forward, given the time, Mr. Shetler, I'm going to ask you some wildly misleading questions. I'm sorry, wildly leading questions, and ask you to give me an answer. First, identify yourself for the record. So,
Vincent Shetler, Schettler.
all right. And is it accurate to say that you've been involved in developing property in Las Vegas Valley for 30 years and you've developed a little bit of property like $4 billion worth?
That's correct.
All right. As part of this long development history, is your practice to evaluate the profitability of proposed projects, and this involves making an estimate of expected future cash flows, calculating the project's fair market value, and then getting investors interested in the project.
Correct. Yes.
Keep going. What do you do?
I've done, like you said, about $4 billion involved in developments around town as either an owner, mostly as an owner or a partial owner or co-developer. And we do a lot of land development, and performing out each development is done on every time we acquire a property. When we develop a property such as this one, this is a ground up construction development. We have to account for cash flow, cap rates, and return. And so we go through a myriad of analytical steps to put that pro forma together, part of which is a cap rate and the market conditions.
And as part of this process to obtain construction loaning and then later to get permanent financing?
Yes.
Okay. And so as part of that, you have to present this information to people with the money who then decide whether to provide money for your project. And have they accepted your projections for the various projects you've developed?
Yes, and I did receive a construction loan about 3 years ago.
When you were considering developing Serenity Townhomes, and that's the name that it goes by, did you go through the same process of expected cash flow and then obtaining lender approval?
Yes.
Okay. And the project was built according to that?
Yes.
And when you did that study, how did you determine what the cap rates were to the expected cash flow?
Basically market driven. It's knowing what the buyers were ready, willing, and pay at any given time. And we always have to do a forward looking exit cash flow and try to pinpoint where the cap rate will be in the future.
And so on this particular project, what cap rates did you look at?
When we were developing it, we probably used a 5% cap rate, 5.25% cap rate at that time.
And what's that today?
Probably 6.25.
All right. Let's talk about the legal restrictions on the actual use of the property. So at the county board, you testified there was testimony that any one of the Serenity townhomes could be sold on the two valuation dates, so July 1, 2024 and January 1, 2025, because we have both a supplemental and we have secured roll valuations. Do you recall hearing that testimony?
Yes.
Is that accurate testimony?
It is not.
Why is it not accurate testimony?
Because we could not be, when we did our entitlements, we went in with the project as being one cohesive unit, one seller, one owner. We were not required to do a homeowners association because it was always intended to be a for rent community. So the county did not require us to do a homeowners associations and CCNRs for our project. In order for us to sell these, we would have to go back in and record those documents, record CCNRs, go back through the county, do that process and record documents accordingly.
Okay, so because valuations are done on specific dates and what it looks like on those specific dates on July 1, 2024 and January 1, 2025, is it your testimony there could not legally be the sale of any one of these townhomes?
Correct.
Thank you. All right. Is it accurate to say that Serenity Townhomes has multiple competitors in the rental market? And these include apartment complexes as well as other rental community, condominiums, townhomes, and single family residences?
Correct.
And why is that?
Can you repeat the why is what?
Why is it that you have all these competitors in the market?
Well, there's a demand for rental communities. We have a unique product type where, and it's a newer product type where you have townhomes that were built for rent, specifically with the intention of building them and holding them and renting them as all one cohesive unit. They're a little bit different than apartments. The only real similarity is that they're both for rent.
Okay. So Serenity was partially vacant on July 1, 2024, and then we're fully occupied on January 1, 2025. Despite not being full on January 1, 2025, is it accurate to say that the financial performance of Serenity matched your projections for all 2025 that were the basis of your position for the entire project being worth $21 million?
Correct. Yeah, it was partial.
Okay. And in December of 2024, it was 86% rented and you had NOI of 705, is that right?
Correct.
Okay, and your expectation in the actual stabilized income performance is 95% rented, and you projected an NOI of 1,350,000 for all the NOI for the year. Is that accurate?
Correct, that projections.
Okay, so the 112,500 a month in December 24 is almost dead on, 1.35 million for the whole year.
Very close, yes.
All right. He testified at the county board that Shirley was put up for sale today, would have to be a rental community. In that event, the potential buyer would evaluate the cash flow and the reasonableness of your NOI projection. He further testified that the buyer would look at 6 to 6.5% cap rate. Can you tell the board how you came up to the conclusion that you testified to the county board of 6 to 6.5% for January 125 and July 124?
When buyers buy properties like this, they base it on current capital cost and financing, and it's based on multiplying that by multiple against the NOI. And so my opinion that the current market conditions in both of those dates, buyers would be ready, willing, and able to purchase that property for right around 6.5 cap rate.
So in 2022, things were a little more robust in the rental community. Is that true?
Yes, very
And
much so.
cap rates also at 6.5?
No,
What were they at?
they were closer to 4.5 to, sub 5%, but somewhere in the middle of 4% range.
And since 2022, the market conditions for rental properties has degraded to the point where you have a higher cap rate now.
Correct.
All right. There's more competition for rent.
Yes.
Are you giving away concessions to get renters?
Yes.
All right. The assessor prepared an income analysis, which is on page 222, and which they looked at a net operating income of $1.4 million, so slightly more than your $1.350 million. You remember that analysis?
Yes.
The assessor then applied a 4% cap rate to that NOI. Do you remember that happening?
Yes.
At the county board, you testified that that cap rate was first not apples to apples because it was an apartment complex, and second, that it was quite stale given the current market rates. Do you remember that testimony?
Yes.
And why did you give that testimony? What was your basis for it?
Because when you hear about a 4% cap rate, it's just not realistic at any, historically here for a very short period of time, like 2 years, we had compressed cap rates because money was basically free from the government, with very little spread between the borrowing rates. And so we had a very short period of time where 4% was very unrealistic. And my memory was that those comps were from 2022 and not 2024. And so they're very unrealistic and not representative of either of those dates.
Okay. So
Much more, Mr. Souza?
Yep. Oh, sorry.
I'm going as fast as I can.
I know, but.
Okay, then we have nothing more. That was all the information I needed to get at.
Okay, go ahead, assessors office.
Okay, so,
Let's just get to the value, okay? How you came up with the value? I mean, they're asking for, 21 and you're at 27, so.
well, there were a number of different analyses that we completed to confirm whether or not we were exceeding full cash value. So
I'd be particularly interested in hearing you explain your income capitalization approach and your bulk sales of bulk homes.
Yeah, if I may, this is a complicated case and I don't want it to get rushed because we have a time constraint till 5 p.m. and not have us be able to put on our case that we have worked through.
You have 15 minutes.
okay, so let's go over the analysis that we completed for the retail lot value. Land values for a subdivision are valued by analyzing a subject's improved sales within a subdivision and allocating a percentage of that sale to the land. Allocation percentages can vary depending on location, size, and age of the improvements. When a subdivision does not have enough improved sales, we will look at a neighborhood with similar characteristics as a subject neighborhood to determine a land value. And because this subject is a rental community, there are no sales. Therefore, the land value was determined based on an allocation using 3 comparable neighborhoods. And those can be found on pages 78 through 80. The median of these 3 neighborhoods indicated a value of 90,000, and that's why we reduced the base lot value from 100,000 to 90,000. Again, this potentially qualified for a subdivision discount as well, so we looked at that. Upon receipt of the appeal form, the assessor requested the petitioner fill out the application for a subdivision discount. Mr. Sousa did provide all requested documents to complete the application, so we looked at all three methods that the NAC allows us. And we determined that the subject parcel did not qualify for a discount. The most relevant and appropriate method for this determination is the absorption method, which is found on page 93. The absorption rate from leases provided by Fort Apache Townhomes indicated that the development should have been fully absorbed by March 2025. As of February 6, 2025, according to lease information provided, 8 of the 79 lots were listed as unoccupied, which would disqualify this development from receiving a subdivision discount. The development cost method indicated our recommended land value of 7.1 million or 90,000 per lot is less than the subject value to the developer of approximately 8.1 million, 112,000 per lot. If you would like for me to go into this analysis in more detail, I can, but again, based on absorption, this subdivision would not qualify for a subdivision discount. And regarding the third method, which is the bulk lot method, there are no bulk lot sales compared to the subject. Therefore, this method is not a valid determination for a subdivision discount. We also looked at the full cash value of each individual model in the community to ensure that it is not exceeding full cash value. The analysis for unit 1 model, the vicinity map and property record begins on page 97. Current taxable value for this model is $304,249, and 10 comparable sales within 2 miles have been provided, indicating a value of $344,000. With the assessor's recommendation to reduce the base lot value down to $90,000, this brings our taxable value down to $294,249 or $280 a square foot, which is below the indicated value of $344,000 or $327 per square foot. Analysis for unit 2 can be found on page 101. Comparison sales have been provided for that as well, indicating a value of $391,000. Again, with the assessor's recommendation to reduce down the base lot value, this brings our taxable value down to $342,343 or $225 a square foot, which is below the indicated value of $391,000 or $257 a square foot. The third analysis for unit 3 can be found on page 104. Current taxable value for this model is $377,211. And with the 10 comparable sales provided are indicating a value of $419,000. Again, with the assessor's recommendation to reduce the base lot value down to $90,000, this brings our total taxable value down to $367,211 or $223 a square foot, which is below the indicated value of $419,255 a square foot. The assessor also provided 6 recent bulk sales of single-family residences. A summary of these sales begins on page 237. The purpose of this analysis was to determine if a full cash value of rental communities that sold in one transaction is less than the taxable value of those parcels sold. For each of these 6 sales, the average price paid per parcel is more than the average taxable value per parcel. The most relevant of these 6 sales would be sale number 3, as all parcels in the sale were in one community and also built as a rental community, while the other sales were a portfolio of parcels in various different communities. The average price paid per parcel for this sale was $411,097, and the average taxable value for these parcels was $408,582. Therefore, our value does not exceed market value for bulk single-family residences sales and confirms the purpose of this analysis, which is to look at when a portfolio of properties sell, is that sale lower than what our taxable value is, which in this analysis, that answer is no. During the county hearing regarding the appellant and individually parceling these lots and their ability to sell them individually, the developer, Vincent Shetler, stated they're not allowed to be sold individually because we don't have an HOA. After speaking with an HOA manager and attorney, we were advised that Mr. Shetler's statement is factual due to the community being gated. On average, depending on the motivation and thoroughness of the process, it could cost approximately $10,000 to have an HOA and CCRs established and put in place within just a few months. Mr. Scheller also stated it's actually a requirement to map them individually, and so it's not a choice when you're doing townhome product. And after speaking with Mark Donahue, principal planner in the county's comprehensive planning department, Mr. Scheller is correct in stating it was required to map them individually if building townhomes, but that was due to the RUD zoning guidelines that the parcel fell under. The developer was not allowed to build a multifamily dwelling as currently constructed under the RUD zoning because a special use permit for that zoning allowed only up to a triplex structure. And this condition/restriction set by the zoning guidelines could not be waived or varied. With this zoning restriction, the appellant submitted a map to parcel the one lot into 79 townhome lots, which theoretically can be sold once an HOA is established and CCR is recorded. The county's comprehensive planning department defines townhomes as an arrangement of attached single-family dwellings. If the multifamily guidelines for RUD zoning did not allow townhomes and only allowed up to triplex dwellings, why would the assessor value these units as anything other than what is zoned for and what they are, attached single-family dwellings? If the appellant's business decision to go forward with building townhomes and renting them instead of selling them, that does not negate the fact that these are single-family residences and not a single economic unit. This is why we feel valuing this community as a individually parceled townhomes is the most appropriate method of valuation and not as a single economic income-producing property, which the county board upheld. But to further review this rental community for exceeding full cash value, we have looked at it as income-producing properties and a gross rent multiplier analysis has been completed. The GRM analysis for 16 comparable townhomes for lease can be found on pages 108 through 111. We took the market value of each of these townhomes, divided them by their annualized rent to develop a median GRM of 15. We then took that GRM of 15 and applied it to the annualized rent to all 79 townhomes in this subdivision to come up with the value. We also tested this with a low-end GRM of 14, as well as a high-end GRM of 16, and all values using 3 different GRMs exceeded our taxable values. I will now hand this over to Ms. Karen Slaughter just to highlight and reiterate a few key points.
How much time remaining?
5 minutes and 40 seconds.
Thank you. I do want to go back to some things that were brought up.
Oh, wait a second. I'm sorry. Stop the clock for a second. You're referring to particular pages in here. Are you referring to the document that is 25-112, the 248 page document?
25-113 would be the PDF.
The difference between the two cases, one is supplemental, one is secured. The supplemental case is only.
No, I don't want to go into that.
Okay.
But I can't find the page he's talking about. So I'm on the wrong pew again here. I'm sorry.
Okay, it's case 25-113.
113. Well, my machine went crazy when I started pulling up more of these files. I don't have any memory left. Anyway, start the clock again. Let's go.
Okay, the real argument here is, do we value these as one economic unit, multifamily, or do we value these as individual parcels as they are, as they were parceled, as they were built? The decision to rent them is a business decision. There has been testimony that says they do not have the legal right to sell these individually. This was brought up at the county. This is on SBE 267 where this was asked by Ms. Petra Latch. There isn't a deed restriction on this that disallows these from being sold. And Mr. Sousa responded, no. This is not deed restricted. This is only from the lender covenants. And this is on page SBE 267, Mr. Sousa's response. No, they're covenants with the lender. So once that loan is satisfied, of course, they could sell these individually as they wanted as soon as they put in an HOA, which again, that was also brought up at the county that this may cost $10,000 to put in an HOA to sell these. This property was not allowed to be built as a multifamily. It wasn't allowed through planning and zoning. It was required to be single family, multifamily only up to a triplex. No, they could not have built this as a townhouse community on one parcel. It wouldn't have been a townhouse. It would have been multifamily, which wasn't allowed. So they were required to build single family because that's what's allowed. It does not make sense to bypass the zoning requirements and now value it as a multifamily. This is a single family community. And we did look at this to see if portfolios of single family residences that are sold as a portfolio from a rental community, if we are exceeding full cash value. The assessor is required to value property equitably. We have valued these equitably with all other townhouses in the county. We've put the land value based on sales of townhouses. We've looked at that, compared that to other properties. And then we did the improvements as the replacement cost new, less depreciation. Now, as it's brought up in an appeal, we're required to look at this to see if we're exceeding full cash value. And we've looked at that in any way that we can. When we look at, and Mr. Sousa didn't like our gross rent multiplier because he said it was onesie twosies. That's from the board, onesie twosies. Well, we can look at the bulk sales, and when we have, and I'm going to refer you to that page, 271.
Is that 237? I'm sorry to interrupt you. Go ahead.
No, thank you for reminding me. We have 6 sales of portfolio rental properties. Most of these are portfolios of properties where one company owns multiple properties in multiple different communities, and they sell them as a portfolio. Again, looking at a company selling a portfolio of sales, these properties have not sold below what our taxable values are. So we're putting taxable value on those, the same that we did on this property, where we're looking at the land based on allocation, setting a value. And then we're looking at the improvements, replacement cost new, less depreciation. And have we exceeded full cash value where someone goes in and pays for these on a bulk basis? The best, again, Mr. Payne testified to this, but the best sale is sale 3, because this was one community. It's in the same area as the subject. They are not townhomes, but they are single family. The subject is single family townhome. These were single family detached dwellings. Again, those sold for 48 million, total price sold at 48 million. That was in July of 23. The 24-25 values on that was 47,804,000. We are not exceeding full cash value when we value these as single family and they are sold as a portfolio.
Anything further? How much more time do they have? 30 seconds?
55 seconds.
And looking at all townhomes in the southwest part of the valley, there's not one townhome that has sold for less than 400,000. We have values on these particular units or these particular projects as from 294,000 to 367,000, and we don't find one townhouse that sold for under 400,000. I just want to end with saying, quoting Mr. Shetler, that says, these are different than apartments. They're only the same in that they are rented. And when we look at a rental community, that's sold in bulk, we are not exceeding full cash value.
Rebuttal?
Thank you. Some interesting comments. It seems that the county has now realized that they cannot sell any of these despite the testimony they presented to the county board. And then they said, but you could just go out and put an HOA in and that would all make it better. And then you could individually sell them. But the problem is we have valuation dates of July of 24 and January of 25, and they could not be sold. So what we could do in the future might be applicable to a valuation date in the future. But here's what we actually had on site. There's been no objection to the county going through their normal procedures to determine the taxable value. The objection is that that value exceeds the fair market value of this property. And any competent appraiser would look at a collective unit of 79 townhomes and say, how would you value that? Answer, based on income. What's it producing? What's it cost to produce it? And the people that are actually doing that work are people like Mr. Shetler, who have done it for 30 years, got lenders to agree to it, hired fee appraisers at times when necessary. And Mr. Morris, I'd have to say, if I hired you to do this, it seems likely you would also use a collective unit, look at income, come up with a value, and then divvy it out on 79 different parcels. That collective value is an accepted methodology in Nevada for determining values, and income is an accepted methodology for determining fair market value. What the assessor has produced would not work to determine fair market value because none of the information that would be required is actually contained within it. They talk about, sale number 3. Well, they're not townhomes, they're single family residences. And what was the rent that those single family residences were receiving? How big were they? What were the operating costs? When were they built? Do they have 2-car garages? Are they detached? None of that information is there, except there's a $45 million sale. So therefore our numbers are good. It doesn't tell you anything about fair market value. These are townhomes. They produce income. Mr. Shetler's an expert in developing townhomes. This would be the NOI produced by them, either under the assessor's document on SBE 222 or our document on SBE 31 to 34. The NOIs are pretty close to each other. You put the right cap rate on it, you get about 20 to 22 million. We asked for 21 million, and we'd ask the board for that value.
Thank you. Questions from the board?
Does it surprise you that I have a question?
No. Go ahead, ask a question. Let's go.
Karen, are you leaving us? No.
Oh, what are you bringing in the first string now, huh? Oh, come on.
I would love to talk about the
Okay, wait a minute. He's just asking a question here. I'm out of memory. Go ahead.
Well,
What's your question?
My question is about the income.
I know.
Because they covered all the other approaches. They didn't discuss their income approach, which is in the materials.
So what I would like to say is we did
Would you
do
introduce
the income
yourself for the
approach.
record,
I'm
please?
so sorry, Melody Garfield with Clark County Assessor.
Were you sworn in?
I was sworn in from the beginning, 9:30, right here. What we talked about on the income approach, Karen and I are both residential evaluation specialists with the International Association of Assessing Officers. I've been doing residential appraisal in the fee world for 20 years before I came to assessment. Karen's been here for a very long time. These are residential properties, not multifamily properties. They're single family residences. Fannie Mae, USPAP.
Okay. The question was about the income approach.
Yeah.
It's the GRM. Did you see the GRM that we prepared?
In case number, the first case,
You know what
112,
page
it's at page 222.
So what happened at the board, which I think is relevant,
No. don't go
because,
there.
well,
I want this to
I'm
be
sorry,
clear.
would you please just listen to the question
absolutely,
and only answer the question?
yes.
Thank you.
I'm looking at case 25113. What page does the income analysis appear on in that?
The income analysis is appropriate for this case is the GRM analysis, which is on page.
Okay,
Page what?
let's go to the other one.
Page 108.
Let's go to case number,
What page do you
112.
want me to answer questions for?
case number 112. page number 222.
This analysis was not provided in the original documentation to the county. We are trying to anticipate all the questions that board members will ask, and we anticipated them asking this question. What if we looked at it as one economic unit? Because we anticipated that, we prepared this analysis, but we continue to affirm that this is not the appropriate analysis for single-family properties. But yes, we did prepare this for the
And I
board, and it
appreciate
ended up in the case.
I appreciate your taking that alternative position. to
Excellent.
Give us the information.
Okay, and that's what we did with the county, and it was discussed at the county hearing. And some people are like, well, yeah, I think maybe that's how I'd look at it, as an income producing property, just one economic unit. But we have a lot of these rental communities in town, and we have already appraised a lot of them. This question was actually answered by the county board in the previous. So that's why we're saying, no matter what, we do not think this is appropriate with regard to the cap rate, because I think that's maybe what your main question is. 4% does seem low here. And we got that based on the next page, which is a median cap rate for sales that occurred like 2021 through 2023, because we didn't have very many recent sales. And so we just went with that median cap rate of 4%. If you notice on the bottom of the original analysis, page 222, it says the imputed cap rate is 5%. And that is more reliable. We have had some recent sales of, again, multifamily. This is a cap rate that we are using for multifamily, which again, we do not think applies in this case. But recent sales are around 4.5, 4.8. I think there was one at 5%. So the 6 and 6.25 is still too high, the one that they're proposing. And a 5% is better. 4% is kind of low, but 5% still supports what our value is. And our contention is that why would we value single-family townhomes significantly less than other single-family townhomes in the valley? These are not multifamily properties because it's not allowed. It's not legally permissible.
Okay, I appreciate that. Go ahead. I'm glad they discussed a little bit the income approach. I just want to share a few. Is it time for rebuttal or are they done?
We're done. We're on the questions.
Okay. I
asked a couple of questions. We're going to make a motion.
I think that this question of should it be valued as one unit or should it be valued as 79 different parcels is a question of how the property would be marketed and sold. If you're going to, and I think under NRS, the person appraising the property has the ability to make a judgment call in terms of their valuation. How would this be marketed and sold? Would it be sold as separate units? Value them as separate units. Would it be sold as one unit? Value it as one unit. Mr. Morris, you're the appraiser. You'd kind of be the one to make a judgment call on this. Personally, I think it would probably be sold as a unit. And so I think the proper way to value it is as one unit. So that being said, you look at the bulk home sales that they've provided and the range of prices, there's no adjustment to kind of give you a clue as to whether, which ones are more comparable or not. But the range of prices at which they're selling support the value that the property's on. So the other way to value it as a unit would be to look at an income approach. And it comes down to a cap rate call. I'm not familiar with enough with the market in Las Vegas to say it should be 4% or 6.5%. I think we've got testimony in here that it should be, 4 might be low, might be 5, or might be 5. Got testimony in here, maybe it should be 6.5. I think that's one of the reasons they have board members from different regions to kind of help us understand what's going on in the market. They aren't that far apart in terms of net operating income. But at a 5%, it supports value. At a 6%, it justify the little reduction. Those are my thoughts.
Thank you. Questions, comments?
I agree with those thoughts. I appreciate that the assessor put in some actual rates and didn't just testify to a cap rate. I didn't see anywhere in the petitioner's presentation that they gave any support for a 6 or 6.5 other than just testimony. Sworn testimony, but no numbers to back it up, no sales. But no sales.
No more comments from the peanut gallery over here, okay? Thank you. You've done very well so far today. We're almost finished. Please. Thank you.
That's all I have.
Is there, you indicated that there are cap rate comps in the assessor's information?
Assessor.
Could you help us
presentum.
find that, please?
It's 223.
What's the cap rate? Oh, there it is. Yeah. Well, only about half the sales even have cap rates. They're from 4, 3.67, 4, 3.4, 3.7, 4, 4. The highest one, 6.6.
I had recent
These
sales.
are, occurred in 21, 22, and 23, the year.
Yes, as I testified as well, we had a sale in January for an apartment complex that was 5% and 2 cents then. Could have been less than 5.
I'm sorry, I didn't call you. I don't know what you're referring to, but well, the median cap rate here on your own data is 4.04. I don't know how we could use something higher than that. I mean, that your own data suggests it should be in the lower than what you reconciled to. I guess one of the questions I really have, though, that's kind of concerns me that I'll go ahead and ask both of you. According to the statutes, the assessor's office is supposed to, as I recall, disregard highest and best use and appraise the property to its present use. Is that accurate?
Yes, that's right.
And so this property is not a for sale community at this time. It is a rental project at this time. So that would be its present use would be a rental project.
Well,
Is
it's
that
the
right?
same when you appraise a house. If I'm going out and appraising a residence, these are 79 residences. When I go to appraise the house, I'm using a sales comparison approach, number 1, which we showed you. Number 2, if it is an income producing property, I'm going to look at other similar homes and what they're renting for and come up with a multiplier. And we also did that analysis. That's typical for single family residential properties, which is what is built here, which is what legally permissible here. I know that's a part of highest and best
You're
use.
again
but-
getting into highest and best use, and that's what I'm trying to point out here is you've gone too far. You've gone into a highest and best use analysis where you're supposed to stop at present use. What is this thing presently utilized for? The same thing we have like a house out here on Las Vegas Boulevard on a single family residential property. I remember this coming before the county board when I was on it years ago. It was an older established single family residence, and the assessor's office was praising the land under a highest and best use analysis and saying it's H1 property and it's $100 a square foot. Well, you go back, it's an old house. That's its present use. That's what should be valued. Isn't that what we're dealing with here? This is the present use of the property as a rental project.
So we do recognize that it is a rental project. It's also current use is single family. It's single family rental community
Yes.
in which we have a bulk portfolio sale of a single family rental community that sold and looking at that.
Okay,
to
address,
test.
address those sales. We got into that and Mr. Sousa brought that up. We have no details on these sales. We have no adjustments for them. You just have big lump sale prices in here, like 17 million and here's where it is or whatever.
Right. There's details of each sale. We don't have the rent, we don't have the income, and we don't have the expenses, but we have the details to show what size the units are, what type of properties they are. Those are in subsequent pages on here. What we're trying to do with these is to test, are we exceeding the full cash value when it is sold as a portfolio, as a rental community, as the subject is a rental community? Are we exceeding full cash value on the sales that we see when there's a portfolio of rentals sold? Again, comparable 3 on there is the most relevant because that is one community where they sold, they built it to rent, and they sold it. It's very recent.
How comparable is it in average unit size, amenities, garages, location? That's probably a big one. Is it location? Is it,
So they're both in the Southwest. The subject and comparable 3 are both in the Southwest. They're both very newly built. It's 237 is, oh, no, not 237. Oh, I got to go back to the right. So this is case 112 that you're gonna, sorry, 113.
we're on the documents are in 112. It's what we referred to earlier.
In case
Where were we?
113,
Okay, just click on.
this is on page 237 is the summary, which shows sale number 3 is 117 parcels sold for 48,098,361. Now I'm gonna scroll down to find the
37.
That's 237. Now, the detail of cell number 3 begins on page 241 of case 113. So this shows
240 what? 241.
241. So these shows the year built was 2023. These are 1715 square feet to 1866. And Marquise, can you tell us what is the size of the townhouse units?
Between 1,051 square feet and 1,642 square feet.
So there is difference in
Smaller.
the heated area. Again, we're not saying because this sold for 48 million that the subject is worth 48 million. What we're looking at is, are we exceeding full cash value when a property sold in bulk?
If my calculation's correct, this sold for 48 million. It's 117 parcels. So that on average comes out to 410,000 per parcel. And the subject property right now is on at 27.6 million for 79 units. Average value per unit, 349,000 per unit.
Correct.
349 versus what?
410.
We've got a side differential of up to 50%. 40.
And again, we're not saying because this sold for 48 million, this one's worth 48 million. We're just trying to see, are we exceeding full cash value when we value these as individual parcels and they're sold as a bulk community sale? And we are not. They're still selling for more than what the taxable values are. Even when it is exactly what you said, we need to value it as what it is. It is a single individually parceled units that are a rental community. That's what we valued it at. That's what we tested with. We tested every component that we possibly could. And we made a reduction because when we look at these subdivision appeals, we look at everything. We look at the land value individually. Is it comparable to other land values that we've sent at the
I
area?
appreciate the steps you've gone through and that you've taken the time to look at it as both individual parcels and as a collective. That the information is in the record that you went through those steps. I appreciate it.
What does the information tell you? Now that you're appreciative of it.
Well, I was still waiting for you on the cap rate issue. Is it?
Well, I just went through the cap rates. I mean, their median cap rate was 4% on the data they presented.
And we have testimony that it should be 6 to 6.5.
Mr. Chairman, I mean, they got like 20 extra minutes here. Do I get any time at all, or is this all one-sided?
These are questions. We're on the section of the agenda where the state board asks questions.
Could you ask me a question about the cap rates then?
Well, I don't know. You think that's appropriate?
Mr. Sousa.
Yes, Mr.
Have you
Bancroft.
gone over their chart that shows the cap rates they're relying on?
I did. It's on SBE 223. These are all multifamily apartment complexes, which were quite the hot commodity back in 2021 and 2022. And they sold for cap rates that were in the fours. Now we have townhouses in 2024 and 5. These aren't apartment complexes. And so this data is stale and inapplicable to townhouse development, which is why Mr. Shetler, an expert in the field, has said that it would be between 6 and 6.5 if in fact this was being sold today, which is what his job is. Thank you.
Mr. Scheller, would you like to add anything?
I'm a beginner. Vince Shetler. Yeah, I just want to point out one thing that they keep using the word single family. These are not single family lots. These are more akin to multifamily. There's just no argument about it. Everybody here should probably know that does appraisals, especially them. And they shouldn't doubt me because I was right about everything that they had to go double check on. But these are not single family homes. And I'm curious about the comp that they're using because we don't have that information in front of us with the comps that they're using regarding the 117 units. Are these being described as townhomes or are these single family homes? Are they attached or detached?
We're getting an answer from the pro here.
They're detached, single-family homes.
Big difference.
And if I may comment on what he just said, it is not allowed for this to be multifamily. It's not multifamily. The zoning didn't allow it. They couldn't have done that. It's single family. It was only allowed single family. Multifamily was allowed up to a triplex only. This is not a multifamily project. It shouldn't be valued as a multifamily project.
What is its present use? Is it a single family or is it a multifamily
Townhouse.
residential community?
A townhouse is a single family.
I don't care
product.
if you're in 4 different tents outside in the yard out here. If you're running them as an apartment complex, but they're zoned for houses, how do you appraise it?
Its present use is single family rental community.
Thank you. The rental community. Whether it's single family or multifamily or townhouse or tents. Anything else?
No, I don't have any further questions.
Comments, questions, motions?
I will make a motion that with the evidence presented, the assessor's value does not exceed full cash value, and it should be upheld.
We have a motion. Do we have a second?
I'll second it.
We have a motion and a second. All those in favor indicate by saying aye.
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 Nay.
Aye.
Motion carries. Thank you very much. It is now 5:15. What time do we have to be out of here?
Mr. Chair, for the record, we probably should conclude for the day.
Meeting adjourned until tomorrow.
Chair, I apologize, Mike Evans, for the record. I know this is a multi-day meeting, but if the board would be inclined to take public comment just out of the.
Oh, I'm sorry. Yeah, you're right. I would like to call for public comment. Anyone wishing to express themselves, please raise your hand or call on the phone or just stand up and yell. Hearing or seeing no one, there's no public comment, meeting adjourned. Thank you.
I just said something real fast.